Hi students, welcome back to another interesting session of Corporate Accounting Marathon for your June 2026 attempt. I am Professor Fatima Kagalwala and I have been taking corporate accounting, financial management for over a decade now, and we have been catering and we are also designing the notes of your marathon from your complete revision point of view. So everything which is very important and which has high weightage of marks in your exams is all covered in this marathon. So even if you have not yet started revising, you can just be with me, revise it. It is all topic wise, where we will solve the basic example questions, some practice questions, followed by the past exam questions. We are also going to solve all the past exam questions of your just last December 2025 attempt. Okay, so now let's begin. Hello everyone, welcome once again back to our marathon classes. We are starting with corporate accounts as a subject, CAFM 60 marks of your section. Okay, to start with, I am taking up issue accounting for share capital, part A of that, which is issue of shares. Now before I begin explaining what is issue of shares and what all it involves, just a small understanding first about this particular chapter. Okay, if you will see this chapter in your module, it is accounting for share capital, right? Correct, absolutely. Now while I was teaching this entire chapter, I had broken down this chapter into parts. Okay, so I had issue of shares as part A. Okay, then there are a lot of parts to this particular chapter. Then we have buyback of equity shares. Then we have right and bonus shares. Okay. Then there is something like which I had thought was ESOPs. Then there was one more part I had taught about redemption of debentures. Redemption of preference share capital. And then there was one more part about underwriting of shares. So this entire accounting for share capital, I had broken down into the sections, and this was how I was teaching. Now amongst all, everything is important. Okay, even underwriting is important. It can be asked for 5 marks. Redemption of preference share capital 3 marks. ESOPs 5 marks. Right and bonus 3 marks. So all this is actually important from your exam point of view, this entire chapter, but it has a different type of weightage. When I'm talking about issue of shares carries the most weightage amongst all these parts, okay, because it covers a lot of things in that. To begin with, issue of shares, what I am going to cover is here. Okay, issue of shares is of 2 types, okay, understand. One is issue of shares for cash and one is for consideration other than cash. Okay, other than cash. Okay. Now talking about shares. What is a share? Share is like, shares is allotted to who? When a company comes to the public. Okay, and tells the public that we are going to raise money by taking, by making you all shareholders. Okay, so basically a share gives you a portion in the share capital of that company. It's your share. So the company is going to announce that, okay, we want to have a public issue. Public issue means what? We are going to allot shares to the public and raise money from the public and use that money for the purpose of XYZ, for whatever, is their motive for using that money, okay, for their capital expansion or for a particular project. Okay, so there will be a company coming for purpose of raising capital from the public, that is issue of shares for cash. Okay, there is something also known as issue of shares for consideration other than cash. Happens when, now say suppose I have just started my company, it is hardly any time, 6 months ago, and I am a company and I have a vendor from whom I am purchasing plant and machinery, and I'm purchasing some furniture and fixture. Okay, I have a vendor and he is giving me this plant and machinery for 10 lakhs, furniture and fixtures for 5 lakhs. So basically I have to pay him 15 lakhs. Okay, in short I am explaining, we will do the sums based on this, but just for you all to get an understanding, what does that mean? So now 15 lakhs rupees I have to pay to the vendor. So I tell my vendor that instead I give you 15 lakhs, why don't you become my shareholder? I will issue shares to you. Okay, instead of this entire 15 lakhs to be given in cash, I will give you my shares worth value, face value, say rupees 100. Okay, so I am going to give you 15,000 shares. So that is going to be 15,000 shares of 100 rupees each. So 15 lakhs rupees will be your share capital in my company. So it is done at the time when the company is trying to pay off their vendors in form of the capital instead of cash. It is also that say promoters have done a lot of work. Okay, promoters who are the ones who give the birth to the company, and they have done a lot of expenses towards the incorporation of the company, and they have to take something in return, or the company has to pay something to the promoters. Then yes, again the promoters can be given shares. Instead of cash, they are given shares and they become the shareholders of the company for the entire preliminary expenses, etc., whatever they have brought into the company. Okay, so there are two things which can be there for consideration other than cash. Yes, even employees can get in form of stock option scheme. Okay, they also get it, like if you have done a lot of good work, then you will get it as a stock option. You apply for these particular shares. So there can be sweat equity shares, which there is no money taken from the employees. So that is also for consideration other than cash. Bonus shares, when company has got a lot of reserves, they want to convert it into capital. So then capitalization of reserve. Capitalization of reserves can be done in form of bonus, where we do not take any money from the shareholders. We just give them shares in form of bonus. I had Reliance shares. I had 6 shares. They gave me bonus 1:1. So now I have plus more 6. Then again they gave a bonus. Again 1:1 ratio. Now basically I am standing at good amount of shares of Reliance by just taking 6 shares once at a time. Okay, so this is how the bonus takes place, and no single penny has been taken from the shareholders. So consideration other than cash is also a part of your issue of shares. Coming to issue of shares for cash. Okay, now I am going to take one simple example and then we will pass the journal entries based on examples. Okay, issue of shares from your exam point of view also is all about journal entries. Okay, now say there is a company XYZ Limited. Okay, they want to issue they want to issue say 100 shares. I'm taking simple amounts and figures. They want to issue 100 shares. Face value of the shares will be 10 rupees each. Now what happens is, generally, if in case you have ever applied in an IPO or all have seen how IPOs also take place, you all must have seen that you have to pay some amount at the time of applying for the shares, and then at the time of allotment you have to pay something. So it is like, say if you went to a college, okay, for your purpose of your admission. So you take an application form. For that application form you paid say 5 rupees, and when you were allotted the seat you paid for the first year. then you paid for the second year, and then you paid for the last year. Okay, it is as simple as that. So even the companies, when they want to do these type of issues of shares to public and take so much of money, crores of rupees, so what they do is this entire money, they split it in stage wise. They say that at the time of application, you all pay us only 2 rupees. Then at the time of allotment, we will take 3 rupees. Okay, then there we stop, and then we may give you a call. Okay, we will write a letter to you all to pay 2 rupees, and then in the final call, whenever we will need it, we will take the last balance 3 rupees, and that is how it is going to become 10 rupees. Correct? Okay. So now this entire stage wise, this is generally what is happening. Okay. So this entire stage wise collection of the money requires an accounting treatment. So how is the accounting process to be taken place? Okay, it has to be followed as per the principles laid down for issue of shares. So for application stage, allotment, first call, final call, all the 4 stages, there will be 2 journal entries each. For each stage, 2 journal entries for each stage. For application, I will have a receipt and a transfer entry. For allotment, I'll start with a transfer, then receipt, then again transfer and receipt, and transfer and receipt. Now, what is this transfer? What is this receipt, ma'am? Nothing. It is simple. Receipt means when you receive the money. Okay, when we receive the money for that particular stage. Okay. And transfer is whatever you have received, we transfer it to the share capital account. The share capital account. That is it. These 2 journal entries for each stage has to be understood well. If you all understand, this entire chapter is solved. Okay, I'm going to take you all through different situations in the same example. Okay, so right now, say my first stage is application, second allotment, third is first call, and the fourth stage is final call. Starting with the application stage. Okay, applications. I have received money. Always think from the company's point of view. You are a company. Okay, you have issued shares. You are passing journal entries. What are you? You are a company. So company is receiving money. So bank account debit, money coming inside. How much money I am taking on application? Only 2 rupees. How many shares we have issued? 100. Correct? 200 rupees. Why did I get this money? Because of share. Perfect. Share application account. 200. Okay. Now this is being money received on share application. This is receipt. Now transfer. Simple. Share application. Where will I put this money? Superb. I will put this money to share capital account. Transfer it to equity share capital account. You can write equity share capital. Okay, equity share capital. These are my short forms. You all will get used to it in some time. Now coming, the first stage is over. 2 journal entries, simple, done. Third. In the third means that is the second stage, allotment stage. Okay. In my allotment stage, I do not wait for the money coming in. Okay. There will be a date when the money will be collected for the purpose of allotment. What I do is I first do the transfer. I say that share allotment. I have to allot shares to whoever has applied. Okay. As per 3 rupees or for 100 shares, I have to do the allotment. I will directly first transfer it to the equity share capital account. And then on the date of receipt, we will say bank account debit to share allotment account 300 rupees. Okay. So the second stage is over. This is how the accounting principles is. Generally, all this is given in the form of dates. They might not give you dates. They might give you dates. If dates are given, you are supposed to mention the dates. Okay. So allotment stage, immediately things start changing. You will first put the transfers and then the receipt will come on the later journal on a later date. Now coming to the first call. On first call, how much money I am collecting? Again, 2 rupees. Okay, so same again, the same thing. I will do the transfer first. So I will say share first call. Account debit. I am taking 2 rupees on 100 shares, 200. To equity share capital account, 200. And then I will do the receipt. I will say bank account debit. Bank account debit. 200 rupees received. Why? Because of share first call account. Right? So in short, if you see in all the stages, basically you are doing bank account debit to equity share capital. See, share first call, debit, share first call, credit cancel. No, as per the journal accounting rules. Okay, one debit, one credit of the same amount. It gets automatically nullified. So bank account debit to equity share capital we are doing. But no, we cannot use these type of shortcuts. We have to kind of follow the rules, and it has to be mentioned in this way. Okay, so done. This is your call stage, and last one is your final call. Share final call. We are taking 3 rupees, so because of 3 rupees it is going to be 300 to equity share capital account 300. And then the last one will be the receipt. Bank account debit 300 to share final call 300. Okay. So that is it. Like means totally if you see in my bank, I got how much? I got 200 rupees. Then in my bank I got 300 rupees. Again in my bank I got 200 rupees, and then last again I got 300 rupees. So 500 plus 500, 1000 rupees. Yes, has to be. Why 1000? 100 rupees, 100 shares, 10 rupees each, 1000 should come in my bank account. And equity share capital also, if you will see, it will be 1000. 200 equity share capital, 300 equity share capital. Again 200 equity share capital, and this is last 300 capital. So amount received 1000 towards equity share capital 1000. Done. Okay. Now tell me one thing. I'll just change my example a little bit. Okay. I'm saying the face value is 10 rupees, but we issued the shares at premium of rupees 2 per share. And this premium we collected on the allotment stage. What do you mean by shares issued at premium? The value is 10, but company is taking more money from you. Okay, we are taking 2 rupees as a premium, and you all are ready to pay it also. Okay, so that 2 rupees premium is not for the shares capital. There is a separate account which is known as security premium, right? So we cannot put that money in share capital because this 2 rupees is extra collected over and above the face value. Face value is more than the issue price. Therefore, I can say that is 2 rupees is my premium. Now that 2 rupees is collecting at the allotment stage. That means on allotment stage I will get 3 plus 2. Only then my issue price will become 10 plus 2 equal to 12. Right. So now what will happen is, by this allotment stage, the journal entry will change. Why will it change? Because I am not going to get 200 rupees. Sorry, I am not going to get 3 rupees on my allotment. I am going to now get, I will now get 5 rupees on 100 shares. 3 plus 2. So I am going to get 500, and here also 500. Correct? So in my bank account also it has to be the same thing, 5 rupees on 100 shares. So it has to be 500. Right? Bank account debit 500. Oh, sorry. My bad. Okay. Okay. So share allotment account debit 500 to equity share capital. Now equity share capital can never be written on any other value but only on the nominal value. Okay. You cannot write capital account on any other values. Nominal value means what? It can be written only with respect to its face value. So what is the face value? How much face value I am taking on the share capital? Only 3 rupees. On face value I am taking only 3 rupees on allotment. So my equity share capital also will stand at 3 rupees only. 300. So what will happen to this balance 2 rupees which I took extra? I will have to mention to securities premium account, a separate reserve kind of account wherein I am putting this extra money received in security premium, because security premium is governed by company law. Okay, the usage of security premium is also governed by company law and accounting principles. You cannot use security premium everywhere. This money you are supposed to use for certain purposes as mentioned in the act. Okay, so there was a past exam question in which they have asked where to use security premium, and I have solved it and I have given it to you all in the notes also. So security premium 200 rupees will now appear in my transfer entry of my allotment stage. Transfer entry. In the bank I received 500 to share allotment 500. This is done. There is no problem here. But the important entry is of the equity share capital and securities premium. Okay. So wherever the premium is collected, in that stage, in the transfer entry, the premium will get reflected. Okay, if you all want, you all can write down this as a note that whenever a premium is there on the share capital, that premium in whichever stage it is, if it is in allotment stage collected or it is collected at the application stage, whichever stage it is collected, it has to be recorded in the transfer entry of that stage. There are only 4 stages. There can be 3 stages also. Application, allotment and final call. Okay, first and final. There can be 3 stages, there can be 4 stages depending on what the company wants to do with that money. Okay. Clear? Now we will change a little bit. Okay, we will put certain addition to this. Now what has happened is there was Mr. A. Okay, who had applied Mr. A who had applied for 20 shares. Okay, he did not pay me my first call money and he also did not pay me my final call money. Okay, we had allotted him 20 shares. Okay, out of 100 shares, I will know who all are my shareholders, A, B, C, D, F, G, H, whichever. So Mr. A was given 20 shares. Now when company is calling them to pay the first call and the final call money, on first call 2 rupees and on final call 3 rupees, this Mr. A is not paying me. So now what happens? Now basically first call and final call stage I'll have to go to. That means the last 2 stages. So when I'm doing the transfer, I will not know that Mr. A is not going to pay, because I will come to know when the money will hit in my bank account, right? So my transfer entry of that stage has nothing to do. It will remain the same. 2 into 100 shares, 2 rupees, share call account debit, first call to equity share capital. But when the money will come in my account, I will get money of 2 rupees only on 80 shares. Right? So if I'm getting that much only, I'll have to write also that much. It is going to be only 160 rupees. Right now, 160 correct. But share first call was debited by 200. It has to get credited also by 200. Okay. It was debited by 200. Credit also by 200. So this 40 rupees which I did not get, 2 into 20 shares. There was Mr. A allotted 20 shares. He did not pay me my 2 rupees. That will be my calls in arrears. Okay, 40 rupees will be my calls in arrears. Same thing now, final call also. I did not predict he will not pay. I cannot predict that. No, but I am doing the transfer first. So share final call transfer entry I will not touch. But what will happen in case of the receipt? At that time I will come to know that okay, in my bank account I got money only on 80 shares with respect to 3 rupees. That is 240. But share final call is to be credited also by 300 because it was debited by 300. So this is going to be my calls in arrears. 60 rupees. Why? Because on my 20 shares, I did not get 3 rupees, which was my final call amount to be received on that 20 shares. Clear? So basically, if there is calls in arrears, there can be calls in advance also. There are some people who like to pay in advance. Okay, they say that on allotment only, on first call only take my final call money also. No? So that is a different thing. Okay, but generally in the sums we are more focused on calls in arrears. Calls in arrears or whatever, even if it would have been calls in advance, it will always be recorded in the receipt entry of that stage. Okay, calls in arrears or calls in advance will always be recorded in the receipt entry. When the money will be received, I will come to know whether there is calls in arrears or okay. So let the story continue. What happens with this calls in arrears? What do we mean by this calls in arrears? Like the company is giving a call, a notice, okay, to that shareholder, Mr. A, that kindly come and pay the money. Your first call money is also pending. Your final call money is also pending. And they give them the time paid within 15 days or 45 days of this notice, whatever is their call. Okay. And then they again send a notice saying that you have still not paid. This is the final call which we are writing to you. And if you do not pay now also, we will forfeit your share. Superb. Forfeit of the shares takes place. Okay. So now what does this mean? Forfeit of the shares. Forfeit means what? That the company will keep the money paid by Mr. A so far. Whatever he has paid, no? A company will keep that money also, and company will cancel Mr. A's name from the shareholders list. Okay, they will put a cross. Just saying it as a form of story, but I am kind of trying to make you all explain that they will now not consider Mr. A as their shareholder, and whatever money you have paid towards that shares will be forfeited, will be kept by the company. So now if I am forfeiting, I am company and I am forfeiting these shares, 20 shares of Mr. A, I will have to now pass the journal entry. Okay, so I had completed 8 journal entries so far. So my 9th journal entry will be about share forfeiture. Okay, very, very important concept. Okay, share forfeiture. When I was issuing shares, I was crediting my equity share capital, right? It is like money coming in. So it's a capital. Capital is always on the credit side. Okay, so we take it on the equity share capital also in the balance sheet. So when I'm cancelling capital, I will debit it. Easy. So what I will say, equity share capital account debit. How many shares I'm cancelling? 20. Okay, share capital always at nominal value. I cannot write any other value. So what is my nominal value on the capital? 10 rupees. So I'm cancelling equity share capital to the extent of 200. 2. Share forfeiture. Share forfeiture means amount paid on face value. So how much did Mr. A pay me on my face value? He paid me my application? Yes. He paid me my allotment? Yes. He did not pay me my first call and final call? No. So how much did he pay me on my face value? 5 rupees? Very good. So 5 rupees I am going to put it in my company's share forfeiture. It is like a piggy bank. I am going to put it over there. Okay, it is there with me. So on 20 shares, 5 rupees Mr. A had paid. So it is going to be 100. 2 calls in arrears. Calls in arrears will be total unpaid amount. Okay, total unpaid amount. So on 20 shares, how much he did not pay? He did not pay me my first call. He did not pay me my final call. Total unpaid amount. Okay, so again 5 rupees. So this is going to be 100. So calls in arrears, share forfeiture. Let me check my calls in arrears. Okay, just verify. Calls in arrears is 100 over here. In credit side, so it has to be debit also by 100. So see this 60, 40. Debit also was 100. Credit also is 100. So calls in arrears gone. This 20 shares gone from my book. I have money in my share forfeiture account. Now what will I do with this 20 shares? What will the company do now? Company cannot do anything. They will do just simple thing. They will find somebody. Okay, they will say, okay, let us find somebody who is ready to take these shares. Okay. So now what they will do is they will reissue. Okay, reissue 20 shares of Mr. A to Mr. Z or say to Mr. B. So there they have found one person who is ready to take up this 20 shares. Company is telling them that we will give you these shares in 9 rupees and we will make it fully paid. So now Mr. B has agreed 1 rupee discount he is getting. So what will be the journal entry? Bank account debit. So company is going to get 20 into 9. Why? Because there is a discount on issue. To equity share capital. Okay. Now equity share capital means discount on issue is only 1 rupee. Equity share capital will always be at nominal value as I told you all. So it has to be 20 into 10, 200. So how much will be in my bank account? 180 rupees only because I have issued it only for 9 rupees. Now shares cannot be issued at discount as per law. Okay, unless it is a reissue of forfeited shares. Okay, otherwise shares issue at discount is prohibited. You cannot reissue the shares on discount to the public. However, if there is a reissue happening of the forfeited share of a given shareholders, reissue is permissible. Okay, so 9 rupees I took from Mr. B and I told him I am making it fully paid up. Equity share capital 200. This discount on issue or loss on issue, if I can mention it, this loss on issue I will remove from where? I will remove it from my share forfeiture account. You can directly write over your share forfeiture or you can write share forfeiture, another journal entry, say share forfeiture account debit to loss on issue or discount on issue, whatever terms you want to use. Okay. How much? 20 rupees. Okay, now in my share forfeiture, I had 100 rupees. I used 20 rupees. These shares were forfeited. They have been given to Mr. B. Share forfeiture account now has to stand closed because now there are no shares only remaining. What will I do with this share forfeiture? So what I do is I transfer the balance. Transfer of balance in share forfeiture to capital reserve account. Why capital reserve account? Because it is a one-time profit on capital. It's not going to keep recurring again and again that I'm going to put in P&L account. Okay, so share forfeiture account debit 80 rupees was the balance to capital reserve account 80 rupees. Okay, so if you have done all the journal entries and you forget this last one, you do not close share forfeiture. That means your 20 shares which were forfeited are still shown as a balance. If you don't pass this entry, your marks will definitely get deducted to a greater extent. So this entry is very important when your entire story of reissue has taken place. Whatever is the balance in your share forfeiture has to get transferred to capital reserve. Okay, everyone. Now, small thing. Okay, just one small change in the sum I am doing. But I'll show it to you in a separate way of journal entry. Say suppose this Mr. A, okay, 20 shares was allotted. He had applied for 20 shares. I'm just changing my example a little bit. He had applied for 20 shares. Okay, applied and allotted 20 shares. He did not pay me my allotment money also, which was 3 plus 2 rupees as a premium. Okay, so calls in arrears will appear even in the allotment stage. Okay, it will appear it even in the allotment stage calls in arrears. Okay, at the time when money will be collected, that Baba bank account, it will not show 500. Here, the bank account will be showing me some other amount. Why? Because there was no money received on my 20 shares. So bank account, I will get only 80 shares. On 80 shares, I will get 5 rupees, no 400. Why? Because Mr. A did not pay me my money. He was having 20 shares. He did not pay me my 5 rupees. To share allotment account. Okay. So calls in arrears will appear in the receipt entry of that allotment stage also. Rest everything is the same. Final call, first call. He did not pay me my final call money. He did not pay me my first call money. But what will happen in the share forfeiture now? The share forfeiture journal entry will now change. Why it will change is, because I want to show you application, then allotment 3 and then plus 2, then first call is 2 and then final is 3. Okay, what is the journal entry of share forfeiture? Share forfeiture is cancelling 20 shares. Okay, 20 shares I am cancelling. So I will debit equity share capital account. Okay, how many shares? 20. What is the face value of the shares? 10 at nominal value. Okay, 200. Now securities premium is unpaid. He did not pay me my allotment money. So he did not pay me my allotment money means he did not pay me my money on securities premium also. So when I was collecting premium, I was crediting. When I did not get premium, I'll have to debit it. Okay, securities premium account debit. On 20 shares, he did not pay me my 2 rupees premium. 40 rupees. 2. Share forfeiture. Share forfeiture is paid amount on face value. How much did he pay me on my face value? Only 2 rupees. So how much it is? 20 into 2. He paid me only 40 rupees. 2 calls in arrears. Calls in arrears means what? Unpaid amount. Unpaid total amount. Total. So total amount means what? He did not pay me my 3 plus 2 plus 3. Plus he did not pay me my 2 rupees. Total unpaid amount. Unpaid on face value with the premium. It is going to be how much? 5 plus 5. 10 rupees. Totally he did not pay me my 10 rupees on total unpaid amount is 10 rupees. Done. Now the journal entry tallies. Okay. So remember one thing. If securities premium is paid, it will not get recorded in the share forfeiture journal entry. But if securities premium is unpaid, then in the share forfeiture journal entry, it will definitely get recorded. And hence your amounts are going to change to that given extent. Okay, so this was the entire story of XYZ Company Limited, who came with 100 shares to public for issue at a premium of rupees 2, wherein there was Mr. A who did not pay money on his 20 shares. His shares were forfeited, and after that it was reissued to Mr. B for 9 rupees as fully paid up. I have just given you all this as a separate example, so that when we are going to solve the sums, there can be a situation where securities premium was also unpaid due to a stage where premium was supposed to be collected was in arrears. So then in that case we will have to understand this journal entry. Okay. So now I am starting with my questions. Okay. Easy questions. There's nothing you all have to worry. You all have to just pay attention now. If in case you all have copied the example, very good. It will really help you all relate to any questions asked in the exam. Okay, let's read a question. Easy question. P Limited. Okay, until now, so far, I hope everything has been clear so far. I just want you all to put a thumbs up or a like sign, so that I know you all are with me and things are solved properly. Okay. So then we move on to the sums. I have taken good sums for your understanding. Okay. Fine. I think I'm pretty clear. You all are able to understand. No problem. Let us read the first question. P Limited was registered with an authorized nominal capital of rupees 10 lakhs. Okay, that was divided as 1 lakh shares of rupees 10 each, out of which 50,000 equity shares were offered to public for subscription. The shares were payable as follows. Now, what does this mean? When you register a company, you will have an authorized capital. You will have to register with that many number of capital. So, your amount of registered capital is 10 lakhs. How did you get that amount? You are having 1 lakh shares of rupees 10 each. Not necessary entire shares you will issue it to the public. You have been registered with this capital. Okay. Out of that 1 lakh shares, 50,000 shares company is coming out and telling the public to pay as a public issue, public subscription. They are saying 3 rupees on application is to be collected, 2 on allotment, 2 on first call and 3 on final call. This is like my example, same thing. The shares were fully subscribed and money was duly received. Show the journal entries, journal and the book entries. Very easy. Same thing, same like my example. So solution, in the books of P Limited, journal entries in the books of P Limited. How many shares are given to public? 50,000 equity shares at rupees 10 per share. Issue is at par. At par means what? Face value is the same as the issue price. See? Anything mentioned about premium? Nothing, no? Rupees 10 each. So application stage 3, allotment 2, first call, final call, 10 rupees on the face value. Journal entries. First will be my application stage. In application stage, we first pass the receipt and then go to the transfer. In case of allotment, we will do transfer receipt, first call transfer receipt, final call also transfer and receipt. So starting with the application stage of receipt. I am going to receive money on 50,000 shares. How much? 3 rupees. So 3 into 50,000. 1,50,000. Okay, yeah, I have written 1,50,000, no? So bank account debit to share application account 1,50,000. You all are supposed to write narration unless mentioned in the question that narration is not required, being money received on share application. Okay. Next one is share application account debit. 50,000 shares. You will transfer share application to equity share capital account. Okay. So share application account debit to equity share capital 1,50,000. So money received on application is transferred to equity share capital account. So first stage is over. Now the next stage is allotment. In allotment, I will do the transfer entry. So share allotment to equity share capital 50,000 into 2, 1 lakh. And then the receipt bank account debit to share allotment 50,000 into 2, 1 lakh. I am not wasting much time on this sum. Then first call 2 rupees I am collecting. So on 50,000, 2 rupees share first call to equity share capital and then the receipt bank to share first call account. And then the last is a final call, transfer entry, share final call to equity share capital and the receipt bank to share final call account. That is it with this sum. Just to make your basics more strong. 4 stages, 2 journal entries each, 8 journal entries we finish. There cannot be a 9th journal entry because there is no additional story to this question. Okay. Now coming to a interesting sum. There is a lot of things now in this sum. Question number 2. B Limited issued 20,000 equity shares of rupees 10 each at a premium of 2 rupees per share. Very good. We have premium now. It is payable as follows. On application 5 rupees including 1 rupee premium and on allotment also again 5 rupees including 1 rupee premium and on final call rupees 2. Applications were received for 24,000 shares. Now this is something very different. Okay, 20,000 equity shares company has issued to public, but applications were received for 24,000 shares. What did the company do? Letters of regrets were issued to the applicants of 4,000 shares and then allotment was made to the other applicants. Mr. A, who was holding 200 shares, he failed to pay the allotment and the call money. His shares were forfeited. Show the journal entries and cash book in the books of B Limited. Okay. Now what happens is, see, issue of shares. Okay, the company had issued 20,000 shares. And applications also were received, say, for 20,000 shares. I will say issue is fully subscribed. Okay, number of seats available in the college, all the seats were applied and allotted. Done. Exact number, 100. Here also 20,000 shares were put to the public and 20,000 applications were received. This is fully subscribed. What can happen is, in our question, we have received application for 24,000 shares. This is known as over subscription. In case of over subscription, two things can happen. Okay, either the company will not allot for that 4,000 extra, they will reject it and refund it. Reject and refund the money. Allotment will not happen for this extra 4,000. They don't have only, no. Or else they can do a pro rata allotment. They will say that okay, whoever has applied for 3 shares, we will give them only 2. Okay, pro rata. Adjustment they do. So that is also possible when there is oversubscription. And if there is undersubscription to the extent of less than 90%, at least 90% has to be subscribed. If it is less than 90%, your issue fails. You cannot go to public. You have to refund the application money. So there is undersubscription, oversubscription and fully subscribed shares. Okay. Now let us understand the solution. In the books of B Limited, 20,000 equity shares. Okay, issued at a premium. What is the premium amount? 2 rupees. What is the face value? 10 rupees. How they are collecting the money? I will write it separately. Okay, I'll write application, allotment and call. On application, they are taking total 5, but 1 is premium. So on application, actually on face value, I'm taking only 4 rupees. Plus 1 which is a premium. Same thing on allotment, I am taking 4 plus 1 as premium. So the balance 2 rupees is on the call. So 10 plus 2 is my issue price. Right? Now, journal entries. Journal entries are easy until Mr. A, who is holder of 200 shares, means he must have applied for 200 shares. He did not pay me my allotment and call money. Also, this sum is a pretty simple, even if there is oversubscription. You see 20,000 and 24, they have refunded. They have sent letters of regret and refunded the money. So what will happen here is, first application stage, I will receive the money. Receipt will happen. Receipt will happen on 24,000, not on 20. Because they have mentioned 24 shares applications were received. So on 24,000 I am receiving 5 rupees. So it's going to be 1,20,000 to share application account. 1,20,000. But when I will transfer this, okay, when I will transfer share application account debit 1,20,000. But on my share capital, I will have to transfer only to the extent of 20,000 because that much is the issue. So 20,000 into 4 face value 80,000 and 20,000 shares into 1 which is the premium. So that will go in the securities premium account. Right? Balance 4,000 extra shares were refunded. So whatever money I received extra, right, 20,000 I received extra, I am refunding that money. I do not want to do pro rata allotment. I am rejecting these applications. If I am rejecting, I can't keep that money, no. I have to refund it and close it. Okay, so even though in share application 1,20,000 was received, I have refunded 20. 1 lakh will be the amount. Exactly 20,000 shares, rupees 5 on application. Understood application stage. Now coming to the allotment. Now allotment story is starting. Allotment again. Now share allotment basic. Okay, share allotment will happen of 20,000 shares only. Okay, so 20,000 shares. On allotment also we are taking 5 rupees. So to share allotment account debit 1 lakh. Equity share capital always at nominal value. What is the nominal value I am taking? 4 rupees. So 20,000 into 4 will be 80. To securities premium account 20,000 into 1. 20,000 rupees. We are taking it in form of premium. When transfer took place, I did not know Mr. B will or Mr. who is it? Mr. A will not pay. Now when the transfer finished, now receipt took place. At the time of receipt, I came to know that Mr. A, who was holding 200 shares, he did not pay me my allotment money also. He did not pay me my call money also. On allotment it was 4 plus 1. On call it was only 2 rupees. Fine. So he did not pay me my allotment money. So in my bank, I will receive money only on 19,800 shares. No. Because there is calls in arrears on 200 shares. So 200 into 5, 1,000. So balance it is 19,800 into 5 rupees. 99,000 only I will get it in my bank account. To share allotment 1 lakh. So receipt is done. Coming to the final call. Same thing. Share call account debit. How much money I am supposed to get on call? 2 rupees for 20,000 shares. That is 40,000. To equity share capital 40,000. There is no premium in this stage. But in my bank I will receive money only on 19,800 shares. Or with extent to 2 rupees on that each share. 39,600. Calls in arrears will be on 200 of Mr. A. Into 2 rupees, that is 400. To share call account 40,000. Okay, so receipt and transfer. There were 3 stages, therefore 6 journal entries, right? Each stage 2 journal entries. Over. Last thing they are telling me that the shares were forfeited. So I will have to take my story to one next stage. Forfeiture means what? Cancelling of the share capital. How much shares I will cancel? 200. At what value? At the face value. So equity share capital account debit 200 into 100. Sorry, please write down this 10. Equity share capital 2,000. In my this case, securities premium is unpaid. See this. Security application stage money he paid. Okay. But in case of my allotment, this 1 rupee is unpaid. No. Unpaid securities premium. So it has to appear in the share forfeiture entry also. So securities premium unpaid 1. On 200 shares 1 rupee he has unpaid on premium. So 200 rupees. Share forfeiture is the paid amount on face value. How much he has paid me on my face value? He has paid me only 4 rupees. He has paid me only 4 rupees. So 4 rupees I am going to take it and put it in my share forfeiture account. Share forfeiture account debit 4 rupees on 200 shares 800. And calls in arrears will be total of unpaid amount. How much is my total unpaid amount? Total. This. Allotment 4 plus 1 and plus 2. So total unpaid is 7 rupees. So 7 into 200, 1400 will be my calls in arrears. Okay, so this will be my 7th journal entry. They are asking me, after this make the cash book. Okay, so cash book, ledger kind of a book, debit side, credit side. Okay, when money came in the account due to application, share application 1,20,000. Then I refunded the money, so it will go on the credit side, money moving out, refund 20,000. Then on allotment I got 99 and on share call again I got 39,600. So the balance in my cash book is 2,38,600. That is the closing balance. That same will become my opening balance. Opening balance brought down. Okay, brought down. Carry it forward and this will be brought down. Clear everyone? Any doubt? Okay. So this was our question number 2. Okay. First and second done. Alright. Now I'm starting with question number 3. It is a little lengthy question, alright, but it is very interesting. Let us read the question. Messrs. Herbal Tea Plantation Limited was registered with a capital of rupees 1 crore. It is divided into equity shares of rupees 100 each face value. So face value is 100 of each share. The company offered to public 50,000 shares at a premium of 20 per share. The amount on share was payable as follows. 20 rupees they took on application. They took 50 rupees including this 20 premium on allotment, 20 on first call and balance 25 on final call. Applications were received for 75,000 shares. Shares were allotted to the applicants on pro rata basis. Oh, so what happened was 50,000 shares was offered, but applications was received for 75,000. So 50,000 offered and application received for 75,000. They are saying that the shares were allotted on pro rata, means they did not refund this extra 25. They were doing pro rata allotment. Okay. Kantibai, who was allotted 500 shares, he did not pay only the allotment money. He also failed to pay the first call money and his shares were then forfeited. Sheetal, who was holding 200 shares, she did not pay the first call. Final call was not made only to the public. Make journal entries in the books of the company. Okay, now this is a matter of oversubscription and pro rata and calls in arrears and forfeiture. So everything together. Okay. So comprehensive question I have taken. In the books of Herbal Tea Plantation Limited. Okay. Let us just write it down a little bit. Application stage, allotment, then first call, and then there is some final call. So on application they are taking 25. Then on allotment they are taking 30 rupees plus 20 on premium. Then on the first call they are taking 20 rupees. And then on the final call they are taking 25 rupees. Just for me to quickly put it on the notes. Even if you all will write it in your question as given, it is going to look fantastic. Okay, journal entries. Starting with the application stage, receipt. But receipt, 50,000 shares were offered, 75,000 were received. So I'll have to take care. My application stage will be with 75,000 shares. Okay, so 75,000 into 5 rupees, 18 lakh 75. Share application, bank account debit to share application, being application money received on 75,000 shares at rupees 25 per share. This application money has to go to transferred to share capital. I am not doing any refund. If I am not doing a refund and I am doing a pro rata allotment, that means my extra money on application has to be adjusted with allotment. Yeah, because I am doing application to allotment pro rata, na? So here also I will now have to do the adjustment only. So what I'll say, share application account, yes, 18 lakh 75. But equity share capital I cannot write on 75,000 shares. No, I don't have only. So I will say 50,000 into 25, that will be 12 lakh 50. So this extra 25,000 on which I collected 25 rupees, 6 lakhs 25. There is extra 25,000 shares, right, on which we got collected 25 rupees in application. I will adjust it to my share allotment. I will consider that money on share allotment to this extent is received. 6 lakhs 25,000. I'll adjust this towards my allotment stage. Okay, so this is important. Very, very important. Okay, because there is no refund and I'm trying to adjust it. I'm adjusting the entire 25,000 extra shares. So I'm adjusting it at the allotment stage. We always adjust it with the allotments. Now in case of allotment, first the transfer will take place. So how many shares I will allot? Obviously 50,000 into 50 rupees, because on allotment I am taking 30 plus 20 na. Total 50 I am taking on allotment. So I am going to write 50,000 into 50. But equity share capital always at face value. Face value is only 30 rupees. It's going to be 50,000 into 30. And premium amount I am collecting here, 50,000 into 20. 50,000 into 30, 15 lakhs, and the premium amount is 10 lakhs. So this was the transfer of allotment. Now coming to the receipt. In case of my receipt, okay, share allotment 25 lakhs I have debited, right? But if you see, there was an adjustment of 6,25,000. So basically I am not going to receive again this 6,25,000. I am going to now have to be transferred, because I have already transferred 6,25,000 in my share allotment. I have adjusted it, right? Here itself only I have adjusted. Share allotment total is 25 lakhs. I have pre-adjusted at my application stage 6,25,000. So now balance that I will transfer to share allotment will be only 18,75,000 now. I have done the working note. Now in case of allotment stage, they are saying Kanti Bhai, who was allotted 500 shares, he did not pay the allotment money. So that means in my allotment at the time of receipt, I am not going to get money as expected. Okay, so what is the working note? See here. Calls in arrears, working note has to come. Applied shares 75. Allotted is only 50 by the company. So the ratio is what? 75 is to 50, that is 3 is to 2. That means if you have applied for 3, in case you have applied for 3 shares, company allotted only 2 shares to you. They did not reject anybody. They accepted everyone. Very kind of them. But they have allotted only 2 shares if you have applied for 3. So they are telling Kanti Bhai was allotted 500. Kanti Bhai was allotted 500 shares. So how many shares he must have applied? I need to know how many shares he must have applied. So application is to allotment 3 is to 2. If allotted was 500, cross multiply 500 into 3 divide by 2, you will get 750 shares he had applied. That means at the time of application, Kanti Bhai paid money on 750, means as per 750 shares, 250 shares extra. So he has paid how much extra money? On 250 shares, he had paid 25 rupees at the time of application. Extra 250 shares, that is 6250. And at the time of allotment, we had to collect on 500 shares 50 rupees, that is 25,000, which he did not pay. But he had paid extra 6250. So my net receivable or net calls in arrears from Kanti Bhai will be 25,000 minus 6250, which is rupees 18,750. Once again I am repeating. In this case, there is a pro rata allotment. Number of shares allotted will be different as per applied. People had applied 75,000 shares, allotment took place of 50,000. So even Kanti Bhai is facing the same problem, no? He was allotted 500 shares. How he get this allotment? He must have applied for 750. I cross multiplied it. 500 into 3 divided by 2. 750 shares he must have applied. Only then he got 500 shares allotted. That means at the time of application payment of money, he paid money as per 750 shares. 250 shares extra. So on 250 shares extra money, 25 rupees on application, 6250. And at the time of allotment, he had to pay me on 500 shares as per 50 rupees on allotment, right? We are taking how much? 30 plus 20, 50 rupees. So 25,000 rupees was due from him. But he had paid me an extra amount of 6250. So actual arrears from him will now only be 18,750. So allotment money receivable will be from 25 lakhs. I have adjusted towards application 6,25,000. Arrears from Kanti is also 18,750. So in my bank account, it will hit by only 18,56,250. It will not be 25 lakhs completely. The first thing that we have understood. Why? Because 6,25,000 which was extra was already received at the time of application. So I am not going to receive this again in my bank. Also, I am not going to receive this 18,750 of Mr. Kanti Bai. So how much money I am going to get? Only 18 lakhs 56,250. This is what is written over here in form of the working note. Okay, very, very important. These are the type of sums and questions which they are going to ask you in the exams. If you have understood the concept, cross multiplication, adjustment, there is nothing, there is no way you can go wrong. Only the amounts will change. Okay. So I have finished with my allotment stage. I have finished the receipt and I have finished the transfer first, and then the receipt entry is also done. Now final call. No, sorry, first call. We still have first call of 20 rupees. Okay. So transfer, share first call account debit 20 rupees on 50,000 shares, 10 lakhs to equity share capital 10 lakhs. Again the story begins of calls in arrears. In the time of the receipt, okay, Kanti Bai did not pay my allotment money. He also failed to pay my first call. And his shares were forfeited. Sheetal, who was holding 200 shares, did not pay the first call. So on first call, I have calls in arrears of 500 shares of Kanti Bai and of Sheetal. Total 700 shares there will be calls in arrears to the extent of rupees 20. Simple, no? Now I don't have to do this adjustment again. I already did adjustment. Already allotment has taken place and we are now on the first call stage. Okay, only at the time of allotment, since adjustment of application and allotment was happening, that is why I had to do that Kanti Bai's extra money received. Now nothing, now that is over. Now at the time of the first call, 500 plus 200, 700 shares I did not receive 20 rupees. So 14,000, that means on balance only 49,300 I have received 20 rupees. 9,86,000 to share first call, 10 lakh rupees. Now company did not make only the final call. They were fed up. They did not make, they didn't receive, they didn't want only that extra 25 last. They have finished here only. Okay. And we had to pass it till here and forfeit the shares. Okay. His shares were forfeited means who? His means Kanti Bai's. Okay. Sheetal's, they have not told me anything. Kanti Bai's shares were forfeited. So forfeiture is taking place now. Application 25 rupees, allotment 30 plus 20 on premium, on first call 20. Final call was not made. I cannot write only now as nominal value. Now my nominal value will be 75. I'll have to cancel it at 75 because I have not made only the final call to make it 100. Okay. So total unpaid on 500 shares. Now of Kanti Bai shares when I am forfeiting, I will say on 500 shares, I will forfeit only equity share capital can be cancelled only to the extent called up, 75 rupees. Okay. Is there securities premium unpaid? Yes. Unpaid securities premium is there because he did not pay the allotment money. How much unpaid premium? 20 rupees. On how many shares? 500. Simple. 10,000. To share forfeiture account, paid amount on face value. How much did he pay me on my face value? Only 25 rupees he has paid me on my face value. 500 into 25, 12,500. And unpaid amount is calls in arrears. So total unpaid amount will be 30 on allotment plus 20 on first call plus this unpaid securities premium. So total unpaid is 50 plus 20, 70 rupees unpaid. So 70 into 500, 35,000. Being 500 shares of Kanti by forfeited for non-payment of allotment and first call money. Always make this working note. You will never go wrong when you are solving and putting it in the journal entry. Okay. So this is your question number 3. So now you all have also got one more additional understanding of the concept that when the call money, last call is not been made only by the company, share capital also cannot be cancelled by that amount. Okay, so share capital will be cancelled only till the extent of money called by the company, to that extent of that face value. Okay, so question number 3, important question. This is your module question, by the way. Okay. Now I am coming up with some past exam questions. They are little lengthy because they are of good 15. Okay. And in certain papers you will find again about some bonus they are asking, buyback they are asking. So your entire chapter, like your entire paper will be like of share capital only. So these sums are little big, but they are covering all the understanding of your issue of shares for cash, right? Come on. So far so good, clear everyone before I move for the past exam question. Okay. So we continue, right? Easy it was. Very easy. Now I am reading the past exam question. Slowly, we will solve with our own pace and time. Okay, then afterwards you all can solve it in your books after we finish the lecture. This was your December 24. Campa Limited issued 4 lakh shares of rupees 50 each at a premium of rupees 15 per share. Okay, Institute loves giving this big amounts and figures. So we are going to get used to of this, but it is an easy sum, but numbers are big. Okay, so do not miscalculate it. 4 lakh shares, 50 rupees each. Again, there is a premium of 15 rupees on that share. Application was received for 4,50,000 shares. The amount was payable on application 15 rupees. Okay, so now this 15 rupees premium, how they are collecting? They are saying on allotment they took 16 rupees. In that 6 rupees was premium. That means it is 10 plus 6. Then on first call they took 20 rupees. 5 rupees was premium. That means it is 15 plus 5. And on first call they took 14 rupees. Premium was 4 rupees. That means again it is 10 plus 4. This is on the face values. Okay. This is the face values. Yeah, 15 plus 15, 30 plus 10, 40 plus 10, 50. And this is the premium. 6 plus 4, 10 plus 5, 15. The premium amount. Half of your question is solved here. Okay. Alpha, who was allotted 6,000 shares, he did not pay the allotment and first call, and thereafter his shares got forfeited. Beta, who was allotted 4,000 shares, he did not pay the first call, and thereafter his shares were forfeited. Gamma, who was allotted 15,000 shares, did not pay the final call, and thereafter his shares were forfeited. Half of the shares of Alpha and Beta were reissued at 42 rupees. You are required to pass the journal entries for the forfeiture and reissue. Okay, so you do not have to do the story of application, allotment, first call, final call. You are just supposed to pass the journal entries for forfeiture and then for reissue. Forfeiture of alpha shares, beta shares, gamma shares, and reissue of alpha and beta only. That also only to the extent of 50%. Okay, so I will show you all the journal entries and I'll explain you all the how did I get that number. Okay, now in the books of Campa Limited journal entries, first I'll go one at a time. Alpha shares I will forfeit 6,000. What did Alpha not pay me? Did not pay me allotment and first call money. Okay, so not paid from here. This entire thing is not paid. So only paid is application money. So now when I am going to forfeit, they are saying that after the first call only the shares were forfeited. So only till here I will consider. I will say 15, 10 and 15. Okay, I am doing alpha right now. Okay, 10 plus 6 and 15 plus 5. Only till here, only first call they made to alpha. They did not make him the final call, and before that only they forfeited his shares. Okay, so it is going to be 40 rupees called up. Okay, and unpaid premium is going to be 11 rupees. So I will be able to cancel also to the extent of 40 rupees 6,000 shares of alpha. Okay, he was allotted 6,000 shares to the extent of 40 rupees only, because this is only the amount till which they waited, only till the first call. Final call they have not made only. Before that only they forfeited his shares. So cancellation will also happen only to the extent of 40. Is there securities premium unpaid in his case? Yes, unpaid. 6 and 5, 11 rupees. Unpaid securities premium. It will appear in the share forfeiture. Right? So security premium account debit 6,000 into 11 rupees. 6,000. Share forfeiture is what? Paid amount on face value. There is only one pay amount paid, 15 rupees. Into 6,000. That is only what he paid. 1,000 into 15 rupees application money. 90,000. Now there is calls in arrears. Calls in arrears for the allotment stage and for the call money, I have written it two separately so that you all understand. Okay, calls in arrears on allotment will be 10 plus 6, 16 rupees total unpaid. So 2 calls in arrears for allotment, 6,000 into 16. And calls in arrears for call in money, 15 plus 5, 20 rupees, 6,000 into 20. 96, and this will be 1,20,000. So the journal entry becomes very simple. It looks also very good. There are 2 stages calls in arrears, allotment stage and call money stage, first call. So both calls in arrears I have written separately. Being 6,000 shares of alpha forfeited for non-payment of what? Allotment money and call money. Easy. Alpha done. Now coming to beta. Beta was allotted 4,000 shares, but he did not pay me my first call money only, and immediately after that I forfeited his shares. So on 4,000 rupees, how much did, again I have waited only for the first call. That means the same example will follow, same working will follow, right? Raising it again. And for alpha, it's done now for beta. Okay, for beta, he paid me my application rupees 15. Okay, then allotment is 10 plus 6, and then final call it is 15 plus 5. Okay, so only 40 rupees on the shares. Immediately after the first call, they have forfeited. So again, at 40 only, I will be able to cancel it. This was paid, and first only the call money was unpaid. Correct? So when I'll forfeit, I will forfeit to the extent of 40 rupees. Okay, on the face value. So 4,000 shares into 40, 1,60,000. Securities premium, if it is unpaid. Yes, there is an unpaid security premium. See, on the first call, 5 rupees security premium is unpaid. So 4,000 shares into 5 rupees. Simple. 20,000. Share forfeiture is paid amount on face value. How much did he pay me on my face value? He has paid me 15 rupees plus he has paid me 10 rupees on my face value. Right? No, beta has paid me 10 plus 15 on my face value. So total he paid me 25 rupees on 4,000. That will become share forfeiture for the company. That is 1 lakh. And calls in arrears is only on his call stage. Total amount unpaid on the call stage. Total unpaid amount. Total unpaid amount. How much is total unpaid? 20 rupees. 15 plus 5. 4,000 into 20. It is 80,000. See, 2 lakhs. Sorry, 1,80,000. It's also 1,80,000. The debit and the credit has to match. Being 4,000 shares of beta forfeited for non-payment of first call money. Now next, gamma. Okay, gamma. For gamma, what they are saying, he was allotted 15,000 shares. He did not pay the final call and thereafter his shares were forfeited. So now for gamma, little bit has changed. Okay, why it has changed? Because for him, it is going to be like this. For gamma, he did not pay the final call. So like he finished paying 15 rupees here. Then he paid 10 plus 6. Then he paid 15 plus 5. And then 10 plus 4 he did not pay. All this else he paid. That means on the face value we called full 50 rupees. We waited for gamma. Right? So now equity share capital also will be cancelled at 50 rupees. See? 15,000 into 50. 7,50,000. Is there any unpaid securities premium? Answer is yes. Why? Because on the final call, 4 rupees is the premium and he has not paid me my final call. So 15,000 shares on which security premium to the extent of 4 rupees is unpaid. 60,000 will be securities premium account debit. Share forfeiture is paid amount on face value. How much did he pay me on face value? He has paid me 15 plus 10 plus 15. 30 plus 10. 40 rupees he has paid me on 15,000. 6 lakhs rupees. And calls in arrears is total unpaid amount. Total unpaid amount is the last call, final call, 14 rupees. On how many shares? 15,000 shares. 2,10,000. So when you will do 7,50,000 plus 60, it is going to be 8,10,000. 6 lakhs plus 2,10,000. 8 lakhs. Debit has to have the same amount of credit. Being 15,000 shares of gamma forfeited for non-payment of final call. Right? Now yet the story has not ended. They are saying alpha and beta shares were reissued. Oh, sorry. Half of alpha shares and beta shares were reissued. Half. So 10,000. Half will be 5,000 shares. So total from 10,000, only 5,000 shares were reissued for 42 rupees. Face value is 50. That means reissue is happening at a discount. Okay. Come on. So what happened? I got money now for reissue. When I did a reissue, how many shares I reissued? 5,000 shares at 42 rupees. So bank account debit 2,10,000. I have issued at discount no of 8 rupees. 8 rupees discount on 5,000 shares. So from where I will use that money? How I will have money? Company will use that money from share forfeiture. They have no share forfeiture. So they will use 40,000 from there. To equity share capital, make it fully paid up. 5,000 shares of rupees 50 each will be 2,50,000. Reissue of 5,000 shares of rupees 50 each at a discount of rupees 8 per share. You write your narration, it is understood that 8 rupees discount is removed from share forfeiture. Now, half shares of alpha, half shares of beta are already out of the picture. So, my share forfeiture also has to get closed, okay, to that extent of what is reissued. Whatever is balanced, till that it is okay. But whatever is reissued, to that extent, that share forfeiture now has to get closed. So, understand one thing. See, how I will get the capital? You can just not take the balance. Okay, whatever was the balance in the share forfeiture, how much we had made? 1 lakh. Then we had 6 lakhs. So 1 lakh, 6 lakhs. Then we have something like whatever. For alpha, we have share forfeiture of 90,000. Okay. Then for beta, we have share forfeiture of 1 lakh. And then for gamma, chalo, forget about gamma. Let's not consider it only because there was no reissue. But for alpha and beta, 90 plus 1 lakh, 1 lakh 96, and we used only 40,000. So balance we will just take it to capital reserve. No, it cannot happen like that. Balance to be taken to the capital reserve will be to the extent of the reissue took place. See, only 50% of the shares of alpha and gamma were reissued. Alpha and beta. Okay, so from that 6,000 of alpha, we reissued 3,000. From beta of 4,000, we issued 2,000. So yet we are left, company is still left with that 3 plus 2 balance. 5,000 shares with them. Later it can be reissued to somebody else. So at that time I will have to use share forfeiture if it was at discount. So I will do transfer to the capital reserve also to the extent of only this 5,000 shares which were reissued. So how will I do? 50% of alpha share 3,000, 50% of beta share 2,000, total 5,000 shares. Say for example, I would have forfeited only this 5,000. Then what amount would I have generated in my share forfeiture? If I'll find that out, it will become easy. So simple. See, for alpha, when we forfeited his 6,000 shares, in my share forfeiture 90,000 got generated. See? When we forfeited his 6,000 shares, in the share forfeiture we had 90,000. Right? So say if I would have forfeited only 3,000 shares, the extent what I have reissued, I would have generated only 45,000, half of it, 50%. Similarly for beta, when we had forfeited his 4,000 shares, in share forfeiture we got a balance of 1 lakh. Say if I would have forfeited only 2,000 shares, 50%, I would have the balance of 50,000. So to the extent of reissue, 50%. Okay, so 1 lakh into 50% is 50,000. So I have the right to use this 50%. 45 plus 50, 95. From that I have used 40,000. So transfer to capital reserve will be 55,000. Once again I am repeating. Transfer of share forfeiture to capital reserve. We do the balance. When all the shares forfeited, all shares forfeited are being reissued. Whatever balance remains in the share forfeiture, put it to capital reserve and close the share forfeiture account. In our case, share forfeiture has also happened, reissue also has taken place, but only to the extent of 50%. So share forfeiture happened forfeiture took place of 6,000 shares plus 4,000 of beta, 10,000. Okay, but reissue happened only of 50% of the shares, that is 5,000. Right? When we had done a forfeiture of this much shares, we had generated 1 lakh plus 90,000 in the share forfeiture. Yeah, 90,000 plus 1 lakh. So 1 lakh 90. So 50%, if I had reissued, 50% of 1,90,000 will be how much? 95,000. This much of right I have to use for my share forfeiture. From this 95,000, I used 40 at the time of reissue. So then there is a balance which is remaining of 35,000. Sorry, 45,000, no? 55,000. Of 55,000 which has to be transferred and closed to that extent. Okay, so balance 55,000 will be my one-time profit known and transferred to capital reserve account. Okay, so understand this is important. Okay, you can just not blindly close share forfeiture. If entire shares would have been reissued, I would have blindly closed. But since only 50% has been reissued, I will use only 50% of the share forfeiture, and from that whatever I have used for discount on issue, I will subtract and balance. I'll take it to the capital reserve account. I hope this is understood by everyone. Got it. All right. So we have finished one exam question. Okay, so you see this, it's a simple question with a little bit of twist here and there, but if you will know this, you will be able to definitely attempt it. Now coming to another question, June 24 attempt, they are saying ZX Limited decided to issue 60,000 shares of rupees 10 each. Premium is 2 rupees per share. The amount is paid as follows. Application they will take 2 rupees. On allotment they will take 5 rupees. How? Including premium. That means if premium is 2, on face value they are taking 3. First call 2 and final call 3. Applications were received for 1 lakh shares. Shares were allotted on pro rata basis. Walter, who was allotted 1,000 shares, okay, did not pay me the allotment money and the subsequent calls. Walter's shares were forfeited. Pass the necessary journal. Okay, so let's begin. In the books of ZX, number of shares 60,000, face value 10, premium 2, issue price 12. Application allotment, first call, final call I have received. Applications were received for 1 lakh shares. No refund was given. No rejection was done. That means pro rata allotment. 1 lakh is to 60,000. 10 is to 6, I can say. So if in case you have applied for 10 shares, you will be given 6 shares in case of allotment. Now Walter was allotted 1,000 shares. That means he must have applied for more, na? He was allotted 1,000, it is given. So application is to allotment 10 is to 6. He was allotted 1,000 shares. So cross multiply 1,000 into 10 divide by 6. Okay, 1,000 into 10 divide that by 6. You will get 1,666 point something. Ignore the decimals. You will take only the figures before the decimal, 1666, because fractional shares cannot be allotted. Okay, fractional shares cannot be allotted or applied. So 1,666 shares was applied by Walter, but he was allotted only 1,000 shares. That means on 666 shares he had paid some extra money at the time of application. How much money was to be collected at application? 2 rupees. That means 1,332 he has paid extra. Okay, I'll have to remember this because he's not paid me some money. So calls in arrears has to be reflected. So let us pass the journal entry. First application stage, receipt, bank account debit. I'll receive money on 1 lakh shares into 2 lakhs share application. Transfer. Share application account debit, full 2 lakhs. To equity share capital will be how much? Okay. To the extent of application, 60,000 into 2, 1,20,000. and 2 share allotment which has been adjusted. So balance entire 80,000 I had adjusted to the share allotment account. Correct, because I can do equity share capital only at nominal value. So 60,000 into 2 rupees is the amount to be collected on application. So balance I adjusted with the allotment stage, like how we had done in my question number 2 previous sum. Same thing, because there is no refund happening. Now coming to the share allotment stage. On allotment we are taking 3 plus 2. Face value 3, 2 rupees premium. Okay, so share allotment account debit transfer on 60,000, 5 rupees, 3 lakhs. Equity share capital at face value 3 rupees, 60,000 into 3, 1 lakh 80, and premium 60,000 into 2, 1 lakh 20,000. Then they are saying that this person, Mr. Walter, he did not pay me my allotment money and subsequent calls also. He did not pay me my first call as well as my final call. So basically he is not paying my allotment, my first call and final call. And he was allotted with 1000 shares. We know if he was allotted 1000, he had applied for 166 shares. Okay, 666 shares extra. We have already done his calculation. So now in the bank, at the time of the receipt, okay, at the time of the receipt, calls in arrears has to appear. Okay, so calls in arrears will be how much? Mr. Walter had to pay 1000 on 1000 shares allotted 5 rupees. That is 5,000 rupees. But he had paid me extra. No, we have already done the calculation of the working note. Right? He had paid me no extra. So this 1000 into 5, this 5,000 rupees is my calls in arrears for my allotment stage. Subtract this extra paid already by him. So actual calls in arrears will be 5,000 minus 1332. It will be 3,668. Okay, so the calls in arrears amount will be 3,668. In case of my share allotment, on share allotment, how many shares I am allotting? 60,000 shares. 5 rupees I am collecting on allotment. That means I have to take how much? 60,000 into 5, 3 lakhs. But 80,000 I already received, no, for that extra 40,000 into 20 extra money I had already received at the application stage. So now I am not going to receive that money again in my bank account. So here I am going to mention only 2,20,000 because I am adjusting my application and allotment. So in my bank from 2,20,000 I am not receiving 3,668. So balance will be my bank. Right? Allotment money of 80,000 was already received at the time of application. Extra, no? This 1 lakh, no? Should have been 60,000 into 2. We have done 1 lakh into 2. Right? So this extra 40,000 into 2, 80,000 rupees is adjusted at the allotment stage here. I did not refund anybody. So this now 80,000 has to reflect here, no? The adjustment to share allotment. And this calls in arrears is there calculated as per the working note. So balance money will only be received in the bank account. So receipt entry done for the calls allotment stage. Okay, share allotment stage. Now first call and final call. First call transfer. Share first call account debit. How many? 3,000 to 2 rupees I am taking on first call. Equity share capital. At the time of receipt, there will be calls in arrears on 1,000 shares of Mr. Walter. Now no adjustment is required. Adjustment was only between application and allotment. Over. Now on 1,000 shares, I have to pass the journal in. Mr. Walter, having 1,000 shares, did not pay me my 2 rupees. That means I received money only on balance 59,000 shares. Bank account debit 59 into 2, 1,18,000. 1,000 into 2 calls in arrears, 2,000 to share first call account. 1,20,000. Receipt entry done. Same thing now for the final call. Final call, I will first do the transfer. Share final call account debit, I am collecting 3 rupees on 60,000 shares. So share final call 1,80,000 to equity share capital 1,80,000 being share final call transferred to equity share capital. But at the time of the receipt, again, Mr. Walter did not pay me my 3 rupees on his 1,000 shares. So that will be my calls in arrears. That means money was received only on 59,000 shares. That is 1,77,000. Share final call. His shares were forfeited. No reissue or anything they're telling me. His shares were forfeited. Means how many shares were forfeited? 1,000 shares. Full 10 rupees we have called up. So we will take that full 10 rupees face value. So 10,000. Securities premium is unpaid. Yes, on allotment this 2 rupees was not paid by Mr. Walter C. He did not pay me my allotment money. So he did not pay me my premium. So 2 into 1,000. Then to share forfeiture account. Now before I take you all to the share forfeiture, okay, there is calls in arrears on allotment which we have mentioned. 3668. The calls in arrears at the time of allotment was 3,668 rupees. Then there was first call 2,000 rupees, 1,000 into 2 and then 3,000 rupees. Okay, so basically your share forfeiture will be your balancing figure. Okay, your share forfeiture will be your balancing figure. Okay, balancing figure. Why balancing figure? Because there are this information which they have given me, okay, about payment of money on share. Only the amount paid has to be transferred. No, only 2 rupees basically on 2,000 into 2 rupees. Amount paid on the share nominal value 1,000 into 2, that is 2,000 rupees. But if you see, he has also paid me 1332 extra. See this 1332. He's already paid me that. That will also be forfeited. Okay, it was adjusted and it will be forfeited. So here when I have adjusted in the calls in arrears in the allotment stage, means here it will be 2,000 plus 1332. That will be my share forfeiture count. 2 calls in arrears for allotment stage, which we have already passed in our journal entry here. Here it is 3668. Then calls in arrears for your first call and calls in arrears for your final call. Okay, so this is how you are going to present your journal entry. Here understood? Yeah. So this also question is done. June 24. Now the next question. This is a little lengthy question. It will take time also for us to solve. Okay, but since we have already done oversubscription, pro rata allotment, so now this is going to be a bit readable and understandable also. Okay. Now Technocrats Limited, they had invited applications for 1 lakh equity shares of rupees 30 each. The shares were issued at a 15 rupees per share, which is payable as follows. They are taking money on application and allotment together, 24 rupees. And that includes 9 rupees premium. And then they are taking money on first and final call together, balance, including whatever is the remaining premium. Applications were received for 1,50,000 shares. Again, this is a oversubscription matter. Applicants for 10,000 was rejected. Okay. So from that 1,50,000, 10,000 they rejected. And pro rata allotment was made to the remaining applicants. They made 2 categories. For category A, if you have applied for 80,000 shares, they were allotted 60,000 shares. And category B, Applicants of 60,000 shares were allotted 40,000. Yes, 60 plus 40 makes it 1 lakh. That is what the subscription was for, application was for. And 80 plus 60, 1 lakh 40,000. Yes, from 1 lakh 50, 10 was refunded. So 1 lakh 40, they are doing pro rata. Mr. X, who belonged to category A, he was allotted 300 shares. He failed to pay the call money. Mr. Y, who belonged to category B and applied for 300 shares, he also failed to pay the call money. These shares were forfeited and they were reissued at rupees 36 fully paid up. Assume that the excess amount received on application is to be adjusted towards the share application account first, share capital account first. You are required to pass the necessary journal entries. When excess application money is utilized for payment of share capital, what are the restrictions on using securities premium account as the provision of Companies Act 2013? Okay, we are supposed to pass the journal entry. Now, before passing the journal entries, I have written certain given. Number of shares to be given for subscription was 1 lakh. Face value of the share is 30 rupees and 15 rupees they are collecting on premium. Total issue price becomes 45 rupees. Application and allotment they are collecting together. First and final call also they are collecting together. Face value and premium. How did I get this? You see this allotment and application they are taking 24 rupees. 9 rupees is premium. Okay, so if they are taking 24 rupees and 9 rupees is premium, that means balance will be my face value amount 15 rupees. Right? Total amount to be collected. Issue price is 45. 24 is to be collected on application and allotment. So balance will be 21. Premium total is 15. 9 I collected in application and allotment stage. That means balance 6 is going to be collected on the first and final call. And balance also is going to be 15 rupees on face value. So 30 plus 15, then it will make to 45. So this is how I got my amount to be collected on the face value and as the premium. So that is how you get the total. Because they have directly given you 24 on application allotment, including 9 rupees premium. That means obviously, if 9 is premium and 24 is collected, means 15 rupees is on my face value. And balance 15, I will take it on my first and final call. Okay. Now, applications were received for 1,50,000 shares and 10,000 shares were rejected. That means 1,40,000 allotment is done on pro rata. In case of category A, they are saying if you have applied for 80,000, allotment is for 60. Mr. A is belonging to this category A. Mr. A is belonging to category A and he was allotted 300 shares. So how many shares he must have applied for? I can calculate. Application is to allotment 80,000 is to 60. He was allotted 300 shares. So how much he must have applied? I can cross multiply, no? It can be 80,000 into 300 divided by 60,000. So he has applied for 400 shares. Means on extra 100 shares, no, he has paid money. He should have paid application money. He has paid on 400 shares. 400 into 24, 9,600. He has paid. He should have paid only how much? To the extent of allotment, 300 into 24. So how much did he pay extra? 2,400. So when calls and errors will take place, I'll have to remember that this money also he has paid, no extra. Then category B, they are saying application if 60, allotment is 40. Okay. And there is Mr. Y who was belonging to this category. He had applied for 300. So if he has applied for 300, how much he will be allotted? It will be 300 into 40,000 divided by 60,000. 200 shares he must have got allotted. Mr. B paid application money on 300. 300 into 24, 7,200. He should have paid only on 200 shares because that was his allotment. 200 into 24, 4,800. So extra paid by him is also 2,400 rupees. Okay, because that 100 rupees extra he had applied, 100 shares extra he had applied, 100 shares extra applied, no, 24 rupees paid on 1,400. Same thing happened with Mr. A. Mr. X. This is Mr. X in category. Even he had applied for 100 rupees, 100 shares extra, 24 rupees, 2,000. Okay, so I'm calculating this and keeping. Now journal entries will become easy. Okay, so for journal entries, application stage and allotment stages together. So receipt and transfer I'll do here first. So bank account debit to share application and allotment account. But I received application for 1,50,000 shares into 25. So it will be 36 lakhs to share application and allotment. This was my receipt. Transfer. Slowly we will do it. Okay, share application and allotment 36. Whatever we have credited, I am debiting here. But equity share capital can be to the extent of only 1 lakh at the face value, 15 rupees. Even securities premium can be only 1 lakh. Whatever is the premium amount, 9 rupees given to us. So 1 lakh into 15, 15 lakhs, and securities premium 1 lakh into 9, 9 lakhs. I am refunding 10,000 applications. So that means 24 rupees which I collected on that at my application stage. For 10,000 shares, I am refunding it. I am rejecting them. So 10,000 into 24, 2,40,000 refund. So again, to bank account refund. And balance 40,000 extra which I am adjusting, 24 rupees which I collected on the extra 40,000 shares, that I will adjust with share first and final call account, 9,60,000. Right? Being application allotment money transferred to equity share capital and securities premium, balance adjusted with final call and also refunded. Okay, you do not need to write big stories in narration. Try to keep it short, okay, so that you don't waste your time. So we have finished with the transfer also. Now first and final call, I'll first do the transfer. So share first and final call account debit. Right? How much money I am receiving on share first and final call total? 21 rupees. 21 rupees I am receiving, no? On 1 lakh shares. So 1 lakh into 21. Here 1 lakh into 21. 21 lakhs. But on capital I am receiving only 15 rupees. And balance 6 rupees of the premium which was remaining. Right? There was 15 rupees premium. 9 I had already collected first. Balance 6 was remaining. So on 1 lakh 6 lakhs rupees will be my securities premium. Now the receipt. Now here I did not get the money of Mr. X and Mr. Y. Okay. X, who belonged to category A, he failed to pay the call money, and Y also failed to pay the call money. So now at the call stage, when I will receive the money, receipt entry, in my bank I am going to receive less amount. Okay. Why? Because there is calls in arrears. Now see the calls in arrears working note first. Share first and final call also I'll explain you all, because we have done adjustment. Share first and final call, we have debited by 21 lakhs. We have to credit also by 21 lakhs. But there is 9,60,000 on top. This we have adjusted. So I cannot credit it now by 21 lakhs. It has to be 21 lakhs minus 9,60,000. That will be 11,40,000. This is only what I can do, because this 9,60,000 was adjusted at the application stage. already received previously. Now again I'm not going to receive it. So calls in arrears for Mr. X and Mr. Y. Mr. X and Mr. Y. Mr. X 300 shares, allotted 300 shares. Okay. He had to pay me 21 rupees on call money. Final call, first and final call. So on 300, 21 rupees is 6,300 is my calls in arrears. But he had paid me no extra on my time of application on that 100 shares extra. So I'll remove that 2,400. I've already received extra. So actual net calls in arrears will be 3,900. Same thing for Mr. Y. Mr. Y was allotted 200 shares. That means he has to pay me 21 rupees on my first and final call for his 200 shares. So 200 into 21, 4,200 he had to pay me. He did not pay. Calls in arrears. But I have his 2,400 extra with me already. So I will subtract that 1,800 net amount. So calls in arrears will be 3,900 of X and 1,800 of Y. That will make 5,700 as calls in arrears. Please make nice working notes. Explain over there everything properly. So the balance will be how much? From 1,14,000 minus 5,700. 11,34,300. 11,40,000 I had to receive, but I did not get money to the extent of 5,700. So balance will come in my bank account. Okay. Now both these shares were forfeited and they were reissued as rupees 36 fully paid up. So both the shares X 300 and Y 200. X 300 shares and Y's 200 shares were forfeited. Total 500 shares, they were forfeited. Okay, how much amount will be my shares? 30 rupees, no face value. 15 plus 15 as it is 30 rupees. So 500 shares face value 30. Is there any securities premium unpaid? Yes. On the first and final call only the securities premium is unpaid. This one. This is unpaid. This premium is paid 9 rupees. But this is unpaid. So 6 rupees for 500 shares. 3,000. Total calls in arrears we just did 5,700. So share forfeiture will be your balancing figure in this case. Okay, it is going to be the balancing figure. Try not to get into adding up and subtraction and all that. Just take the balancing. Okay, because there is lot into this. Extra money paid, this, that. So there is lot into it. So the balance is your share forfeiture account. Now this money, these shares were forfeited. After that they were reissued for 36 rupees. 30 rupees is the face value. I reissued also at premium. So 500 into 36 received in my bank, 18,000. Share capital can be written only at nominal value. So balance 6 is the premium. Being forfeited shares reissued at a premium of rupees 6 per share. So my share forfeiture is not used only, unused totally. And all the shares have been already reissued now. So what will I do of this share forfeiture? Nothing. I'll have to transfer it to the capital reserve. Share forfeiture account debit to capital reserve 12,300. When you will pick up the model answers of the institute, even they have done it in the same manner. Balancing figure, they have taken it as the share forfeiture. Okay. And bank account is very simple. In the bank account, debit to balance. Okay. 1 minute. They have given me something. Nothing, no? Their application. Okay, you all do not have to make this bank. If you all want, you all can, but there is something which is not here. This you all can cancel. Or what is important is past necessary journal entries we did. We utilized the money payment for share capital. Last one is your, this is for 5 marks. Theory question. What are the restrictions for using of securities premium as per the provision of Company Act? What is the implication if you violate this provision? Okay. So premium received on issue of shares is a capital receipt. It has to be specifically transferred to a separate account called securities premium account. And according to the Companies Act, securities premium account can be only used for the following purpose. So this 5 purpose they have given. 1, you can use it towards issue of unissued shares to the members of the company to make it as a fully paid up bonus. So for fully paid up bonus, you can use securities premium. If you want to write off any preliminary expenses of the company, you can use it. Any expenses of a commission paid or discount allowed for issue of shares and debentures of the company, yes, you can use it. In providing for any premium you have to pay at the time of redemption, you can use it, or at the time of buyback, or for purchase of its own shares or other securities under section 60. And if anyone contravenes these provisions, okay, and utilizes the amount of securities premium except the modes, it will attract provisions related to reduction of share capital under section 66 of Companies Act 2013. Okay, so this was for technocrats. Now the question number 25 for June 2025, these 2 questions are for issue of shares for consideration other than cash. Other than cash, which I had explained. So now we will get to know how to pass the journal entries also. Let us read the sum. Divya Limited, they purchased machinery for 1,20,000 and building was worth 2 lakhs from Tara. So Tara is the vendor, Divya is the purchaser. For consideration other than cash, and purchase consideration they agreed is 3 lakhs rupees. So they are purchasing it things for 1,20,000 plus 2 lakhs. Means it is 3,20,000. But purchase consideration they have agreed that 3 lakhs will be satisfied by issuing 3,012% debentures of rupees 100 each. Now this is not for like issue of cash, they have issued debentures, but I want to explain it to you all here only, that one of the concept gets cleared and a past exam question is also getting solved. There will be only 2 journal entries always. One is for the purchase of whatever you are doing, whatever capital assets you are purchasing, and the second journal entry will be for the payment. Okay, now see this. Building account and plant and machinery. Building I took it in 2 lakhs, plant and machinery I took in 1,20,000. From whom? From Tara. I am taking things worth 3,20,000 and purchase consideration is decided only 3 lakhs. Means I got 20,000 profit na. I have to pay only 3 instead of 3,20,000. But that 20 is not a P&L profit. It is not your yearly profit. It is a capital profit. Therefore, capital reserve. Okay. And this 3 lakhs, I am not giving cash or bank. I am not paying from my bank account. What I am doing, Tara Limited account debit 3 lakhs to 12% debentures account 3 lakhs. 3,000 debentures of rupees 100 each makes it 3 lakhs. Same thing they could have asked in the form of equity share, 3,000 shares of rupees 100 each. Done, no? So same thing, consideration other than cash. Next one. A new process for development of active pharmaceutical ingredients, APIs, is developed by Professor Shastri. This process is subsequently patented. The APIs are used to manufacture medicines for cure of cardiac diseases. The patent is bought by a pharmaceutical company named Ratan and Company. The patent was bought for a consideration of rupees 45 lakhs. The deal involves payment of 15 lakhs to Professor Shastri and allotment of shares of rupees 10 each at a discount of rupees 2 per share for the balance consideration of 30 lakhs. Means they are saying that 45 lakhs we have to pay, but from there we will pay 15 in form of cash payment form and balance 30 we will give shares. Okay, the face value of the share is 10, but we are giving it in the form of discount, so issue price becomes 8 over here. Okay, so we have to pass the journal entries 5 marks. See this. We have bought what patent? From whom? Professor Shastri. So patent becomes my asset. Vendor is Professor Shastri. Patent account debit to Shastri. 45 lakhs. Now I have to pay this 45 lakhs to Mr. Shastri. How I am paying? Professor Shastri account debit 45. From bank 15 lakhs will go out. That is what they have told me. But the balance is share capital in form of shares. Now how will I come to know the discount? See, discount 2 rupees. But how will I take 2 rupees on how many shares? Do I know number of shares? Okay, even here I did not know number. I knew the number of debentures, 3,000 debentures of rupees 100 each. Here I don't know only my number of shares. I know face value, I know discount, I know my issue price. So now whenever there is a consideration to be paid, 30 lakhs we have to pay in the balance. 15 lakhs we paid, no? 15 lakhs has gone from my bank account. So balance 30 lakhs is remaining. I am paying that in the form of shares. Issue price of that share is 8 rupees, I know. So number of shares will always be consideration upon issue price. If ever you want to find number of shares given to a particular vendor, number of shares given or allotted to that particular vendor, always take the purchase consideration, divide that by the issue price directly. If it was at a premium also issue price, if it is a discount also issue price, just divide that by the issue price, you will get the number of shares. So 30 crores, sorry, it is 30 crores, divide that by 8, so you will get 37 lakh 50,000 shares of rupees 10 each. These many shares you will allot. So discount will be 37 lakh 50,000 into 2, 75 lakhs. So now I can write it here. Discount on issue of shares 75 lakhs and share capital will be how much? 37 crore 50 lakhs. How did I get that? 37 lakh 50,000 into the face value of the share is 10 rupees. Always we write share capital at the face value. This discount of 2 rupees is 37 lakhs shares, 2 rupees discount. Got it? So that is why this particular question is for 5 marks. Only for this 2 journal entries. For consideration other than cash, always remember, in order to find out, if they have given number of shares, there is no problem only. But if they have not given the number of shares, that consideration you have to take and divide it by the issue price to get the number of shares. Because share capital cannot be written at any other amount but only at the face value. So what is the face value? 10. But how many shares? 37 lakh 50,000. That will become 37 crores 50 lakhs as an amount of the share capital. I think so. Yes. No. It is 45 CR. 45 crores. 15 crores we paid it in cash. 37, basically 30 crores we had to supposed to pay it elsewhere. Okay. 37 crores. 30 lakhs. 37 crores 50 lakhs minus 75 lakhs will give you 30 crores. Okay. So this is it with your past exam questions also for issue of shares. Alright. So what I will suggest for you all is that once you all have finished these type of sums, okay, you all just need to know these maximum journal entries as per the example which I taught you all. Okay, once you all are done with this particular part, you all can do only the past exam questions also know of the other types, that is your other parts of this chapter, accounting for share capital. It will be more than enough and they are very easy. Redemption, buyback, bonus, all those are really simple. You all have, what you all have to understand is the basic, the main crux, and these are important sums and they are for carrying good weightage. Okay, 5 plus 3 over here only 8 marks is done. Here and there little bit theory, they ask 10 marks is done again from this particular part of this chapter. Okay, so we are done with the issue of shares, accounting for share capital. Thank you everyone. I hope you all have been able to kind of completely have a comprehensive view of this particular. Okay, now let us solve the December 2025 attempt questions. It was maximum about issue of shares, the entire paper, if in case you all have seen it. Okay, the maximum marks out of 60, I will say around 30 marks was all for issue of shares, all the subtopics which are included in issue of shares. So let us solve all the sums for this particular attempt. It is important. Let us read the question. Okay, now Vikas Steel and Company is a steel manufacturing company in existence for past 3 decades. The executive chairman and the MD of the company is Mr. Mohan. He is a mechanical engineer who has constructed and operationalized the steel plant. The company has achieved significant success due to growing economy. Ms. Disha, daughter of Mohan, is the executive director and oversees the operations of the company. Based on the study conducted by the operations team, it was observed that there is a need to modernize the company's operations and estimated budget is around rupees 75 lakhs. Now, the merchant bankers have advised the company to raise a capital of equity shares through IPO. So the issue is of 50,000 equity shares of 100 each. Issue price is 120. The payment terms are as follows. Application 25, allotment is rupees 20, but allotment is rupees 50, but 20 rupees is the premium. Here we can see that the face value of the share is 100 rupees. Issue price, they are saying it is 120. Therefore, the issue is at a premium of 20 rupees. So on allotment stage, I am collecting 20 rupees. First call 20 and then the final call is of 25 rupees. Now, applications were received for 75,000 shares and shares were allotted on pro rata basis. Kamal, who was allotted 500 shares, he failed to pay the allotment money as well as the first call. Consequently, his shares were forfeited. Amar, who was holding 200 shares, did not pay the first call and the final call was not made only. The entire issue was underwritten by 4 underwriters, which is as follows. PQRS 35%, they have given their gross liability ratio 35, 25, 20, 20, making it 100% underwritten. The underwriting commission is payable at the rate of 1.5%. What are they saying? Pass necessary journal entries for the issue and forfeiture of the equity shares along with the necessary working notes. Calculate underwriting commission payable and then pass journal entry for the underwriting commission. Very easy, very simple sum. It is all together for 15 marks. Okay, so now let us solve this question. I will keep this page open over here to understand whatever is given so that we are able to solve it easily. Okay, now of course in the books of Vikas and Steel Company journal entries, see to it that you are writing all these small little details. Even the narration, you can write just one liner of narration. I have been repeating this, but it is important for you to write narration. If there is something you want the examiner to see as your working note, write down over there, okay, that refer working note number so and so. Okay, and make your paper simple for the examiner also to understand. Okay, now the first journal entry, we always start with application stage, receipt, transfer. So that is how we are going to do in this sum. There is nothing new in this sum at all. Okay, first it will be bank account debit to share application. Why? Because application money was received. However, we have to remember here it is 75,000 application was received and allotment happened pro rata. There is no refund happening here. Okay, so for 75,000 shares money is received at rupees how much? 25 per share. So here it will be 18,75,000. This share application has to be transferred to share capital. Okay, so share application 18,75,000. But how much can I transfer to share capital? Only on 50,000 shares. So on 50,000 into 25, which will be 12,50,000. Balance has to be adjusted on the allotment stage. Okay, this is like as if money is received for allotment also. 6,25,000 on the balance 25,000 shares. On the balance 25,000 shares. Okay. $6,25,000. Now coming to the allotment stage. Allotment we will also first pass transfer and then the receipt. So when I do the transfer, I will say share allotment to share capital to security premium because the issue is at premium. Face value is at 100 rupees and premium is at 20 rupees. Okay, so share allotment. Okay, but here how much am I collecting? I am collecting total 50 rupees. Okay, so share allotment I am collecting on 50,000. I am collecting 50 rupees. From that, for share capital it is at 30 rupees and for security premium it is 20 rupees on 50,000 shares. So share allotment, okay, 25 lakhs. For share capital it is 30 rupees on the 50,000 shares and 20 rupees on 50,000 shares, 15 lakhs and 10 lakhs. Allotment money due including premium. Now what happened is we have received money on allotment. Now whenever we will receive money on allotment on pro rata, we have to remember one thing. We have already received this 6,25,000 also. Okay, so there has to be an adjustment which will take place over here. Now share allotment. Okay, it is 25 lakhs over here as a debit. Okay, now there was a credit of share allotment of 6,25,000. So when there is 25 lakhs as a debit and we have already credited as 6,25,000, so balance only 18,75,000 we will credit to close the share allotment, because allotment has happened on pro rata basis. This we have done even in the previous sums. Okay, so allotment we have already credited by 6,25,000. We adjusted the extra money of application with share allotment. So now also share allotment, though it is debited by 25 lakhs, I cannot debit again over here by 25 lakhs. There is a credit of 6,25,000. I will adjust that and the balance will be credited 18,75,000 only. Now there is an additional information. They are saying Kamal, who was allotted 500 shares, he failed to pay the allotment money. He also failed to pay the first call. First call stage I have not yet gone on. I am on the allotment stage. I need to understand what will be his calls in arrears. Okay, so see the working note. Applied to allotment, there is a pro rata. 75,000 shares were applied, 50 were allotted. So 3:2 is the ratio. Now Kamal, who was allotted 500, that means he must have applied how much? 3:2 is the ratio. He was allotted 500, so his application will be cross multiply. 500 into 3 divided by 2, 750 shares. That means excess money he has paid on how many shares? 250 shares. 25 rupees on application stage. Ideally, he has paid extra money. No, he was allotted only 500. He was applying for 750 shares. So for 250, he paid extra money, which is 6250. At the time of allotment, he did not make any payment. So on that 500 shares, he did not pay 50 rupees. That means total 25,000 is the calls in arrears. But I'll have to adjust it with the excess money which he's already paid. 6250, because I'm adjusted application with allotment. So now also I'll have to adjust. So 18,750 will be the calls in arrears. So here in the journal entry it will be 18,750 and balance money will be received. Okay, so from 25 lakhs which should be received on allotment, 6,25,000 was already received. That is why I am writing 18,75,000. From that 18,750 will not be given to us because it is calls in arrears. So it is 18,56,250. There is one zero missing. Please add the zero. I'm sorry. Okay, 18,56,250 rupees. So done with the allotment stage. Now coming to the first call. First call, how much money are we getting on the first call? 20 rupees per share. Okay, so on 50,000, 20 rupees, that is 10 lakhs. Share first call, this will be the transfer entry. To share capital on 50,000, shares 20 rupees, call money due. Now the receipt took place, receipt entry. In the receipt entry, there will be two things. See, Kamal did not pay allotment as well as he did not pay first call. There is Amar who was holding 200 shares, he also did not pay my first call. So total calls in arrears will now be on 700 shares because it will be for Kamal also 500 and it will be for Amar also 200 shares. So total 700 shares will have calls in arrears of 20 rupees first call. 14,000. 10 lakhs I should have received it, but now I will receive only 9,86,000. Okay, first call money received only on 49,300 shares. Now coming to the forfeiture. Why forfeiture directly? Final call is not made. That means now immediately forfeiture will happen. My value, face value, nominal value will be considered as 75 because final call of 25 is not made. Not made. So forfeiture will also happen with the call amount. So 75,000 share capital on 500 shares. Whose shares are being forfeited? Only Kamal's shares are getting forfeited. They have not told anything about Amar. Okay. Kamal shares are getting forfeited. 500 shares at 75 rupees nominal value. He did not pay the securities premium, therefore it will come and reflect in the share forfeiture. So on 500 shares, he did not pay security premium of 20 rupees. So 10,000. Two calls in arrears to share forfeiture account. Now understand what will be his calls in arrears. See, calls in arrears in case of allotment stage 18,750 we had already calculated. And in the first call on 520 rupees, 10,000. Therefore, it will be 28,750. Total calls in arrears, right? First calls in arrears were 18,750 at the time of allotment. At the time of first call, 500 into 20, which is 10,000. So, total calls in arrears is 28,750. Share forfeiture, I have always told you, it is paid amount on face value. Correct? So, now how much did he pay? See, share forfeiture is amount paid. He had paid on 500 shares actually. He paid 12,500. But he has also paid excess money, no? If you see 500 shares we are forfeiting. So on 500 he has paid 25 rupees. But he also paid excess money, no? That 250 on 25. Right? 6250. So his share forfeiture will be 18,750. Okay, so don't make a mistake over here. Understand properly and write it. Okay, calls in arrears and share forfeiture. So this is how the entire sum, it is completed with 7 journal entries, very easy. Only this is the most important journal entry and it is not at all difficult. Calls in arrears we have already done for allotment. We already did it for the first call. We will add both, write it here. Obviously the balancing figure will be your share forfeiture, but I am explaining you how share forfeiture also came. Share forfeiture is amount paid on face value, you all agree. How much did he pay on the face value? On 500 shares, he already paid 25, plus he paid some excess money on that other 250 shares also which he had applied, which we have kept it with us. Right? So that is 18,750 rupees. Going to part B of this sum. So we have completed part A. They are saying calculate the commission which will be payable to each underwriter. Okay. Now number of shares offered 50,000. What is the issue price? 120. Commission is always paid on issue price. Okay. On issue price. So what will be the issue size? 50,000 into 120, 60 lakh rupees, on which 1.5% commission will be paid, which is 90,000. So now this 90,000, I am not paying only one underwriter. There are PQRS, 4 underwriters. They have their gross liability ratio. This is their gross liability ratio. So 90,000, okay, into 35%, 90,000 into 25%. 90,000 into 20% and 90,000 into 20%. Each of the underwriter will get their respective amount based on their liability. Okay, so underwriting commission, account debit, very easy. Journal entry is nothing. Here the commission calculation is important. Journal entry is very simple. Commission on shares is paid as a percentage of the issue price. Okay, so 1.5% on the issue price. How? We already know the issue price. We know the number of shares offered. So our issue size is rupees 60 lakhs. On 60 lakhs, 1.5% comes 90,000. It has to be divided between the 4 underwriters as per their gross liability ratio. So now the journal entry will be underwriting commission account debit to underwriter P with their respective amounts, to underwriter Q, underwriter R, underwriter S. Okay, please excuse me for writing this as a shortcut, but you are supposed to write it properly. Okay, so May 10th. Okay, it's 10th May. All right. If the date is not given, do not write any of the dates. Okay, please. Only if the date is given, then only we will go ahead and write it. Otherwise, please avoid writing dates. You all can write serial number 1, 2, 3, 4. Okay. So if the dates are not given, do not write it. Now this was the entry for due, commission payable. Now I will make the payment. So underwriter P, Q, R and S to bank. 2 simple journal entries for underwriting commission. So first 15 marks of this paper is so easy. Simple, done. Okay, so A, B and C. Next. Okay, let's go to the next question. Employee stock option plan. The human resource team of Rama Limited has implemented an employee stock option plan for eligible employees 1 year after the listing of the company's share on stock exchange. On 1st of April 2022, your dates are given, so we will keep in mind. Options were granted for 20,000 equity shares as rupees 40 each when the market price was 130. The employees exercised option for 19,000 shares only between 15th of March 23 and 21st of March 23. Okay, so only in 1 year everything is getting over. So 1st April they granted the option, and in that same financial year, at the end of that financial year, that is March 2023, the options were exercised and the remaining options lapsed. Company closes its book on 31st of March. Show journal entries 5 marks. Okay. So here directly we will solve the question in the books of Rama Limited. Okay, tell me one thing. Face value, I will assume it to be 10 rupees. Nothing is given to me. Market price is given 130. Okay, exercise price 40, this is also given to us, all this is given. So my option discount, when in the market my price is running at 130 and I'm asking my employees only to pay 40 rupees, that means 90 rupees is what I'm giving them at a discount of 90 rupees this share. And securities premium will be how much? 130 is the market price, 10 rupees is the face value. That means premium amount will now be 120, right? So, okay. So, in the books of Rama Limited, I am going to put the journal entry for this exercise. Okay, 15th of March to 31st of March, what happened is I received money for 19,000 shares which were exercised by my employees. So, bank account debit 19,000 into 40. To equity share capital is how much? At face value, at nominal value 10 rupees, 19,000 into 10, 1,90,000. Securities premium I just explained you, it will be 130 minus 10, which will be 120 rupees, so 22,80,000. What will be the employee compensation expense for the company, the discount which they are giving? Okay. So 130 minus 40, 90 rupees is the discount for 19,000 shares. So 17,10,000 is the expense which the company will bear towards the employee stock option. Okay, so being allotment to employees of 19,000 equity shares. Okay, for rupees 10 each, premium 120 per share in exercise of the stock options by employees. Right, and then the balance options has already lapsed. So fine, we will do the exercise of 19,000, and this expense of employee compensation has to go in a profit and loss. We'll have to transfer this expense. It is an expense debited to P&L. So profit and loss account debit at the end of the year 31st March to employee compensation expense account. Since everything was just of the 1 year period, we have just passed this simple 2 journal entries which is for 5 marks, and this is exactly what even the model answers have been given from the institute. Okay, so if you all want, like, there are detailed lecture about, the employee stock option as a part of your issue of shares chapter. So obviously you all can go ahead and take up the dream batch. All the lectures are there in that. There are different ways of solving employee stock option when the vesting period is given. Okay, where vesting period is 2 years, 3 years. Here the vesting period, like vesting and exercise was same 1 year, you had to complete everything. So then there is no writing off of the employee compensation expense, etc. So it was a very simple sum where exercising of the option had to be given as a journal entry, and then passing, transferring that employee compensation to P&L. Alright. Now next question for debentures. Okay, let us see. ABC and Company issued 5,000 debentures of rupees 1,000 each at a premium of 10%. Okay, so the amount was payable as follows. Similar like issue of shares, they are saying on application of debentures collect 200, allotment including premium take 500, and balance on first and final call. Applications were received for 7,000 debentures. Applications for 4,500 debentures were accepted in full, and applicants for 1,000 debentures were allotted 500 debentures. The remaining applications were rejected. All money was duly received. Past journal entries. So instead of share, I will write debentures over here. 1,000 is the face value of the debenture given at 10% premium. So issue price is now 110 rupees, 1,100 rupees. Okay, and how it is being collected? 200, 500. Now this 500 is including premium, that means it will be 400 plus 100. Here it is 200. Okay, so basically 600, and this will be, balance will be 400, which will be selected on first and final call. Okay, now in my bank, first we will do the receipt. Same thing like issue of shares. That is why I have taken up this sum of debentures also. Bank account debit to debenture application. We have received application for 7,000 debentures. Application money is 200 rupees per debenture. So here it will be 14 lakhs. Now this debenture application to debenture, I can take up debenture only of how many number of debentures can I take? 5,000, correct? So on 5,000, application money is 200 rupees. Okay, there is a refund also which has happened. Okay, refund. Applicants for 1000 debentures were allotted 500 debentures. So there is this bit of adjustment which has taken place, but there is a refund also which has happened. All the balance was kind of refunded. So on 200, this 200 rupees on another. So here 7,000 debentures were there. Okay, from that 4,500 debentures were accepted in full. Okay, so now the balance is 2,500. Okay, now from there, applicants for 1,000 debentures were allotted 500 debentures. Okay, so here I am trying to adjust more 1,000. Okay, so balance is 1,500. Okay, so the balance was kind of refunded. I have adjusted 1,000 more and 1,500 was kind of refunded. Okay, so the refund amount will be 1,500 into 200 rupees. I'm going to not keep this money with me. I'm going to refund it from my bank account. Okay, understand again one more important thing. See, for me the number of seats available is only 5,000 because this was my allotment size, 5,000 debentures. But I received application forms for 7,000. Now I am not ready to adjust the exact extra 2,000. Okay, what are we adjusting is, we are saying 4,500 applicants we will accept in full. Now there is remaining 2,500. From there, another 1,000 debenture holders we will do pro rata. We will allot them 500 only. Okay, so that means I am trying to adjust that 1,000 also. So the balance I am not ready to adjust. I will have to refund it. So refund amount is 200 rupees of application. 1,500 into 200 will be 3 lakhs rupees. And in case of allotment, I am still adjusting. Okay, so on allotment I will adjust. I will get 1 lakh rupees. Okay, I am adjusting 500 debentures at rupees 200. Alright, so this is how the journal entry will be passed. Now in the case of allotment stage, when the transfer will take place, allotment will happen of 5,000 debentures at rupees 50, on which the debenture amount is how much? 400 rupees. And securities premium is only 100 rupees. Okay, so 20 lakhs and 5 lakhs, total 25 lakhs. When the receipt will take place, okay, for this allotment stage, okay, debenture allotment account, when the receipt will take place, already 1 lakh has been adjusted at the time of application. So I will not receive full 25 lakhs. I will receive 24 lakhs in the bank account. Okay, only 24 lakhs. Receipt will be only of the balance amount because 1 lakh has already got adjusted at the time of the application. Okay, then will be your call transfer entry. Debenture call is how much? Balance 400 rupees will be on the call, so it will be 5,000 into 400, 20 lakhs, and bank account debit to debenture call money 20 lakhs. This will be your receipt entry. Okay, so amount due on call received. So this is it. Yes, it was important for you all to understand that this debenture sums was a little tricky when it comes to adjustment of application to allotment. Okay, and then there was also a refund. So you all do not have to worry, just understand that number of applications received. They are saying they are accepting 4,500 totally, in total. So now 2,500, what will they do with that? They are saying, okay, another 1,000 we are ready to adjust. For them, we will give only though 500 debentures, but we will adjust. Okay, if somebody has applied for 10 debentures, we'll give them 5. Like that is what they're trying to say. So now balance 1,500, what will they do? They will totally refund them. And this 1,000 which they have kind of adjusted, that adjustment is happening at application stage. So I will obviously not take this money again at the time of allotment. Now that is what we always do in pro rata. When application money is adjusted towards allotment, then here in case of allotment, instead of writing 25 lakhs again here, I'll write only 24 because 1 lakh has already been adjusted. On for 500 debentures, 200 rupees. Okay. So now this was your debenture sum. Next bonus issue. Kapoor Limited has subscribed capital of 7,50,000 rupees consisting 75,000 equity shares of 10 each. The called up capital is only 7.5 per share. Okay, that means 2.5 is not called. A bonus of rupees 1,87,500 was declared out of general reserve to be applied in making the existing shares fully paid up. Okay, so 2.5 into 75,000. Yes, 2.5 into 75,000. If I will remove this from general reserve, it will become this partly paid up bonus. Like I am telling my shareholders, don't pay this extra 2.5, this remaining 2.5. We will give you a partly paid up bonus. Okay, so cool. In the books of Kapoor Limited, where am I giving this partly paid up bonus? I am capitalizing the reserves. Which reserve I am capitalizing? General reserve. So general reserve account to bonus to equity shareholders. How much amount? 1,87,500. Why did I give them this bonus? I am giving them as a share final call bonus. Okay, so bonus to shareholders to share final call. Why is this bonus given? We are completing the final call on the share. Okay, and share final call to equity share capital 2.5 for 75,000 equity shares. Transfer to equity share capital. So basically, I have done a partly paid up bonus for my shareholders for 2.5 rupees on 75,000 shares. Okay, so that is why the journal entry is like this. I am using general reserve for the purpose of share final call. Right? So general reserve to bonus to shareholders. Why am I giving this bonus? Towards share final call. Share final call to equity share capital. Okay. Now the next question. Below is given the balance sheet of Bharat Chemical Limited, 2,14% preference shares of rupees 100 fully called up, 2 crores, calls in arrears at rupees 20 per share, 4 lakhs. So now it is 196 lakhs. 10 lakh equity share of rupees 10 each, rupees 8 is called up, therefore 80 rupees. Calls in arrears 20,000, calls in advance 10,000. So now it has become 79,90,000. Securities premium is 5 lakh 10, general reserve 150 lakhs, 10,000 15% debentures of 1,000 each fully paid up, 100 lakhs, current liabilities and provisions 10 lakhs. Okay, 541 lakhs is the total. In assets, we have 130 lakhs of fixed assets, investment 28, current assets is 215 lakhs and cash and bank balance is 168 lakhs. On 1st of April 2025, the Board of Directors decided that the fully paid up preference shares are to be redeemed at a premium of 4% on 1st of May 2025. For this purpose, 6 lakhs equity shares of rupees 10 each are issued at a premium of 5% considering the above information, pass required journal entries in the books of the company. Now, preference share capital to be redeemed, this is how we do our working note. We have to redeem, we can redeem only the fully paid up preference shares. Now, out of this 2 lakhs, okay, out of this 2 lakhs, there is a call in arrears, okay, at rupees 20 per share. So, basically, on 4 lakhs, divide by 20. 20,000 shares. Okay, they are in call in arrears. So, from this 2 lakhs, I will remove 20,000. Only 1,80,000 shares I can redeem. Face value is 100 rupees. So 180 lakhs I will need. Redemption is at a premium of 4%. So premium on redemption is 7,20,000. For that I am doing a fresh issue of 6 lakh shares, face value 10. Okay, so 180 lakhs is the amount at nominal value of the preference share to be redeemed, nominal value of the equity shares as a fresh issue. So DP transferred to CRR will be the balance amount on the nominal value. 180 is the nominal value to be redeemed. 60 is the nominal value of the fresh issue. So balance I will take it from my DP divisible profits, right? Now premium on redemption, I will use some which I will get from fresh issue and some which is there in the balance sheet. From fresh issue I will get 3 lakhs. No, on 60 lakhs 5% premium they are saying. Fresh issue they are saying it is at a premium of 5%. Okay, so on 60 lakhs 5% is 3 lakhs. Balance sheet already has 5,10,000. Here 5,10,000 securities premium. So I am having 8,10,000. I will use 7,20,000. Then also there will be 90,000 balance in the balance sheet will remain. So now the journal entries are very easy. First I will do issue 1st May 2025, date is given. Okay, so just May 2025 you can write and then just start writing the serial numbers. So bank account debit for the fresh issue, bank account to equity share capital to security premium. Okay, so equity share capital is of face value 10 at rupees 10. Okay, and here it is going to be that 5% premium. So at rupees 0.5. For how many shares? For 6 lakh shares. For 6 lakh shares. So 6 lakhs, okay, into 0.5 is going to be 3 lakhs. Please write the amount over here. Okay. Now I have to write off the premium on redemption. So from where will I write it off? Securities premium account debit to premium on redemption 7,20,000. General reserve I am using. I have lot of money in the general reserve here. 150 lakhs are there in general reserve. I am using 120 lakhs DP transferred to capital redemption reserve. Now I am going to redeem my preference share capital. 14% preference share capital 180 lakhs. Premium on redemption 7,20,000 to preference shareholders 187,20,000. 187,20,000 preference shareholders to bank, payment made, amount paid to the preference shareholders. Okay, so easy, very easy. In fact, question number 3, how much marks? 5 marks, done. So we finished 15, then we did 5, 20, then 6 is 26, 4 is 30, 35, and now next. We are still going on. Okay, issue of shares. Following is the balance sheet of XYZ and company as on 31st of March 2024. We have equity share capital, fully paid up shares of rupees 10 each, 4,800 lakhs. Security premium 700 lakhs, general reserve 1860 lakhs. We have profit and loss account of 680 lakhs, debentures 3000 lakhs, sundry creditors 1500 lakhs, sundry provisions 780 lakhs. Machinery 7200 lakhs, furniture 904 lakhs, investments 296 lakhs, stock 2400, 1040, and cash and bank balance 1480. On 1st of April 24, the company announced buyback of 25% of its equity share capital at rupees 13 per share. For this purpose, investments were sold for 300 lakh rupees. 4 lakh preference shares of rupees 100 each were issued at par. Entire amount was paid on application. The buyback was completed in due time. Show the journal entries. Okay. So in the books of XYZ company, amount required for buyback. How many shares do I have? 4,800 divided by 10. Okay, 4,800 divided by 10. 480 shares. 480 shares. From that, I am buying back only 25%. So I'll buy back 120 shares. 120 shares, face value 10, 1200 lakhs. Premium on buyback is 3 rupees because the premium amount, the buyback amount is 13 rupees. So 3 rupees premium, so 360 lakhs is premium. Preference shares, 4 lakh preference shares of 100 each, that means 400 lakhs. Now I will compare the nominal value of the buyback with the nominal value of the fresh issue. 1200, 400. Okay, so the balance of 800 lakhs will come from the DP transferred to CRR. We have a lot of money in our divisible profits. First journal entry on 1st April 24, bank account debit to investment to PNL. Why? Because this is what they have given me. Investments were sold for 300 lakhs. So I'll receive money, bank account I'll receive 300. Value of investment as per balance sheet is 296. Therefore, profit will be 4 lakhs. Then I have done a fresh issue of preference share capital, bank account debit 400 lakhs at par. 400 lakhs. Amount in lakhs I have written. This is what even you will have to write if you are writing directly like this. Then buyback due entry, equity share capital, I am going to pay them 1200 plus 3 rupees premium on buyback to equity shareholders. Equity shareholders 1560 to bank. And balance I will take it from general reserve. I have lot of money in my general reserve, 800 lakhs. General reserve to CRR. Okay, so 5 marks, 40 marks is already with us. Okay, now the last question, I think so. A Limited acquired assets worth of 175 lakhs from V. Consideration was paid as follows. By check they paid 55 lakhs and remaining they paid shares of rupees 10 each at a premium of 20%. Okay, so 10 at 20%, that means 12 rupees. 2 rupees is the premium. What will be the number of shares to be issued to V Limited? Pass the necessary journal entries. Okay. So, in the books of A Limited, we are purchasing goods from V. Okay. So, in the books of A Limited, we are purchasing certain assets from V Limited. So, sundry assets to V 175 lakhs. What happened is then we paid 55 lakhs in form of check. So we limited to bank 55 lakhs. Now there is a balance remaining from 175 minus 55. 120 is yet remaining. So for that 120, I am giving him equity share capital at 10 rupees, but issue price is like 12 rupees. So 120 divided by 12 issue price. Consideration divided by issue price will give me number of shares. So 120 is the consideration, divide by issue price is 12. So the number of shares is going to be 10 lakh shares. 10 lakhs. Okay, so 10 lakh shares into rupees 10, so 100 lakhs, and 10 lakh shares into rupees 2 as a premium, 20 lakhs, that will make 120. So number of shares also is calculated. You have to calculate this number of shares because they have asked what will be the number of shares issued to V Limited. So number of shares will be equal to consideration, okay, upon the issue price, which is nothing but 120 lakhs, okay, divide by issue price being 12. So it is going to be 10 lakhs shares. Okay, so even another 5 marks, 45 marks out of 60 is already covered and complete. Even out of this 45, say you get 40, okay, and balance more 10 marks, 50 marks is only in your corporate accounting. You can get exemption in this paper because there is FM also, no, 40 marks. From there I am expecting you all can get 20, 25. So exemption marks in this particular paper. It was so simple. Okay, so with this we complete issue of shares with all the past exam questions. Thank you everyone. See you all. Bye. Hello everyone. So to start with consolidation of accounts, one more important marathon for your corporate accounting paper, which carries weightage of good 12 marks. Okay, at least 7 to 12 marks in each paper. Consolidation is a must question asked. And trust me, from exam point of view, this particular chapter is very, very simple. You have to just understand the treatment of each subsidiary item which we do, which I am going to explain you all from the basics. So even if you all have not studied this chapter, you all don't know anything what has to be done, after my lecture, after my marathon, you will be able to solve the past exam questions by yourself. Okay. So I am Fatima Kagalwala and I have been teaching these practical papers as my favorite papers over past 8 years now, and I am striving to make you all study in a way that you all get exemptions in this paper, score well, and that is what is my motive over here. Hence I am sharing you all my notes and the way I have written things. So for you all it is like a guidance as to how you are supposed to write the papers, how things are expected by the institute, how the marks are being given. Okay, so talking about consolidation of accounts. Okay, so beginning with that, consolidation basically, okay, it is nothing but it is like adding the two balance sheets. Okay, consolidating the two P&Ls and consolidating the two balance sheet and giving a consolidated figure of two companies. Okay, so wherever there are two companies involved and there is a relationship between that company of holding and subsidiary, it is only then when consolidation of accounts takes place. Okay, there is a relationship of holding and subsidiary. Now, as per your Companies Act, what is a holding company? It is a company which has a control over the board of directors of other company, or it has 50%, more than 50% stake, means I'm at least 51. More than 50% means what? At least 51% stake in another company. So then it will become a holding company. Okay. So that company which has more than 50% stake, it can be 51 until it can be a wholly owned subsidiary up to 100. All the shares of a given company can be only one shareholder of that particular shares, and hence it can be a wholly owned subsidiary also. So if there is more than 50% of shares, it will be a holding company and the other one will be the subsidiary company. Okay. Now in consolidation, you keep yourself in place of holding company. Okay. Always think from the point of view of holding company. Think your boss, you are kind of taking over a small company. So there is one small company under you. Okay, so we are holding company. So everything which we will read and every adjustment which we will have to do, we will do considering ourselves as holding. If you will do this, I always give you all this kind of a hint whenever I'm taking my class, that from which point of view you are supposed to think. Why? Because your journal entries, your adjustments, what accounting treatment you are going to carry, it makes a whole lot of difference when you know what you are, because you have to think that way. You will be passing your journal entries with that point of view, what is coming in, what is going out. Okay, so that is why I'm saying keep yourself as a holding company. Now, why so much about consolidation, why institute gives us so much of importance with this chapter, is that they want us to understand that whenever this relationship of holding and subsidiary comes up, it does not come free of cost, right? If I am today trying to acquire another company, I will have to pay that company. So say there is a holding company and they want to buy the subsidiary company. So before buying, I will say that, okay, let us understand how much worth is this subsidiary. Is it even worth? And if it is worth, then what is the worth of this particular subsidiary? So when we calculated, we came to know it is 100 crores. Okay. So now we are doing negotiations. The holding company, we are saying that we want to buy shares in your company. Your worth is 100 crores. We are ready to pay you 120 crores. So for holding company, the cost, the purchase consideration is more than the net worth. Hence, I can say that this 20 crores extra which I paid, worth was 100, but I have paid 120. So this 20 extra which I have paid is, I can say, I have paid towards the goodwill of this subsidiary. It is kind of paid extra. It is like a loss. Okay, it is like a capital loss, but I cannot show it as a loss. No, I cannot write loss. I will say I have paid extra towards the goodwill. Goodwill is nothing but a notional loss. Practically, if you see anywhere, wherever goodwill is written in the balance sheets, is nothing but a notional loss. Okay, it actually has no money in it. It is just being there in the balance sheet because it is not written off over the period of years. Generally, goodwill has to be written off with the help of any capital reserve available with you. Okay, so if the holding company has any capital reserve, to that extent goodwill can be written off, because even capital reserve is kind of like that. Okay, we can just write off the goodwill. So in a balance sheet, you will never always see goodwill and capital reserve both at the same time. It will be a very, very rare occasion. There can be only goodwill or there can be only capital reserve. Because accounting principle says that if you are having capital reserve, you can write off the goodwill. Okay. So this was one scenario where the holding company is paying more money as compared to the worth of the subsidiary. There can be another scenario where your worth is 100 crores, but I am buying you in 80 crores. Hence, this 80, that this 20, which is there, is like a profit for the holding. I paid less, no? So for me, 20 crores is like a profit. It is a one-time profit. One-time profits we always put in the capital reserve. One-time capital profit. Okay, one-time capital profit will always go in the capital reserve. Okay, so this understanding of whether paid extra or whether paid loss is known as cost of control. Cost of control. Right. In order to acquire the control in the subsidiary company, what was the cost paid by the holding company? Okay, cost of control. So that additional or less paid or more paid will become my cost of control. Now, if it is a profit, it will become a capital reserve. But if it is a loss, that cost of control will be written as goodwill. Okay, so if it is a loss, cost of control will be nothing but goodwill. But if it is a profit, cost of control will be nothing but capital reserve. Okay, so this is the basic idea of solving any sum for holding and subsidiary related. Okay, for consolidation related, you will find everything, everywhere, all the sums are asking you what is the cost of control. Okay, now there is a way and a manner. Now it will not be given to you directly that this is the worth and this is the amount paid. They will give you balance sheet. They will tell you find the worth of the subsidiary. And based on the worth, they will also give you what is the amount paid, purchase consideration paid by the holding. Then with the help of that, we will be able to solve and give the answer. Okay, so it is that simple. Now, so what all am I supposed to take into consideration to calculate the cost of control? Okay, so now if I am telling you that holding company holds 80% stake in the subsidiary company, that means I know the ratio of the holding. Okay, so say if the subsidiary company has 100 shares, 80 shares to belong to holding itself. So the stake is given. So balance 20% are who? They are also there, no? 20% are there, no, with the subsidiary. Those shareholders are still there with them. So they are known as minority interest. Okay, important. They are known as minority interest. There are 20 shareholders here, na? 80 shares the holding company is holding, but there are 20 other shareholders worth of 20 rupees. So then obviously those are known as minority interest. Okay. Now in order to find the cost of control, whether in form of goodwill or capital reserve, we need to understand the shareholder items of the subsidiary company, because shareholders items will be forming the part of the net worth. Now if I tell you find the net worth of the subsidiary company, what you will do? You will say, assets, total of the assets minus outside liability. That is how the net worth is. Net worth generally, what is the formula? Total of all the assets minus outside liabilities. That will become your net worth. Other way for calculating the net worth is the shareholders item. Okay, now what are shareholder items? Equity share capital, reserves belonging to the shareholders, any kind of a preliminary expenses not written off. All those are the shareholders items. They belong to them. Okay, so you can consider those shareholders items for calculating the amount of the net worth of the subsidiary company. How will we calculate? We will take one thing at a time. Equity share capital. See, now the particulars of subsidiary company, very important. I will take all the shareholder items, okay, of subsidiary. So I will take the share capital of subsidiary company. Share capital of the subsidiary company is always like pre. It was always there before the holding company came inside. Okay, it was always there. There is something known as pre and post. I will come to it why I am terming this. But equity share capital, you all agree, right? This capital was always there. Subsidiary company always had this capital. Then from that capital, holding company took the shares. Okay. So whatever is the ratio of holding, that will go into cost of control calculation. Balance will go for minority interest calculation. Revaluation reserves. Okay, why revaluation reserve gets created? Because in order to find the net worth, the holding company generally does revaluation of the assets of that subsidiary. Revaluate the building, revaluate the land, plant and machine, furniture and fixtures. Okay. So at that time, there can be a possibility that the assets have turned into a higher value than what they are appearing in the book. Because in the books, it is appearing for the values before 5-10 years, and again depreciation was done. But today's day, if revaluation take place, it might be more than what was appearing in the balance sheet. So any revaluation reserve will always be pre. If there is a profit in revaluation, I'll put in that revaluation reserve, right? These revaluation reserves are always pre. Why? Because they belong to the assets of subsidiary company, which was there even before the holding company came in. So revaluation reserves pre. Divide that between the holding and the minority interest ratio. 80% will belong to the holding and 20% will belong to the minority. Fair enough. Next is the general reserves. General reserves, if nothing is mentioned, it is again always pre. If they are giving some particular dates, then we will see what has to be done. But general reserves are always again pre 80% and 20%. Preliminary expenses, pre. It was always there with the subsidiary before holding company took acquisition in the shares. So it is again pre 80% holding company will bear this expense and 20% minority interest. Then we come to one of the very important point, which is profit and loss. So profit and loss can be pre and can be post. Okay, if it is pre, you blindly divide 80%, 20% and you give this 80% for cost of control of holding and 20% will go in minority. But if it is post, that means holding company has already acquired and after that, that profit was earned, then I do not need to take that profit for calculation of cost of control. I already acquired. I have already come in this company, and after that I have earned profit. It is like a regular course of business. So I will take that profit in my P&L account, like how we take other profits. When I'm saying I'm talking from the holding company point of view. Okay, so I don't need to calculate this profit, the post profit, for the purpose of cost of control. Okay, it is not a shareholder item, it is a regular course of business. I earn the profit and hence I'm going to take this to the P&L account on the credit side, like how we do otherwise. Minority interest holders will get their share. That will always be there. Okay, so they will get their share. Then if there is any kind of a dividend which the subsidiary companies pay, if it is pre 80% and 20%, sorry 80%, but there will be no effect for the minority interest. They already got that dividend, no, before we came. They have already got that dividend, pre-dividend already paid to them. Again, I will not pay, but I will take my share, 80%. Right? If pre-dividend is proposed and not paid, payment is not yet done, so then 80% too for cost of control and 20% we will pay the minority interest. And if it is anything which is post dividend is like any other income for me. So I will put it in my P&L account credit side. I do not need to take my share for the calculation of cost of. Alright. So that is going to be the thing I have to do if the post dividend is already been like there. Okay, whether paid or whether proposed. If it is a post dividend, no effect will come in the cost of control related calculations. I will give the share of that post dividend for minority interest, it will belong to them. Okay. Now, how will I decide whether the dividend is pre-dividend, post-dividend? See, P&L and everything is very easy. They will give you this is the pre-P&L, or they will tell you this is the opening P&L, the closing P&L. So then you will come to know whether which is pre and post. For general reserves also they will give you date. That general reserve opening is so much or closing is so much. If nothing is given, general reserve is always pre. If nothing is mentioned, okay, no dates are given for general reserve, so then it is always pre. If dates are mentioned, then we will take it according to the dates. Revaluation reserve always pre. Equity share capital always pre. Preliminary expenses always pre. P&L they will tell us whether it is pre or post. What comes here a problem is dividend. How will I know it is pre-dividend? Okay, whether paid, proposed, or whether it is post-dividend. How will I come to know reading the question? Okay, you know what has to be done. If it is pre-dividend paid, pre-dividend proposed, or it is post-dividend, we know what has to be done. But how will I come to know from the question? So understand whether it is pre-dividend or whether it is post-dividend. Look at the profits date from which the dividend has to be considered. Take the date of the profit. If that profit is pre, it is pre-dividend. If that profit from which you are giving the dividend is a post-profit, it is a post-dividend. Simple. Date of declaring dividend, payment of dividend, nothing. I am not going to consider those dates. It's very confusing. And it is against the accounting laws and principles. They are saying the profit which you used for giving dividend to the shareholders, take the date of that profit. Okay, if that profit is a pre, it will become a pre-dividend. If that profit is a post-profit after holding company came into our, as an holding company, came the holding company, then if it is a post, then you will consider it as a post-dividend. Okay. Now this entire story which I told about pre and post, how will I come to know? With the help of the acquisition date. So date of acquisition is a must. During this entire year, when did the holding company come into subsidiary? That is what is important. That date is important. If they have not given us the date, we will always assume it to be the first day of the financial year. 1st of April. Okay. So basically all these shareholder items which I told you, share capital plus reserves and surplus and any fictitious asset like preliminary expense and all, We'll minus those, and whatever is the shareholders items, we will divide that between holding company and subsidiary and minority in. Okay, so all the shareholders items, whichever we said, no, pre, so reserves and surplus, the ones which are pre, evaluation reserve, general reserves, a P&L, anything which is pre, we are going to take it as a shareholders items after equity share capital plus reserve minus the fictitious assets which are always. Okay, fictitious asset, one example is preliminary expense. So then that total I'll divide between holding and minority. This is important for you all to know, because in the sums also you don't have to make ledgers. Okay, unlike of what I teach in consolidation during my lectures, this is unlike it. I'm not going to solve any ledgers or make any balance sheet for this marathon. Why? Because it is not important from your exam point. You will see my lectures otherwise. You all know that how I have solved these sums, right? We have made ledgers, we have made investment account, minority interest account. But all that account making also is going to give you the same answer like how we are going to solve now. Okay, for us it is important to know how to solve these sums right like this, because it is expected in the same way and given in the model answers of the institute. Okay, so till so far, if I am clear, I just want you all to give a thumbs up, okay, so that even I feel like interactive. So I just want to be rest assured that you all are understanding up till now whatever we have done. Okay, I want to see more thumbs ups or likes button. Okay, because quite a few of you all are there. I want everyone to be on the same page. Now next concept. Okay, when holding and subsidiary come and become it's like relatives, right? Holding is holding so many shares of subsidiary. There is a relationship between them formed now. Okay, so if there is any kind of a mutual owing, what is the meaning of mutual owing? That before they became holding and subsidiary, it might be possible that they were dealing with each other. They were each other's clients. Holding must be buying goods from subsidiary, or subsidiary is buying goods from holding. That relationship might be there. Okay. So once they get into a relationship of holding and subsidiary and they become one, okay, obviously holding company will not pay to itself, no. The holding company has to receive some amount from subsidiary company, or holding company had to pay some amount to the subsidiary company before this holding subsidiary relationship came into picture. Now they became holding and subsidiary, they did investment, acquired shares, and everything is done. So this payment or receivable becomes a mutual owing. This payable or receivable becomes a mutual owing. It will get cancelled from the books of the company. So when a consolidated balance sheet will be made, then at that time, say trade receivables in case of holding company showing 100, and trade payables in case of the subsidiary company showing 100. Why? Because they have bought goods from the holding, and holding has sold goods to the subsidiary. So this becoming the mutual owing will get cancelled from the books and not be written to this extent of that amount of mutual owing. If there is any mismatch in the amount, obviously least of the amount will get cancelled, because there can be other owners, there can be other trade payables, there can be other trade receivables. So only to the extent of which it will be cancelled it from both the books. Next is, it might happen so that holding company is having some debentures also of that subsidiary company. So basically holding company becomes a creditor of subsidiary, no? And now this is again a mutual owing after holding and subsidiary came together. So this also has to get cancelled from both the books. Okay. So if holding company is holding some debentures in the subsidiary company, after they have come together, cancel it from the books. It is a mutual owing. As per accounting principles, we will cancel it from both the books. What is the amount of cancellation? Whatever, see, cancellation is always done at the face value. Okay, whatever is the face value, say it is rupees 100 or whatever it is always done at the face value. Okay, so say debentures were issued by subsidiary company to the holding company. The face value is 70,000. But currently, the market value of that debentures is standing at 60,000. Right? So face value is more than the market value. Okay, and this liability is only getting cancelled. So like I have saved 10,000 rupees. Okay, so it becomes a profit. It will be credited to the P&L. Right? And when the face value is less than the market value, obviously it is a loss, na? Face value is less than the market value, means market value, this debentures are running into 80,000. So tomorrow if I would have sold in market, I would have got 80, na? Now I'm cancelling, means like I'm selling it to myself, I'm cancelling it. So it is a loss. And I'm cancelling it at face value and market value is much higher, then it is a loss. It will be debited to P&L. Sorry. Excuse me. Now, it can happen that they have not given you the date of any P&L or general reserve, etc. If it is not given, we will not put our heads into it. We will directly take it as pre. Okay. See, and if the acquisition is on the first day of the year, 1st April, and they are being smart, okay, they are saying profit and loss opening balance of P&L is given, and then they have given closing balance. Okay, 1st April balance, 31st March balance. So yes, 1st April balance is given, so it is pre, no? But what about this closing balance? What it will be? How can I take closing balance? Closing balance is like our entire year has got over now. So this is pre. So the post will be the current year's profit. Current year's profit will become post. Obviously, no. If I had 10 rupees already at the time of opening of the year and I'm closing it at 15 rupees, that means during the year I earned 5 rupees extra, right? Correct. So that is why it is going to be 15, like it is the current year's profit, which is 5, that will be considered as your post profit. If the acquisition is on the last day of the year, that is I came only on 31st of March, then that entire profit is going to be pre. Obviously I have come only on the last day, so whatever profits been earned before that is going to be pre. Okay. Now let us read a question and then we will come back to the solution and understand the concepts. Okay, one at a time. Now like this, they will give you a question. They will tell you there is a balance sheet of A Limited and S Limited as on 31st of March 2012 they have given us. Okay, H Limited, S Limited amount. In share capital, they have authorized, issued, subscribed and paid up share capital, nothing they have mentioned. In that they are saying equity shares of rupees 100 each fully called up and paid up. So H Limited has 6 lakhs and S Limited has 2 lakhs. In reserves and surplus, they have only one, profit and loss, both 80,000. In current liabilities, only one liability, trade payables, 75,000 of H and 48,000 of S. Now coming to the asset side. In non-current assets, they have fixed assets, 5,55,000 of holding and 2,48,000 of the subsidiary. And in long-term investments, shares in S Limited at cost, 2 lakh rupees. This is important. So in the balance sheet of H Limited, in the asset side as investment is asset, right? For holding company, it's an asset. I have invested my money I have taken shares in the subsidiary, it is an asset. So long-term investment, shares taken in S Limited, cost is 2 lakh rupees. That means the amount, the cost for which the holding company for this particular shares, taking these shares in subsidiary, has amounted to 2 lakh rupees. Okay, it is at cost. Now understand one thing. Okay, you see there is equity share capital, 2 lakhs rupees here, and there is 2 lakhs at cost over here, and they have not mentioned how many shares. They are telling me find cost of control. Okay, whether it is goodwill or whether it is capital reserve. Now this is a problem of a wholly owned subsidiary. Why wholly owned? Because if you will see the balance sheet, long-term investment, shares in S Limited at cost 2 lakhs. The amount is also matching. Okay. Also there is shares at S. There is not. It's not written that only 1000 shares or 1500 shares. All the shares of S Limited costed them 2 lakh rupees. This is a matter of a wholly owned subsidiary. So if it is a wholly owned subsidiary, no tension. Okay, what we are going to do is, we are just going to understand that what is their net worth, and with the help of the net worth, we are going to know the cost of control. Okay, so if the holding company has an entire shares of equity shares of the subsidiary company, then what are we going to do? Then the investment cost of holding company, we will just simply subtract by the net assets, net worth. Okay, but here we will take the net assets. Why net assets? Because for paying this 2 lakhs, I took shares. Okay, so in return, I am getting to use no subsidiary company's assets, net assets. Okay, so investment paid, investment cost, okay, or purchase consideration, if I say, or investment cost is 2 lakh rupees. This is given to me. I need to find the net assets. How much I am getting in return for this 2 lakhs. 2 lakhs is the cost of investment, shares. Okay. But what am I going to get to use? What is the net worth? What is the net asset for this wholly owned subsidiary? Then in that case, I'll take total of the assets of the subsidiary. Total assets. What are the total assets? 2,48,000. Simply I will subtract outside liabilities, which is 48. Okay, 48,000 I will subtract. Outside liabilities is only one liability. So it becomes 2,48,000 minus 48,000, it became 2 lakh rupees. Correct? So this 2 lakhs is my net assets. 2 lakhs I have paid for that investment. 2 lakhs minus 2 lakhs, nil. So there is no profit, no loss. If in case there was any profit or loss, then I would have taken it as a goodwill or a capital reserve. Okay, this is a different type of a sum. Because it is a wholly owned subsidiary, I will take my net assets into consideration. What is my net assets? Total of the assets of the subsidiary, this total. Okay, this main total minus the outside liability will become the net assets of this subsidiary. That I will compare with the investment cost paid. If I get anything which is more or less, that will decide whether it is a goodwill or capital reserve. So there is nothing, there is no difference. So there is no profit, no loss, hence there is no goodwill or there is no capital reserve accordingly. So basically, like your cost of control which they are asking is nil. Okay. So this was one sum of wholly owned subsidiary. Very rare chances they may ask you. If they ask you, it will be for 3 marks. Okay. Now coming to the main important question. We are going to understand a lot of things with the help of this question. Okay, so pay attention. There's everything which we are going to solve in this. Okay, this pre, post and all. This is not a wholly owned subsidiary. This is a normal subsidiary and holding. So share capital, shares of rupees 100 each. Holding company has 5 lakhs and subsidiary company has 2 lakhs. This is the balance sheet as on 31st of March 2007. They have told me general reserves as on 1st April 2006. Okay, so starting of the year. It was 1 lakh of holding and 1 lakh of subsidiary. Profit and loss 1 lakh 40, 90, bills payable 40, creditors 80 and 50. In the asset side, they both have goodwill 40,000, 30,000, other fixed assets 3 lakh 60, 2 lakh 20. Now you see this 1500 shares in S Limited at cost. Cost means what? This is the purchase consideration paid by the holding to the subsidiary to acquire 1500 shares in subsidiary. 2,40,000. Stock 1,75,000, debtors 20,000, 75,000, cash at bank 60,000, 40,000. Okay, so this makes it 4,40,000. They are telling me now in the adjustments, the PNL of S Limited showed a balance of 50,000 on 1st of April 2006. We are supposed to find the cost of control and minority interest. Okay. So there are two important things, general reserve and PNL, for which they have also given me the dates. So I have to be very careful whether I am considering it pre or post. Only that will help me to divide it properly and take it for cost of control and for minority. Okay, so first I have written some working notes. Okay, answer sheet. I have given you all everything. They have not told me the date of acquisition. I told you if they have not given you the date of acquisition, then assume it to be the first day of that financial. The balance sheet is of 31st March 2007. Assume it that you came in holding company, took acquisition on 1st of April 2000 and start of the financial year. Okay. Now, how many shares have been acquired by holding? 1,500. Correct. How many total shares does subsidiary have? Subsidiary has 2 lakhs rupees in shares. Divide that by 100. Okay. So basically they have 2,000 shares. From 2,000, 1,500 shares is belonging to the holding company. What is the ratio? 1,500 divided by 1,000, 75%. Divided by 2,000. 75% is the ratio of the holding. So balance 25 will be my minority. Right? Now to find the cost of control, I am supposed to take up all the shareholders' items of the subsidiary company. Okay, investment cost is already given to me. I know what is the price paid, 2,40,000. But I need to treat the shareholders' items of the subsidiary company. Which are the shareholders' items? 2 lakhs equity share capital, general reserve, and profit and loss account. That's it. Is there any fictitious asset? No. Only these three items I have to kind of, solve them in order to find the cost of control. Starting with equity share capital. 2 lakh rupees. I told you equity share capital is always. So holding company share 1,50,000 will go for cost of control. And minority interest share will be here. Okay. Taking a second now. General reserve. General reserve, they have given me 60 and they have given me the date also. 1st of April 2006. So basically, I also came on 1st of April 2006 and this general reserve was already existing. 60,000 rupees. So general reserve is free. So 75% share of the holding. That is 45,000. I will take it for calculating the cost of control. Balance 15,000 minority interest will get their share. And now the last item, PNL of the subsidiary company. For that they have given me two figures. 90,000 is already appearing in the balance sheet. It is on 31st of March 2007. And they have given me the opening also. Opening 1st of April 2006 is okay. So I'm going to write both these figures. 1st of April 2650 and then closing balance as of per on balance sheet is 90,000. Okay, now make the timeline. Starting from 1st of April till 31st of March. 1st April 50,000 pre, simple, no? I came also on that day, it was already there 50,000. It's a pre-profit. Pre-profit divide minority and the holding company share 75% and 25%. This will go in the cost of control calculation, share of holding company in the pre-profit. What will be the post-profit? This is not post. This is not post. This is the closing balance. Post will be always current year's profit. Okay, current year's profit is always the post profit. So post profit from 50 I reach to 90. That means I must have earned 40,000 during the year, current year. Correct? Closing minus opening. That will give you my current year's profit. Closing is 90, opening is 50. So I'm going to get 40,000 as my current year's profit. That is post. If it is a post profit, we treat it as a regular profit in our course of business. I don't have to take that to my cost of control. So my share of 75%, 30,000 rupees, has nothing to do with my cost of control. I've just calculated. But yes, minority interest will get their 25% share, that is 10,000. So minority interest will get 12,500 plus 10,000. So total is going to be 22,500 share in P&L for minority interest. Okay, so now cost of control is very easy. Cost of control is investment amount paid, or you can say purchase consideration paid or cost paid. Okay, minus shares in net assets or shareholders items, share in the shareholders item. What are my shareholders items? Equity share capital calculated, general reserve share we calculated, and P&L share we calculated. Share of the holding company to the extent of 75%. Investment amount paid. Okay, cost 2,40,000. Subtract all this from 2,40,000. So we paid 2,40,000. In return, we got share in equity share capital. We also got share in the general reserve, and 2,40,000 minus 45,000 minus 37,500. 7,500 we have paid extra. We are getting a positive figure. We have paid more. Okay, we have paid more than what we have got in return as shareholders items. 7,500 is the cost of control in form of, and minority interest, just add everything. Minority interest, share in equity share capital, their share in general reserve, their share in P&L, both pre and post. Okay, this one is pre, one is post. So total 87,500 will be the amount of minority interest. Okay, so if you have seen my lectures, I must have solved the ledgers. I have then taken those amounts to the balance sheet, etc. But this is how the institute is solving the sum when they are giving you this type of questions for 5 marks. Okay, so this is all you have to. That's it. Okay. Now question number 3. We are done with question number 2, right? Now coming to question number 3. Same sum. A little bit here and there. They have given me balance sheet of X Limited on 31st of March 2005. Okay, 12,000 shares of rupees 10 each, 1,20,000, general reserve 25, P&L of 12, trade creditors 50. Asset freehold premise, plant and machinery, shares in the subsidiary company at cost. How many shares? 2,000 shares in 10 rupees. So that means X Limited is the holding company. So this shareholder item of holding company for me, I do not need that. Okay. What is important from this balance sheet? This 25,000 or 20,000 shares. 1,000 into 10. Stock at cost, trade debtors, bank balance. Y Limited is now my subsidiary company. I'm interested in the shareholder items of the subsidiary, which is equity share capital 30,000. General reserve on 1st of April 2004, just correct this. Okay, 6,000 rupees. Profit and loss 9,000. Trade creditors 5,000. Leasehold property, plant and machinery, stock debtors, bank and. For me, this 3 shareholder items is important. As on the date of the acquisition of X Limited of its holding of 2,000 shares in Y Limited, the latter company, that means Y, had a credit balance of 6,000 in the PL. That means as on the date of acquisition, that means on 1st of April 2004, the opening balance of P&L was 6,000. Of which company? Of Y Limited. That is the subsidiary company. So I have to take care because this will become pre. No date is given. I will assume the date of acquisition as 1st of April 2004. Okay, 1st of April. Find out the ratio of holding company. How many shares is the holding company taken? 2,000. Right? 2,000 shares they have told. Out of how many shares does the subsidiary company actually have? Only 3,000. So the share ratio is 2/3, 1/3. I've kept it 2/3, 1/3 because percentage is coming in decimal. Okay, now consider the shareholders items of of the subsidiary company, that is Y Limited, to calculate the cost of control. Only 3 shareholders items again: equity share capital, general reserve, and PL. Okay, equity share capital is always free. So this 30,000 divide 2/3, 1/3. Okay. 2/3 and 1/3. So this will go in cost of control 20,000 and 10,000. General reserve, they have already told me it is as on 1st of April 2004. Holding company I also came on that same date. So obviously this general reserve is free only. No, it was there 6,000. So holding company share will go in cost of control. That is 2/3 is 4,000 and 1/3 will go for the minority. P&L of Y Limited, they are telling on 1st of April it was 6,000. And when I see my balance sheet, it is closing at 9,000. So 9,000 it is closing. And 1st April it is opening. So this is going to be pre, no doubt, the 1st April one. Okay, pre. So pre 2/3 and 1/3. 1/3 is for minority interest. But 2/3 will go for the calculation of cost of control for the holding limited share, holding company share. And current year's profit, which is closing minus opening, 9,000 minus 6,000, 3,000 will go as a post profit. Holding company share 1,000, minority interest share 1,000. But this 2,000 I will not take in cost of control. This is a post profit. Anything which is post has nothing to do with the cost of control. This already I have come in the business and started earning this profit. So this will go in the normal P&L credit side of the holding. But yes, minority interest, it will be both these figures. Okay, pre 2,000 for minority and for post minority interest are going to get 1,000. So cost of control is investment paid minus share in the net assets or shareholder items. Okay. So cost of control, amount paid. Amount paid is 25,000. Investment. Okay. Purchase consideration. This is given to us in the balance sheet. See the balance sheet of X Limited. See, 25,000 is the cost of the investment. For that investment, we got in return capital to the extent of 20, general reserve we got to the extent of 4, and P&L only 4. Only this I will consider, no? The pre one. So minus everything you are going to get from 25,000. If you are going to minus 28,000. It is like kind of a negative. So your paid is less than what you're getting in return. Automatically this will become capital. Okay, so cost of control here is in the form of capital reserve. And for minority interest, we will add everything. Share in equity share capital, in general reserve, pre-P&L and post-P. Okay. So this was with question number 3. Alright. Now we will do question number 4. Again, calculate the amount of cost of control and minority interest. Okay, Vipul Limited and Vedika Limited, there are 2 companies. Equity shares of rupees 10 each fully paid up. Vipul has 10 lakhs, Vedika has 2 lakhs. General reserve in Vipul is 3 lakh 10, nil. P&L 1 lakh 50, 40. Creditors 2 lakh 13. So total they have given 3 lakh 90 and 3 lakh 9. In assets 1 lakh 62 and 1 lakh 80. 70% shares in Vedika Limited at cost. They have already calculated 70% and given it to me. 1,42,000 is this purchase consideration. Current assets 3,86,000, 1,24,000. Discount on the issue of shares. Fictitious asset. Shareholder item 5,000. Only in Vedika. Okay, so basically Vipul is the holding company. Vedika is the subsidiary company. On 31st of December 2011, Vipul Limited acquired the shares in Vedika Limited. On 1st April 2011, Vedika Limited's P&L account showed a debit balance of 8,000. On 31st March 2012, Vedika Limited decided to reevaluate its fixed assets at 2 lakh. Find the amount of cost of control and minority. Very interesting. Here they have given you the date of acquisition. On 31st of December, Vipul Limited acquired the shares in Vedika Limited. Okay. On 1st of April 2011, and here it is 31st of March 2012. This is my financial year. And in December, 31st December 2011, I have come into the picture and acquired shares in Vedika. Holding company has acquired on this date. Okay, so date of acquisition 31st of December. It is a little tricky sum, but it is a good question. Okay, try to understand. I am explaining everything 2 times. Now, holding company share 70 and 30. Minority interest will be the balance, no, given to me. I will start treating the shareholder items of the subsidiary. What are the shareholder items of the subsidiary? Equity share capital, general reserve is not there only. P&L. And last is the discount on issue of fictitious asset. Okay, so let us treat this item. Equity share capital's amount is 2 lakhs of the subsidiary. I will divide that between holding and minority because that I will take into the consideration for cost of control. 70% and 30%. It is always pre. So anything which is pre has everything to do with the cost of 1,40,000. Revaluation reserve always pre. How did I get this revaluation reserve? They have given me. Vedika Limited decided to reevaluate fixed assets at rupees 2 lakhs. So fixed assets were standing at 1,80,000. I revalued it and made it 2 lakhs. That means 20,000 is the revaluation profit. Now my assets are going to be shown at 2 lakhs instead of 1,80,000. So this 20,000 profit will go as a revaluation reserve. Revaluation reserve is always pre. Though I did the revaluation on 31st of March, that is at the end of the year. But it will always be pre because it is for those assets which were existing with the subsidiary for holding company acquired share. Okay, so it will always be pre. For revaluation reserve, don't think anything, don't see any dates. It is always pre, 20,000. By 22 lakhs now the value will become, balance sheet value is 1,80,000. Okay, so 20,000 is the profit. Divide between holding company and minority interest. Take this in the cost of control for holdings. 70% will be 1,40,000. Minority interest will be 1,000. Discount on issue of shares is a fictitious asset. Okay. So like how I am taking my share in the profits, I will have to take the share even in the loss. Like a loss. Discount on issue of shares, fictitious asset, 5,000 rupees. So holding company and minority interest, 70% and 30%. So I will debit, means like until now like this was profit, was credit. Now this is like a loss, 3,500 and 1,500 for minority interest. Okay, 70% and 30%. Now coming to the main item, which is P&L. Okay, P&L on 1st of April of Vedika showed a debit balance, means a loss of 8,000, and they are closing at what? P&L 40 profit. It is appearing in the liability side under the form of reserves. That means this is profit. Okay. So giving the timeline, 1st of April 2011 till 31st of March 2012. On 1st April, 8,000 loss, it is given to me. Okay, and this 8,000 will be pre because it stands on 1st of April. Anything which is pre has to go for my cost of control calculation. Fine. Okay, and 40,000 it is at the end of the year, 31st of December. So you all know how to calculate current year's profit. No, current year's profit, now we are already doing this. It is closing minus opening. Closing in the balance sheet is 40,000. Minus opening is minus 8,000. 8,000 is loss, no? So minus 8,000. So minus and minus plus, current year's profit is 48,000. Obviously, if I am closing at 40 and I had opened at negative 8, I must have written off, no, this negative 8. From negative 8 till positive 8 I must have come. Only then I am closing at 40,000. Na? So I must have earned 48,000 profit of the current year. Then only closing can be 40. So closing minus opening, 40,000 minus 8,000. So 48,000 is my current year's profit. Until now, my current year's profit, I was considering it at post. Why post? Because I was coming on the first day of the year over here. So entire thing was post. But no, in this sum, it is different. They are saying we have acquired shares on 31st of December. So it's like as good as 1st January. So there is a time ratio involved now. Time ratio 9 months pre. 1st April to 31st December. 9 months it will be pre and balance only 3 months will be post. So this current year's profit, no, which is 48,000, that entire cannot be post. It has to be now divided in the time ratio of 9:3:1. 36,000 will be pre and 12,000 will now be post. Okay. So for post there is no worry, but for pre, 36,000 out of that 48,000 current years, 48,000 rupees profit. From that 36,000 is pre. I already had 8,000 negative pre. So my net pre-profit, net pre-profit, total pre-profit actually will be what? Actual pre plus the current year's pre. Okay, so 8,000 and 36,000. Since 8,000 was loss, I'll subtract it. So my net pre-profit is 20. So I am not going to take that 8,000 and divide between holding and minority. No. I will first try to calculate the current year's profit because there is a time ratio involved. And that pre 31st December until then I came. That entire current year's profit will be pre. 36 minus 8, 28,000 will be my pre-profit. Divide that between the holding and minority. 70% and 30%, and we are going to take this as a cost of control calculation. And yes, minority interest holders, they will get their share 8,400, and in the post profit also they will get their share. No, post profit is only 12 from 48,000 current year's profit. 48,000, if I divide that divide that by 4, 12,000 rupees. Ratio is what? 9:3. That means the ratio is, I'll even do this and show it. The ratio is basically 3:1, no? 3s are 9, 3 1s are 3. The ratio is 3:1. So total profit is 48,000, no? 48,000 into 3 divided by 4 be my pre-profit. Pre-profit 48,000, divide that by 4 into 3, 36. 3 plus 1, the ratio I am taking, okay? And that one part is going to be 12,000. 48,000 into 1, divide that by 4. 12,000 will be the post profit. Post profit, even holding company will get its share. That is 8,400 to the extent of 70%. But it has nothing to do with the cost of control. It will go in the regular P&L account on the credit side. Okay, and minority interest share will be 3,000. So now for my cost of control, investment amount paid, that is purchase consideration, this is given to us in the balance sheet in the investment section, 1,42,000. From there, share in the capital, subtract, share in the P&L, I will subtract. P&L will be how much total? 19,600, okay? For the cost of control calculation. 19,600. Okay. Revaluation reserves, that share also will get subtracted. And discount on issue of shares. When all this profit related I am subtracting from my purchase consideration, this is like my loss. I will add it back. It's like my cost. I will add it back. Right? Discount on shares is like a loss or a cost. Profits I am subtracting from my amount paid, and loss I will have to add back. So if you will see, no, you are going to get, add all this 1,40,000 plus 19,600 plus 14,000. Okay, subtract that from 1,42,000, and then again subtract 3,000. 28,100 is going to be your capital reserve, that is your cost of control. Don't get confused, okay, over here. Whatever amount I have paid to my subsidiary, I am taking that total amount and I am subtracting whatever I am getting in return to find the cost of control. I am getting in return 1,40,000 for share, 19,600 in P&L. I am getting 14,000 of share in my revaluation. Only this 3,500 here is different. We are adding back. Why? Because it is a loss. It's a discount on issue of share. So you can just do 1,40,000 plus 3,500 first, then subtract 1,40,000, then subtract 19,600, then subtract 14,000. You will get 28,100. You don't do miscalculation over here. And minority interest, add all the share of the minority. We have 60,000 in share capital. We have 6,000 they are taking from revaluation reserve. They will also have to bear this loss of 1,500, and they are taking total 8,400 plus 3,600 P&L. 8,400 plus 3,600, 6,000, 60,000. This you will minus because this is a loss. They will have to bear this loss. So 76,500 will be minority interest. Okay, I hope this question also everybody has got it. It is clear. Okay. Now, before I start my past exam questions, I would just like to take 1 minute pause and break. You all can just go through whatever we have until now just done, and then we do the past exam question. Just take a 1 minute, we'll just take a 1 minute break. So, did like question number. Okay, only one small correction is there in question number one. In the question, please remove this 80,000. 80,000 only the H Limited has it as the PNL. There is nothing in the amount of S Limited. Okay, so just remove that 80,000. It is a misprint, right? So we did question number 1, we did 2, 3 and 4. Now we have to start with the past exam question. Start it like in a minute. Until then, just go through. Okay, like even in case you all have written some notes or done something, just go through it, and then you all are ready, just put the thumbs up button. Okay, we can start solving the past exam questions, and trust me, they are like this only, simple. You all have understood the concept of calculating the share of holding company for cost of control. Nothing can be difficult. Okay. So clear so far? Anything understood? Now, past exam questions are going to boost our confidence because now you all will know, yes, we can solve it. So let's begin. You will read the question slowly. There is a summarized balance sheet of H Limited and S Limited as on 31st of March. Shares of rupees 10 each. Okay, this is like what? 1 CR, 20 lakhs. Reserves 16 lakhs, 6 lakhs, PNL 12 lakhs, 8 lakhs. Total of the asset side, liability side is 1 crore 20 lakhs, and here it is 34. In assets, we have sundry assets of 1 CR and 34 lakhs. Equity shares in S Limited 1,60,000 shares. Purchase consideration paid, the cost is 28 lakhs. Total 1 crore 28 lakhs and 34 lakhs. So simple, like they have just given 1-2 items. Okay. Now S Limited had reserves of rupees 6 lakhs. S Limited, subsidiary company, when H Limited acquired shares in S Limited. But PNL balance was fully earned after the purchase of H. So basically, this they are saying that it was before, na? So this is pre. And whatever PNL balance you see, whatever PNL balance you seeing over here, 8 lakh rupees, was after holding company came. So this is post. This is pre. S Limited to decided to issue bonus shares out of the post acquisition profits in ratio of 1 share for every 5 shares. It's a favorite question of the institute. Okay, calculate the cost of control before the issue of bonus and after the issue of bonus. What will be the journal entry passed in the books of S Limited and H Limited for issue of the bonus shares by S Limited? Okay, now remember one thing, S Limited is giving bonus. Okay, bonus is given to the shareholders. One of the shareholder is holding company. Okay, so the shares of the holding company will increase to the extent of the bonus, right? Okay, so understand this. What they have given me, they are telling me holding company is having 1,60,000 shares in S Limited. How many total shares are there in S Limited? If the share value is 10 rupees each, 20 lakh shares, that means there are 2 lakh shares. So out of 2 lakh, 1,60,000 so belongs to the holding. So what is the ratio? 16 upon 20 divided into 100, 80% holding company share. Minority interest will be the balance 20%. Now calculate the cost of control before the bonus share. Okay. Particulars and amount. What is the amount of consideration paid? It is given to me in the balance sheet. See, 28 lakhs. H limited paid to S limited, 28 lakhs. In return, I will take the shareholders items. What are the shareholders items? One is equity share capital and one is reserve. Only these two are pre. P&L is post. Thing has to be done in the cost of control. So share in equity share capital will be how much? To the extent of 80% of 20 lakhs. 80%, no? 16 lakhs. Yes, 1,60,000 shares. And in the reserves, 80% of 6 lakhs. What is the reserve? Lakhs. Even that I will take to the extent of 80%. 4,80,000. So cost of control is coming in form of a goodwill. We paid 28 lakhs and in return we got only 6 lakhs in form of shares, in form of capital, and we got 4,80,000 in form of reserve. So 7,20,000 is the goodwill. Okay, they have given general reserve of 6 lakhs is as on the date of acquisition. Since it is on the date of acquisition, it is a pre-profit. It will be taken for the cost of control calculation. So before the issue of the bonus, it is this. But after the issue of the bonus, what will happen? What is the bonus? What the bonus will do? It will kind of reduce the capital, reduce the reserve. They are saying no, that this bonus is given from the post acquisition profits. That means they are using the P&L profits to give this bonus. So the amount in this profit of the subsidiary company will reduce and the shares of the holding company will increase. Even subsidiary company shares will increase only, because of the bonus. What is the bonus ratio? 1 share for every 5 shares held. So let us remove the ratio. Bonus is given in the ratio. If you are having 5 shares, we are going to give you 1 bonus share. How many total shares does the holding company have? 1,60,000. Holding company also will get this bonus. So 1,60,000 they already are having. So what will be the number of bonus shares given? 1,60,000 shares into 1 divided by 5. 32,000 shares they will get at bonus. Share value is 10 rupees each. That means 3,20,000 will increase in the share capital. Correct. So amount paid, consideration given. Equity share capital to the extent of 80%. Same thing, 16 lakh rupees. Then in the reserve, 4,80,000, that will also remain the same. Just copy paste from what you did previously. But we got bonus shares also now. So bonus shares of 3,20,000 we will subtract. So now our cost of control, or which is get in the form of goodwill, is 4 lakh rupees. Okay, it is 4 lakh rupees. Simple, no? In case of the holding company, to find the cost of control, we are also getting the bonus. So I just calculated that much part. Okay, for bonus, we had 5. For every 5, we are going to give 1. I am having 60,000 shares, okay, of the whole subsidiary company. So I am going to get 32,000 shares as bonus. What is the value of 1 share? 10. So 3,20,000 more in my share capital will increase that extent. So I will take that for the calculation of the cost of control, because share capital is always pre. So now my cost of control or goodwill is 4 lakhs. Initially it was 7,20,000. Right. Now journal entries. Okay. In the books of S Limited. S Limited gave bonus. For giving the bonus, what did they use? They have used the P&L account. From that P&L, they have lot of money in the P&L. Okay. S Limited has lot of money in the P&L. This is the post profit, 8 lakh rupees. So from 8 lakh rupees, they are giving this bonus. Right. So it will be what? P&L account will get debited. How much? 4 lakhs. How? Held to bonus. Actually, number of shares currently subsidiary has got 2 lakh shares, right? So bonus will be of how much? 2 lakhs. Divide by 5. They will have to give to all these 2 lakh shareholders, na? How much? 40,000 will be my bonus. Bonus shares. What is the value of each share? 10 rupees. Therefore 4 lakhs. Okay. So P&L account will get debited by 4 lakhs to equity share capital 4 lakhs. So P&L will get reduced, share capital will get increased. This will be the journal entry. And there will be no journal entry in the book of H Limited. H Limited is not doing bonus. Okay, S Limited is doing bonus. So there is no journal entry in the books of H. Okay, so this was like kind of good 8-mark question. Okay, so done. Question number 1. Now coming to question number 2, past exam. Okay, they are saying balance sheet of S Limited only, they have given it to me. Share capital rupees 10 each fully paid up. That means they are having 60,000 shares. General reserve 1,50,000. P&L 1,05,000. Creditors is 1,80,000. And in assets there is fixed assets and current assets. Holding company, which is H Limited, has brought 48,000 shares in subsidiaries. So that means out of 60,000, 48,000 is taken by H. So I can find the ratio. Consideration paid for the purchase of the shares is 9 lakh. General reserve on the date of acquisition is 1,20,000. That means it is pre. And profit and loss account on the date of acquisition, again pre. Find minority interest and goodwill amount. How will goodwill be treated in the consolidated books? Very easy. From 60,000, if holding company is having 48,000, percentage of holding is 80% and 20%. I will start taking the share of minority interest to the extent of 20%, right? Of all the shareholder items. What are the shareholder items? All this. Share capital, general reserve and P&L. Okay. So share capital 6 lakhs into 20%. Okay. General reserve 1,50,000 into 20%. And P&L 1,05,000 into 20%. Or else you can just do the total and take it 20 as you like. So share into the minority interest will be 1,71,000. Lakhs plus 1,50,000 plus 1,70,000. You can do the total of all three, total, and directly take 20%. Okay. Now working note for general reserve. For general reserve, date of acquisition is assumed to be the first date. Okay, as on the date of acquisition, it was 1,20,000. Now, okay, so opening is 1,20,000. Now, closing of general reserve is 1,50,000. So, from this opening till closing, right? Opening will be considered to be totally as pre. Why? Because the date of acquisition is also 1st of April. Right? So, this will be considered totally pre. So, I'll take 80% and 20%. 96,000 will be the holding company share. That I'll take it in the cost of from this 1,20,000. Okay, 1,20,000 into 80%. 96. But when I'm closing at 1,50,000, the entire current year's profit will be post. Okay, because that is what I have earned during the year, na? So 30,000 will be current year, which is post. So the share to the extent of 80,000, 80% of 30,000. Okay, this is what, like 24,000. This has nothing to do with my cost of control. Yes, minority interest shareholders will get 20%. Okay, they will get 20%. So for minority interest, I have directly taken it 20%. I have already taken it only pre and post thing I have done. So if you will see this, it will be 24,000 plus 6,000. Which is how much? 3,000. Okay, which is 30,000 here. See. Okay, and in case of PNL also I'll have to do the same thing. Since the balance sheet figures, okay, and the figure given in the opening is different, we will have to do this pre and post. Okay, so try to do pre and post only, because in this case, though I have done this, okay, 20% directly, it has come the same thing. It might not even come. Will come, but try to do this pre and post related only. So opening 24,000 is there in PNL. This they have given me. And then in the closing, as per the balance sheet, they are standing at 1,05,000. Right? So opening will be pre, because the date of acquisition is 1st of April. So entire 24,000 is pre. So that pre will go as 80% for the calculation of cost of control. Okay, so from 24,000 into 80%, 19,200 will be holding company share, and it will be taken for the calculation of cost of control. And this is going to be 20% minority interest. And when I am going to close at 1,05,000, that means in the current year, we have made a profit of 81,000. How? Closing minus opening. 1,05,000 minus 20. 81,000 is my current year's profit. 80% share of the holding company, which comes to something 64,800. I have nothing to do with that cost of control. It will go in their normal P&L account credits. But yes, 20% of the holding company share, which is 81,000 into 20%, 81,000 into 20%, will go 16,200 will go to the minority interest. So now if you will see minority interest again, 4,800 plus 6,200. Okay, 4,800 plus 16,200, that will come to 21,000. Okay, that will come to 21,000. Right, so minority interest I have already done, and I am also doing pre and post for the purpose of cost of control. Everything we are verifying, it is the same. So now calculating the cost of control, which is can be goodwill or it can be, okay, minority interest and goodwill they have told. That means there has to be goodwill. We have paid more than what we are getting in return. Fine. Amount of consideration paid, this is given to us. Given. Right, 9 lakh rupees, no? Right. In return, we got the share in equity share capital, 4,80,000. We got share in the pre amount of the general reserve, only pre. Only pre can be taken into consideration. So pre of general reserve was how much? 96,000. And pre of PNL was how much? 19,200. Right. So only this amounts I will take. Only the pre. Because that only can be taken for the cost of control calculation. So 96,000 minus 19,200. So from 9 lakhs minus 4,80,000 minus 96 minus 19,200, you will get 3,04,800 as a cost of control in form of goodwill. And goodwill is always shown on the asset side of the consolidated balance sheet of the holding company. Okay, consolidated balance sheet of the holding company. Yes, it is like a fictitious asset. It is a notional loss. Okay. So this was an interesting sum. Okay, question number 2. Now coming to question number 3. This sum is a little tricky. It is for more marks. Though it is looking small, the bigger the questions, everything is given in that. Okay, so sometimes people get scared in reading the question only. They're like, ma'am, so much is there in the question that we don't know how to solve. But if you all will read the question, no, half of the answers are in the question. If there are big questions, don't get scared of the size of the question. Okay. Now see this third question, small question. Now see its solution afterwards. On 31st of March 23, H Limited has 20,000 shares out of 25,000 equity shares issued by S Limited. Okay, so S Limited actually is having 25,000 shares. Okay, from that, holding company is holding 20,000 shares. Can somebody tell me the ratio? It is 80% is there as the holding. Okay, 80% is the holding. Okay. Now, H Limited acquired the shares in S Limited in the following manner. On 1st of April 22, they acquired 25%. Percentage of shares acquired. Then on 1st of October 22, they acquired 37.5%. And then on 1st of January 23, they acquired 37.5%. Okay. So 25 plus 37.5 plus 30. Perfect. 100% was then completed on 1st of January. Okay. On 31st of March 22, the balance sheet of S Limited exhibited equity share capital of rupees 2,50,000. Right, 25,000 shares they have, 10 rupees is the value. Reserve and surplus was 1,25,000 on 31st of March. During the year 22-23, net profit earned by the company was 50,000. That means current year's profit. Okay, during the year means current year. That was distributed evenly throughout the year. Amount of reserves and surplus on 31st of March 2003 stood at 1,75,000. Okay. Ascertain the share of parent company in the profits of S Limited as on the date of the acquisition. Now understand one thing. I am giving you basic understanding of holding company holds 80% of shares in the subsidiary. Okay. So basically they have acquired 20,000 shares of subsidiary. Now this 20,000 shares they have done in parts. From 20,000, 20%, 25% they acquired on 1st of April. Then 37.5%, 7,500 shares they acquired on 1st of October. And then again now remaining 7,500 they acquired on 1st of January. That is how the entire acquisition 100% was completed. Don't take 100% of the holding. They are saying this acquisition 80% has taken place in stages. Okay, so 20,000 total 100%. 20,000 got complete when? 1st of 23. Okay, so that is the ratio of the percentage of shares acquired. Percentage of the holding is 80%. Okay. Now first one we will solve. See, calculation of the shares of H Limited in the profits. Okay, calculation of share of H Limited, profit of S Limited as on the date of acquisition. There are different dates. 80% holding you all understood from 25,000 shares. If I am holding 20, that means I am having 80% stake in the subsidiary. Whatever is happening on 1st of April 22 now. Okay. They are saying that what is the share of the parent company in the profit of S Limited as on the date of acquisition. Okay, share of profit. And they are saying there is 1,25,000 reserves and surplus on 31st March. And profit earned during the year is 50. And reserves and surplus is 1,25,000. Okay, so on 31st of March 2020, okay, balance sheet of S Limited exhibited equity share and reserve and surplus. So on 31st March 2022 means 1st of April 2022, right? General reserve was standing at 1,25,000 reserves and surplus. Okay, then on 31st of March 2023, this reserves and surplus is standing at 1 lakh. We have to ascertain the share of H Limited in these profits. Okay, so this 50,000 they have earned during the year, right? That is what they have given. Okay. So now amount of reserves and surplus is opening. I can say this is opening, and it is also pre, right? It will be pre. 1st of April they came, 31st March was the amount. So it is pre, no? Before I came, this profit was there. Okay. Amount of shares acquired was 25% of 20,000. How many shares I acquired? 5,000. So how much amount of stake did I acquire on 1st of April? 5,000 out of 25,000 shares. No, the stake acquired is 20%. Number of shares acquired is different. Okay, I acquired 25% of the total number of acquisition. Total number of shares, which is 20,000. On 1st April, I acquired only 25% of. Okay, so from this 5,000, so the stake, if I want to calculate, currently on 1st April, my stake will be how much? 20%. So I will get only 20% of the share in the profit also on 1st of April 22 from 1,25,000, which is pre. I'm going to get 25,000. Post, remaining 50,000 was earned after 1st of April. Nothing I'm going to get at that time. On 1st of April, my share in the profit will be 25. Then I came on 1st of October. And on 1st of October, again, amount of reserves and surplus is 1,25,000. Profit earned during the year is 50,000. Right? So, proportionate of that profit, this 50,000 was for 12 months. So, from 1st April to 1st of October, it is 6 months. So, 50,000 time ratio. So, this 50,000, I am going to take it proportionately for 6 months from 12. So 25,000 also will become pre. I'm doing everything for this pre-profit. 1,25,000 is the pre only because it is on the date of 31st of March 22. Right, so that is the pre only 1,25,000. But current year's profit, which is 50, which I have earned from 1st of April 22, 1st of April 22 till 31st of March 23. Okay, they have told me we have earned 50,000 and it was evenly spread throughout the year. That means for 6 months I have earned 25. So now my total share in the profits will be 1,25,000 pre plus 25,000. Okay, which is 1,50,000. This I will have to take it to the extent of my holding. So what is my holding? My holding is now on 1st of October 37.5% I acquired. 1st of October 22 I acquired more 37.5%. Of how many shares total? 20,000 I am going to acquire. From that 37.5 I did on 1st of October. I acquired 7,500. Right. So what is my holding? 1,500 divided by 25,000 total number of shares. 30%. Right. So on 1st October I acquired 30%. I already had 50% holding. 20% on 1st of April. On 1st of April, I already had 20% of the holding. I had acquired 5 shares out of the total 25,000 shares of subsidiary. So, percentage of holding was 20. Now, my percentage of holding will be 7,500. Total number of shares acquired, 37.5 into 20,000. Okay, 7,500. Total number of shares in holding in subsidiary is 25. So, percentage of holding acquired is 30. So, 20 plus 30. Now, my holding is 50. So the profit which we calculated 1,50,000, I am going to take immediately 50% of that 1,50,000, which is 75,000. Okay. And now the third acquisition happened on 1st of January. So reserves and surplus amount pre is 1,25,000. This is profit earned during the year. Current year's profit is 50. So basically from 1st April till 31st of December, 9 months. So it has to be 50,000 into 9 divided by 12. 37,500 will be pre. So it's 1,25,000 plus 37,500. 1,62,500 will be pre. This pre, I have to take the share of my holding, the extent of this pre profit, that will be my share. How will I find my holding? 37.5% shares I acquired on 1st of Jan. Okay, I had to acquire total 20,000 shares. I acquired 37.5% on 1st of Jan. 7,500 shares acquired. So now my percentage of holding will be 7,500 out of the total number of shares of subsidiary. 30%. Already I finished acquiring 20 on 1st of April. Then 1st of October I acquired another 30%. And now I am going to acquire another 30%. Yes, it became 80%. See, fantastic. So now it is going to be 80%. Now we have completed. Okay, so now we will take that entire profit into 80%. That will be my share in the profit of subsidiary company. Share of H limit of the holding company in the profit of subsidiary company. It is a very, very important sum. Like chances of this. Okay, so you have to be very careful while solving this. Now question number 4. From the following details, calculate goodwill or capital reserve and minority interest that will reflect in the consolidated balance sheet. Yes, if it is a goodwill, it will reflect on the asset side. If it is capital reserve, it will reflect in the reserves and surplus side of the consolidated balance sheet. Summarize balance sheet as on 31st of March 23. Share capital value rupees 100 each, 10 lakhs, 4 lakhs. P&L 6 lakhs, 4 lakhs. General reserve only holding companies. Liabilities 9 lakh, 2 lakhs. Total 27 lakhs and 10 lakhs. Sundry assets 20 lakhs, 10 lakhs. Shares in S Limited as on 1st of April. How many shares? 3,000 out of 4,000. Cost paid 7 lakhs. Okay. Balance sheet of S Limited exhibited on 31st of March 22 was 1 lakh. Okay, profit. And it was 3,000 in general. 31st of March 22 is as good as 1st of April 22. That means they are talking about opening balance. So what is given over here? P&L 4, all that, it is closing balance, and nil is the closing balance. Okay. So H Limited holds 3,000 shares out of 4,000 shares. So percentage of holding is 75%. Minority interest will be 25%. Calculation of valuation of goodwill. Cost of investment is already given to us, 7 lakh rupees. I will take 75% of 4 lakhs, which is 3 lakhs rupees. Share in the P&L amount, which is pre. Okay, whatever is pre. So P&L, they have told me 1 lakh is pre. 4 lakhs is standing in the balance sheet. So 1 lakh is only pre. They have told me opening date of P&L. 75%. And share in the general reserve, 60,000. Okay, share, opening. This is the opening general reserve. So share in the general reserve is going to be 6,000 into 75% pre, no? Opening general reserve will be pre. So from 7 lakhs, I'll minus 3 lakhs, 75,000 and 45,000. My cost of control of goodwill comes to 2 lakh 80,000. And share of minority interest, they are going to get a share of 25% in the equity share capital, 25% share in the pre-PNL. How much is the pre-PNL? 1 lakh. 25% of 1 lakh. They are going to get the share of 25% in the opening general reserve, which is how much? 60,000. 1,000 into 25. 15,000. Okay. But they are also going to get share in the post PNL. Post PNL for holding company, it does not matter. It does not come in the cost of. But for minority interest, they will get now. Okay, so how to calculate this? See, PNL. Opening given to me 1 lakh. Closing they have given me 4 lakhs. That means 3 lakh was current year's profit, that is post. Okay, 75% holding company will get cost of control. It will be 75% PNL account of the credit side. This I have done already. I am doing only post PNL account credit side of holding. But 3 lakhs to 25%, 75,000 minority interest shareholders will get it. Okay, post PNL share. But if you see, in case of general reserve, we started with 60 and we ended up at 0. That means when I started on 1st of April, I was standing at 60,000. And then on 31st of March, this amount became 0. So what must have happened? Closing minus opening will give me current year. Closing is 0, opening is 60. So that means in current year I must have made 60,000 loss. Right? Only then my general reserve became nil, no? From profit of 60 it is showing nil. That means there must be a 60,000 loss. That is entirely post. 60,000 loss is post. Post loss has nothing to do for the cost of control. Okay, so even if I am taking 60,000 to 75%, which is 45,000 as share of the holding company, it will go in the PNL account debit side as a normal loss. But yes, I will have to take 60,000 into 25%, which is 15,000 as the minority interest shareholder, 25%. No? So that will be a loss. So for minority interest shareholders, you will say, okay, so you will take I have taken over here 3 lakhs minus 60,000, the entire loss. Okay, and then I have taken it 25%. You can even do that, or you can take this 75,000 as a profit minus 15,000 as a loss. Again, you are going to get it 60,000. Okay, you are going to get it 60. Or else directly 3 lakhs post minus 60. That is also post, no? 60 is post only. 3 lakhs minus 60,000. That is the entire post. For that, the share of only 25% of the minority interest shareholder. So this both is post. So for minority interest, to directly we will take 25% of this post na, and give it to them. So 60,000 here. Okay. So 60,000. So total is going to be 1 lakh plus share in the PNL, pre-PNL, post-PNL, okay, and pre-general reserve. Okay, pre-general reserve, and you are going to get share in the post-PNL also and share in the pre-PNL. It was going to be 2 lakh rupees. Okay, pre-PNL 1 lakh, 25% of 1 lakh, this is pre-PNL. Okay, share in the pre-general reserve also. 3 pre-general reserve, which is 60,000. They are going to get a share of 25% of that pre, and their share in the post P&L, which is 4 lakhs, from 1 lakh to 4 lakhs, 3 lakhs. And also there is a 60,000 loss I directly subtract. Or you can do post, you can also write share in the post general reserve. Pre-general reserve, post-general. Pre-P&L, post-P&L. Okay, pre-P&L, post-P&L. Similarly, you can have it as pre-general reserve and you can write it as a post-general reserve. Okay, for post-general reserve, then you will have to take two different amounts. Share in the post P&L will be 75,000. Then this sum will change a little bit. Instead of 60, we'll write 75,000. And share in the post P&L or share in the post general reserve will be minus 15. Then also the answer will come the same. Whatever you all are comfortable with, you all can solve it in that manner. Okay. Now next question is about the requirements of consolidation of subsidiary, which is an LLP or partnership. You all can just go through it, read it. It is important. Okay, they have asked this for 5 marks as a note, short note. And this is your latest paper question. Coming to that, the summarized balance sheet of H Limited and S Limited as on 31st March 2025 they have given. Share capital face value is 10. H Limited has 30 lakhs, 6 lakhs, reserves 4 lakh 80, 1 lakh 80, P&L 3 lakh 60, 2 lakh 40. Sundry assets 30 lakh, 10 lakh 20, and there are 48,000 shares taken in S Limited, the purchase considered. Okay, so out of 60,000, 48,000 belong to H. S Limited had reserves of 1,80,000 when H Limited acquired the shares in S Limited. Okay, so reserves were 1,80,000. Okay, so 1,80,000 is here, 1,80,000 is closing and open, same thing. Okay, so this is a pre-reserve. The balance, P&L balance of S Limited was fully earned after the acquisition of H. So it is post. P&L is post. Will not hit my cost of control or anything. S Limited decided to issue bonus shares of the post acquisition profit in the ratio of 1 share for every 10 shares. I'll calculate cost of control before and after bonus. I told you, this is the favorite question. Okay, so this is like your question number 6 answer. Same thing, cost of control before the issue of bonus share. Before the issue of the bonus share, basic purchase consideration paid, which is given, minus the shareholders items. What I am getting in shareholder item? 1, I am getting equity share capital, 48,000 shares of rupees 10 each, 4 lakh 80. Right? I am getting share in my reserves. What is the percentage holding? 48,000 divided by 60,000, 80% is the 80% holding. Okay, so share in the reserves, which is pre 1,80,000, they have told me only it is before the acquisition. So 1,80,000 is pre, so I'll take holding company share to the extent of 80%. That I will remove it. So I'm going to get cost of control in form of goodwill, that is before the bonus issue, 2,60,000. Now after the bonus issue, one thing will change. Equity share capital I'm getting, but I'm going to get bonus shares also now. So what is the bonus is to held ratio? If you are having 10 shares, you will get 1 share. So holding company has 60,000 shares. So they are giving how many shares as bonus? 6,000 shares as bonus. From that, holding company will get 80% because it is their holding. So 4,800 they are going to, from 6,000 they are going to get 4,800. The amount of bonus will be 48,000. 4,800 bonus shares. Right? So again same thing, amount of consideration paid given 8,40,000. Face value of the shares acquired 48,000. Why? Because initially I acquired 48,000 into 10. Share in the reserves, because they have told me my reserves is pre. Okay, so pre-reserves. So 2,16,000 I have arrived till here. Now less number of shares got in bonus. H limited share in the bonus issue. How many shares were issued in the bonus? 4,800 into 10, 48,000. So cost of control or goodwill after the bonus issue is 1,08,000. Okay. So this is it with your consolidation of accounts. Okay. You all also try to solve all these sums. Okay. All the important notes I have given it to you all, which is from the exam point of view, and all these were your exam questions. Okay. Even those previous ones which we solved, they were asked ever before when there was consolidation account was always there as a part of CS syllabus. So these are all the types of questions being asked for this particular chapter. Okay. So with this, I have completed consolidation for marathon. Go ahead, revise, all the best, try to solve all these sums in your own handwriting and in your books. You will definitely get a hang of it. You will be able to solve this even in the exam. Okay, thank you everyone. Bye. So, welcome everybody for this one more interesting and helpful marathon for corporate accounts. Okay, like we have already done some more previous marathons on important chapters from exam point of view. I am now coming up with another very important chapter. Trust me, with this chapter and the previous 3 marathons which I have already shared with you all, if you all do this, okay, out of your 60 marks of your corporate accounts, easily your 45 marks to 50 marks is being covered totally. Okay, so today this is my favorite chapter. Okay, it is ratio analysis. Okay, ratio analysis, it is one of my favorite chapters. Why? Because it really is very interesting. It is very helpful. Okay, it helps you understand the financials, P&L, balance sheet, trading, profit and loss account, everything we have been doing since a very long time, and we all know what it is. Okay, but to understand the financials from within, to understand how much actual profit or loss, or what is a return on the assets or on equity, how much is a debt, how much is our equity, in order to understand in details, ratio analysis is the most important management tool. Okay, so it in practical way, this is more often used. So if I am an investor and I want to invest, I would kindly go ahead and see all these financial ratios instead of just reading the P&L and the balance sheet, which just gives us the figures. Okay, we need to understand the relationship between the figures, right, of the entire financial statement. In this, I have prepared these notes. Okay, again the same way like how I have done for my previous marathon classes. I have already solved all the questions for you. Okay, so we are going to solve a few questions which I have taken from the module. There are some questions, then there are all the past exam questions until now covered, and there are some practice questions. Okay, those practice questions, they are in form of MCQs, because previously this paper was an OMR based. But I have kept those questions. Why? Because they are very useful, and now also they keep asking this type of questions, though it is a descriptive paper. They will not give you options, they will ask you to solve. That's the only difference. Okay, so we are going to solve those questions also, because based on that, they give big questions in the exam. So I am going to first take you all through all the ratios. I have made a list of all the ratios. Okay, I will explain you all the ratios quickly, and then we will go to the solving of the problems. Okay, this chapter is basically completely practical. Okay, there is no such theory to it. However, they might ask you for 2 to 5 marks to interpret a ratio, to give us the analysis based on the ratio you have done. So that you will have to understand and write it. So if you will know what this ratio is all about, you will be able to interpret the ratio also. Okay, so quickly I will take you all through to all the ratios. Important ones I will explain, and the others you all can just go through. Okay. So starting with the profit margin ratios. Now this part A, if you all have seen, I have written this as part A. Why? Because they are about profit margins. This is one of the most important types of ratios. They generally keep asking you gross profit margin, net profit margin, all those type of things. Okay. So gross profit margin means what? How much percentage of gross profit we have. Margin, we will always calculate the amount of gross profit we made upon the net sales or sales into 100. It is in form of percentage. Higher the ratio, better. That means you are making more profit against your sales. So your sales, your turnover can be 1000 crores. But if your gross profit is only 1 CR, that means you have got a lot of expenses. Correct? Then net profit margin is actually your net profit after tax. Everything you have completed paying upon your, again, sales or net sales into 100. Okay, so gross profit margin and net profit margin. Operating expenses ratio, again same thing, all your operating expenses which you are needing in your day to day, okay, yearly operation related, okay, to your sales. Not any other kind of operating expenses, only those which are related to your operations. Divide that by 6. Operating expense ratio. Then you have operating ratio. The difference between two of them is operating expense talks about all those operating expenses which have gone into your P&L. They are not a part of your trading and COGS. Okay, and operating ratio is your operating expenses plus your cost of goods sold. Divide that by sales into 100. Okay, so gross profit and net profit, because they talk about profits, obviously higher, more the better. Expenses ratio, lower the better. Okay, quickly I am moving to the next part, which is B, capital ratios. Okay, now in capital ratios, these ratios are also very important, this B section. Okay, in that the first one, return on investment. This is the favorite question of our institute. Return on capital employed, return on investment. Okay, return on capital employed means what? What is your actual amount of capital which you are using to run the business? Okay, or amount of, so your capital employed is nothing but your shareholders' funds, which is your equity share capital, preference share capital, your reserves and surplus, everything belonging to your shareholders, plus any kind of borrowed funds, capital employed. Okay, that ratio you can find only with the help of NPBIT, net profit before interest and tax. Which interest? Before long term and short term borrowing interest which we have. So we have to make an income statement. From there we will be able to take our NPBIT. Divide by capital employed into 100, again in form of percentage. If I tell you return on only shareholders funds, or I tell you return on net worth, means your own capital. Net profit after tax, because that is the profit which belongs to your shareholders. So net profit after tax upon shareholders funds into 100. Return on equity, net profit actually available for equity. Not necessarily this entire net profit after tax is available for only equity. You may have preference dividend also. So you will have to remove it. Then that will be net profit available only for equity shareholders. That divided by your equity shareholders funds, that will be your return on equity into 100. This is all again in form of percentage. Which net profit? Obviously net profit after tax minus preference dividend, if any. If there is no preference dividend, entire profit is for your shareholders. Return on total assets, again NPBIT. Okay, entire profit before interest and tax upon the total number of assets which you have taken and kept it in your organization and using it over the period of time. Okay, so that again in form of percentage. So return on total assets, return on equity, return on shareholders funds, and return on capital employed. 4 important capital related ratios, favorite for the institute and their questions. Okay, so I'm just giving you one format. Gross profit, whatever is your gross profit. How do you get your gross profit? You take sales or net sales minus your COGS. You get your gross profit. From there, you remove operating expenses and add your operating income. You'll get net profit before interest and tax minus your interest on short-term borrowing, NPBIT, interest on long-term borrowing. Generally, we do this only. It's short-term borrowing, long-term borrowing directly. They don't give you so much in detail. They will just give you a borrowing and interest rate. You subtract interest, you'll get net profit before tax minus the tax at whatever rate, net profit after tax. Preference dividend, net profit for equity shareholders. Okay, then you can give them equity dividend since there is profit. Balance you will transfer it to P&L account. Okay. Next is your liquidity ratios. Now, in case of liquidity, 2 important ratios are there. One is current ratio and one is liquid ratio. Current ratio means, are your assets, current assets, which are, what are your current assets? Those which are convertible within a period of 12 months. Okay. They will not stay in the balance sheet for years to come like fixed assets. Current ratio, your current assets like your debtors, your cash balance, your bank balance, your short-term investments, your stock, okay, bills receivable, okay, all that which are going to be within the 12 months that are going not to be there now. Okay, those are your assets. Like you will sell the stock, you will have debtors paying you, you'll have bills receivable received, cash and bank balance will change. So current assets upon current liabilities. You need to have 2 rupees in current assets against 1 rupee in your current liability. Only then I can say that this particular organization is liquid, is current. They are able to pay their liabilities with the help of their assets. It should not be other way around, of course. Then liquidity ratio, quick ratio. Quick ratio means what? All those current assets, okay, which are not quick, they cannot be easily converted into cash. Remove them. Okay, so from current assets, stock. Not necessary I will be able to sell it tomorrow. Prepaid expenses, fictitious asset. Fictitious. It does not have anything in it. It's in fact an expense. But we are writing it in the asset side. Okay. Upon current liabilities minus bank OD is not actually your current liability. Okay. It's like your overdraft facility. Your credit card facility. Right. So all the current assets but remove stock and prepaid expense, and from current liability, if there is any bank OD, this is known as short-term borrowings. Remove that. You will get the liquid ratio. So standard ratio is 1:1. And for current ratio, it is 2:1. Then there is absolute cash ratio. This is not very important, but I'll explain you what is absolute cash means. Cash and cash equivalents means cash in hand, cash at bank. Plus your short-term investments which can be easily converted into cash upon current liabilities. Again, it will be in form of is-to. Okay, there is no standard in this. And then there is defense interval ratio. Defense interval ratio is always in days. Means in how many days are you able to, pay your daily operating expenses, kind of. So you have your cash and bank balance plus your short-term investments. This is the amount of cash you actually have upon your daily operating expenses. That will be your defense interval ratio. Now these ratios, they don't generally ask, very rare, but I am explaining and keeping it to you. Okay. Then you have stability ratio. In stability, we have long-term and short-term stability. Long-term debt equity ratio. This is, without this, we will never be able to do any sum. Why? Because for every 2 rupees of debt, they say 1 rupee of equity is what is standard. Borrowed funds upon shareholders funds, debt equity ratio. This is the standard. Okay, so basically you should have 2 rupees of debt against your 1 of your own fund. Then you have capital gearing ratio, your fixed return bearing security. Okay. Divide by security not having fixed return. Which is your fixed return security? One is your borrowed funds, long-term debentures, bank loan, plus your preference share capital. Fixed return you have to pay them, whether you make profit or not. Divide by security not having fixed return, shareholders funds minus preference share capital. So this you all can go through it later, read it. Okay. Proprietary ratio, entire shareholders funds upon your total assets. Okay, how much of your own funds are you using against your total assets? That will give you the proprietary ratio in form of percentage. Proprietary, own. So own funds, shareholders funds is own funds upon total assets into 100. Standard is 60% is to 70% minimum. Okay. Come on. Next is your turnover ratios. Important. Turnover, everything relating to your revenue and sales. Okay, revenue, sales, one and the same thing. Okay. Capital turnover ratio. All these ratios you will find sales at the numerator. Turnover, it is always sales at the numerator. Capital turnover means sales upon capital employed. It will always be in dash times. 5 times, 4 times, 2 times. Okay. Asset turnover, how will you remember turnover? So sales upon, what is the word? Total asset. So sales upon total assets. Fixed asset turnover, if I tell you, I can remove these ratios in any form. Fixed asset turnover, sales upon fixed assets. So total assets, fixed assets, capital employed. Debtors turnover. Okay. Debtors turnover will be your credit sales. How is debtors generated? Not from all the sales, not from entire revenue. Only if you are selling goods on credit. So credit sales upon your average debtors plus bills receivable. Average means what? Opening plus closing divide by 2. If nothing is given as opening closing, then I will just take the figure which I have with me in the balance sheet. Okay. Stock turnover, same thing. Total cost of sales, or you will have COGS. Okay. Upon your average stock, opening stock plus closing stock divide by 2. Okay, you can have cost of sales or COGS, whatever they have given you. That will give you a stock turnover ratio. Creditors turnover ratio, it generates because of credit purchases, na? So credit purchases upon your average bills, payables and creditors. Dash number of times. And debtors collection. Now this based on your turnover. Now you have collection also. In how many days are you able to collect the debtors money? That means you will take your ratio of average debtors plus bills receivable divide by credit sales into, if it is 12 months or 2 weeks or days, whichever we will take. So debtors velocity lower the better. That means I am able to get money quicker. Okay, so I will get that collection period in number of days or weeks or in months. Okay, I have to just kind of turn the formula. See, it is the reverse. Average debtors plus bills receivable upon credit sales. Same is stock holding period. For how many days I keep the stock in the company before selling. So again, reverse. Average stock upon your COGS into 1252, 365, whatever is given in the question. Lower the better. And creditors payment period. In how many days I am able to pay my creditors. So average creditors plus bills receivable, or sorry, bills payable upon credit purchases into 1252 or 365. Higher the better. Means I am getting more time, more days or months to make the payment, or more credit period. So the greater the credit period, better for the company, right? Then investors ratios or market based related ratio. This is all about earning per share, dividend payout, all that. So earning per share is all the profit which is now available only for equity shareholders upon total number of equity shares. That will be your earning per share. Dividend per share will be the amount of total dividend upon number of shares. Dividend payout ratio is always in percentage. So total dividend upon the net profit for shareholders. Total dividend, how much dividend you are paying upon the total net profit available for equity shareholders will give you a dividend payout ratio. Price earning ratio, market price per share upon earning per share. This is lower the better. Means what? If this ratio is less, it means that I will be able to reach the market price faster with the help of this earning. Okay, earning per share means what? The company is availing this much of profit now for equity shareholders, divide by number of equity shares. That earning and market price, if I compare, how much times it will take to reach to that market price. So the less time it takes, it is better. And then dividend yield ratio is dividend per share upon market price per share. Higher the dividend yield ratio, that will be better. Earning, again, yield ratio means what? You will take dividend in the numerator, yield means market price. Earning yield ratio, earning in the numerator, earning per share, divide that by market price per share into percentage. Higher the better. Yield, higher the better. Price earning ratio, lower the better. Okay. Then see NPBIT interest, NPBT tax, net profit after tax, preference dividend, net profit for equity shareholders minus equity dividend transfer to P&L. Sales is what? COGS plus gross profit. These are certain important formulas. What is working capital? Working capital is your current assets minus your current liabilities. Okay, say if you do not have any kind of borrowed funds, there is nothing there in the borrowed funds, then you can say your working capital is nothing but shareholders funds minus fixed assets. This is used very rarely when borrowed funds is zero. Okay, so your shareholders funds minus your fixed assets will actually give you working capital. What is average stock opening plus closing? Divide by 2. And COGS is nothing but all your expenses relating to your trading. Okay, so opening stock plus purchases, then you might have some kind of wages, etc., all related to your trading account. Okay, so all those expenses minus your closing stock will give you your cost of goods sold. Net worth is nothing but your shareholders funds. Okay, equity share capital plus preference share capital plus your reserves and surplus. Okay, then you have some coverage ratios. These are not very important, but I'll just read them for you all. Interest coverage. How are you able to cover your interest with the help of your profit? Which profit? NPBIT. NPBIT upon interest. Preference dividend coverage. Preference dividend, you will take the profit just before preference dividend, that is NPAT upon preference dividend. Here you will take the profit just before interest, so NPBIT. Okay, here NPAT. Equity dividend coverage ratio, net profit for equity upon equity dividend, and total dividend coverage ratio will be net profit after tax upon equity dividend plus preference dividend. Okay, and debt interest service coverage ratio. Debt interest means, and service coverage ratio. So here your NPBIT plus your non-cash expense, which is depreciation, it actually does not have cash moving out, minus your tax. After you add depreciation, then remove the tax, whatever profit you get, divide that plus upon your interest upon installment of your principal amount, debt service. Okay, so this is it with your ratios. We will keep this file very much open over here and we will try to solve our given sums. Okay, so we are good to go now. All right, come on, let us read this question. The following data of Vishal Limited is available for the year ended 31st of March 2007. All right, share capital, there are 20 lakhs of equity shares of rupees 10 each. So rupees in lakhs, they have written it as 200 lakhs. Okay, general reserve 150 lakhs, investment allowance reserve 50 lakhs. Okay, then we have provision for dividend 10, provision for tax 84, 15% for the long term loan, which loan amount is 300 lakhs, profit before tax is 140. Calculate capital return employed, okay, and return on net worth and return on capital employed. Basically they are saying return on capital employed and return on net worth. Okay, fine. So now return on capital employed, I have given you all this formula. See here, return on capital employed, just the next one, B, capital ratio, NPBIT upon capital employed into 100. Okay, so I am just writing the formula and keeping here, NPBIT upon capital employed into 100, and return on net worth means your shareholders funds. So net profit after tax upon shareholders funds into 100. Okay, I am just writing this formula. Okay, these two formulas we have to use. Now for that I will need NPBIT, capital employed, NPAT and shareholders funds. Okay, so NPBIT, have they given me NPBIT? One second. Net profit before interest and tax? No. They have given me net profit before tax. This is given. So I will now start with, one second. I will start with, okay, I have made the statement. NPBIT minus interest. Interest will be 15% on 300 lakhs. Right? See, on 300 lakhs I will take 15%. That I know. NPBT is given to me. Tax is also given to me. Net profit after tax I got. Now if I want to go reverse, so this, when I go reverse, I will, net interest rate is given to me 45. No, 300 into 15% will be 45. So when I will go reverse, I will add this to 140 plus 45. Only then I will get, no, this 185. 185 minus 45 will give me 140. Since I am going reverse, I will change the sign. Net profit before tax plus interest will give me net profit before interest and tax here. So I got this NPBIT. I have NPAT. I need to know my capital employed and shareholders funds. What is shareholders funds? I have told you, share capital plus reserves and surplus. So let us see what is there in share capital. We have 200 lakhs. We have 150. We have investment allowance reserve also. So 200 is your share capital. Okay, so 200 is your share capital. 150 is your general reserve. Investment allowance reserve. 400 is my shareholders funds. And capital employed will be your shareholders funds plus your borrowed funds. Borrowed funds is only this 300. Shareholders funds we just calculated, 400 plus 300, 700. All my figures which I have to put now I have. NPBIT 185 upon 700 capital employed, percentage will be 26.43. Net profit after tax, they have given me 56. Shareholders funds we calculated into 114%. Such an interesting and easy sum, and this type of sums of 5 marks. You will not take more than 3 minutes to solve this. Okay, next question. From the following balance sheet, you are required to calculate current ratio, quick ratio, inventory turnover, average collection period assuming 360 days, owner's funds to the liability ratio. Okay. Now sales credit for the year is 4 lakhs. Gross profit is 1,60,000. In liability and capital, we have share capital, reserves, debentures, creditors, bills payable, other current liabilities, goodwill, plant, stock, debtors, cash and miscellaneous current assets. Okay. So, ignore this solution number and all that, okay. You just say focus on this. Question number 2 this is. Now current assets. We all know what is current assets. Current ratio is nothing but current assets upon current liabilities. Now in my question, what is current assets? Stock, then we have debtors, and then we have cash. Just added up 80,000 plus 45,000 plus 17,000 plus 8,000. Another some fixed current miscellaneous current assets is also there. All this 4 I will add, and my liabilities will be creditors, bills payables and other current liabilities 62. So I'm going to get 1,50,000 current assets. Current liabilities is 62,000. Okay. So I'll get 2.42. 2.42 is to 1 is my current assets upon current liabilities current ratio. Then they are telling me find the quick ratio. Quick ratio means liquid ratio. In case of liquid ratio, I need to know that from current liabilities I'll have to remove bank OD. But from current assets I'll have to remove stock also and prepaid expense also. So there are no prepaid expense, there is no bank OD. But yes, stock is there. How much is the stock? 80,000 here. So 1,50,000 minus 80 will be 70. Current liabilities will remain the same, 62. So my current ratio is 1.13 is to 1. Okay. Then we have inventory turnover ratio. Turnover ratio. Inventory turnover ratio means COGS upon average stock. Okay, now COGS they have not given me, but they have given me sales minus gross profit will give me my COGS. So sales figure is given to me here. Gross profit is also given to me. So COGS will be 4 lakhs minus 1,60,000. Average stock. Average means opening plus closing upon 2. But nothing is given to me. Opening, closing figures are not given to me. So whatever is given to me in the balance sheet, I will take it. Okay. I will take that only. So it is going to be 80,000. So 4 lakh minus 1,60,000. 4 lakhs minus 1,60,000 is 2,40,000. Okay. Divide that by 80,000. So it is going to be 3 times inventory turnover ratio. Then they are telling me to find average collection period assuming 360 days in a year. Okay, so average collection period will be that reverse of turnover. So it will be average debtors plus bills receivable upon credit sales. Now they have not given me anything whether, no, they have given me sales is all credit. Sorry, credit sales. So 4 lakhs. Average debtors plus bills receivable, they have not given opening closing. So I will take this debtors 45. So 45,000 upon 4 lakhs into, I told you can take 12, 52, 365 depending on what is given in the question. They have told me to take 360. So I will take 360. Debtors collection period will be 41 days approximately. You will get it in point, but you will have to write approximate. You have to write the proper number. It cannot be in fraction, days. So 45,000, divide that by 4 lakhs into 360. You will get 40.5. 41 days approximately. Round it up. And then the last ratio, which they are telling me. So we finished with current, quick, inventory, average, collection period. Owned funds to liability ratio. Okay, now in this case, they have not mentioned which liability and what liability. Okay, what I have done is owned funds to total liability I have taken. Shareholders funds. Shareholders funds will be only share capital plus reserves and surplus. So 2,50,000 upon total liability side. Okay, total liability side I have taken, which is 4,20,000. Whatever you are doing, if you are doing, own funds to liability means you are just taking these balance liabilities. Okay, where debentures, creditors, bills payable, other current liabilities, only this you are taking. Whatever you are doing, see to it that you write a note to it. Okay, so generally institutes don't ask this type of questions. I have just kept it over here and I am asking you why, because it's there in the module. So you can write over here now that we are assuming that the liability means the total of the liability side of the balance sheet. If you are taking only liabilities, that is long-term, short-term liabilities, then you can mention it like that and give the ratio. Okay. Okay, so this question is now over. Done. Now coming to question number 3. ABC has made plans for the next year. It is estimated the company will employ total assets of rupees 8 lakhs. 50% of these assets will be financed by borrowed capital with an interest rate of 16% per year. The direct costs for the year are estimated as 4,80,000 and all the operating expenses are rupees 80,000. The goods will be sold to the customers at 150% of the direct cost. Income tax rate 50%. Calculate net profit margin, return on assets, asset turnover, return on owner's equity. Ratios are okay. First I have to make my income statement. Okay, so in case of income statement, write your solution number 3. Okay, for income statement, first thing, what is my total assets? How much capital I will need? 8 lakhs rupees. They have told me that we need to employ total assets of 8 lakhs. That means this is the capital also I will need, right? So that 8 lakhs, they are saying 50% with borrowed funds, interest rate 16%. So 50% of 8 lakhs, 4 lakhs. That means balance 50% is shareholders' funds, equity share capital. They have not told me anything about preference share. So obviously this will be equity share capital. Direct expenses, they are saying it is 4,80,000. Okay. Now they are telling me the goods will be sold to the customers at 150% of the direct cost. Okay, direct cost is 80. No, sorry, 4,80,000. Okay, direct cost is 4,80,000. If I am selling goods, that means my sales will be 4,80,000 into 150%. Right, that will come to 7,20,000. That is my sales, that is my revenue. How did I get this? This is 150% of my direct cost. The direct cost is nothing but your COGS, cost of goods sold. Okay, which is 4,80,000. It's already given to us. Gross profit 2,40,000. Operating expense given again 80,000. Is there any operating income? Not given, 0. So net profit before interest and tax is 1,60,000. 2,40,000 minus 80, 1,60,000. Subtract interest from that. How will I get interest? 4 lakhs into 16%. 4 lakhs is my borrowed funds. So 4 lakhs into 16% is 64,000. Net profit before tax 96,000. Tax is given, is at the rate of 50%. 48,000 net profit after taxes here. So I have all the figures now which I will need in order to put it in my formula. Net profit margin, I told you, net profit after tax upon sales. Right, so net profit after tax, we just calculated 48,000. Sales is 7,20,000 into 100, 6.67%. Next, they are asking me return on assets. Return on assets means NPBIT upon your total assets. How much is my NPBIT? Here, NPBIT 1,60,000. Total assets which I need, we just did it here. This is the total assets which we will need. Capital employed. Kind of. Right? 8 lakhs into 100. So 20% return on assets. Asset turnover. Turnover means sales upon total assets. Sales is 7,20,000. Assets is 8 lakhs. 0.9 times. This is always in times. turnover ratios. Return on equity will be the profit available for equity shareholders. I think this will be the profit, net profit after tax itself. Profit available for equity shareholders upon the equity shareholders funds. Entire 4 lakhs is your equity shareholders funds. Nothing is given to me about reserves and surplus and anything. So that total 4 lakhs I am considering. Net profit for equity will be your net profit after tax only in our case, and divide by 4 lakhs into 100. 12% is net profit on equity. Okay, so we are done with this also question. Easy one, easy questions. If we will practice this, we'll be able to solve the past exam questions quickly. Past exam questions, no, in case of ratio analysis, always keep in mind, they will give you big question. They will write entire history, geography of some kind of a company who is not doing well, and now they want to revamp the company. This is something standard which they ask. Even in my time, when this paper was a descriptive paper, okay, ratio analysis used to be this type of questions. Don't get scared thinking, oh my god, such a big question. When you will solve, no, it will be hardly anything. So much of details are already given in the question. You have to pick the figures from there and put it in the formula. That is all. Okay. Now next, question number 4. I will not waste much time. We have lot of questions to be solved. Question number 4. From the given information of ABC, okay, they have told me working capital 1,20,000. Working capital means what? Current assets minus current liability. Reserves and surplus is 80, bank OD is 20. Fixed assets to the proprietary ratio is 0.75. Current ratio 2.5, liquid ratio. Now they have given me the ratio. So what they want from me? They want the assets, liabilities and stock. Okay, so now this is reverse ratios. Okay, basically they have given me the ratios. They are telling me to find the amounts. Until now we had the amounts and we were finding the ratios. Okay. Question number 4. Alright. I need to find assets, liabilities and stock. For assets, I can take this, no, current ratio. Current assets upon current liabilities. Let's start with something, no. Current ratio will be nothing but current assets upon current liabilities. Ratio is given to me as 2.5 upon I don't know current assets amount, I don't know current liabilities amount, but I can write it, no. Current assets is nothing but equal to 2.5 of current liability. This one equation I got it right. No, current liabilities, if we'll take on the other side, current assets will become equal to 2.5 of current liability. Next, they have given me something about working capital is 1,20,000. Working capital is nothing but current assets minus current liabilities. 1,20,000. Instead of current assets, I am writing 2.5 of current liability from this equation. Minus again current liability. 2.5 current liability minus 1 current liability will be 1.5. Take that 1.5 in the denominator on the other side. So 1,20,000 divided by 1.5 will give me my current liabilities, which is going to be 80,000. So current liability figure is given, that I can put it in this equation, 2.5 into 80,000. That will give me my current assets. So I got current assets, I got my current liabilities. Now in case of liquid ratio, I need stock, right? Liquid ratio is given. Current assets we just found out. Stock we don't know. Prepaid expenses is 0. Divide by current liabilities. Bank OD they have given to me 20,000. Now I can do it. Okay, this is going to become 60,000. So 1.5 into 60. I'll take it on the other side. And 2 lakhs minus stock. When I'll bring stock on this side, negative will become positive. 2 lakhs minus 60 into 1.5 is 19. So stock is going to be 1,10,000. Okay. So I got current assets, current liabilities and stock. Fixed asset proprietary, they are just given me to confuse. Okay, done. All the amounts are here. Fine. Now next question number 5. From the information of XYZ Limited, find the below. We have to find amount of sales, amount of fixed assets, capital employed, debtors, creditors, purchases, opening and closing stock. Everything we have to find. Okay. Stock turnover is 6. Fixed asset turnover is 4. Capital turnover is 2. Gross profit 20%. Debtors collection period 2 months. Creditors payment period 73 days. The gross profit is rupees 60,000. Closing stock is equal to 5,000 in excess of the opening stock. Okay. Fine. First I will start with whatever I have. I have got gross profit. Gross profit will help me find the sales amount. How? Gross profit margin ratio. Gross profit margin is nothing but gross profit upon net sales into 100. I don't know my net sales. So I'll bring that on the other side of the equal sign. Gross profit upon gross profit ratio. Gross profit is given. Gross profit ratio is also given. See? Here they have given me 20% and 60,000 of gross profit. That means my net sales is 3 lakhs. One thing is done. Since I have my sales, I have my gross profit. COGS is easy to find. Right? COGS will be how much? 3 lakhs minus 60,000. That will be my 2,40,000 as my COGS. Okay, I have done something which I know you all are little curious to know. Gross profit is 20% of the sales. I generally have a habit of writing this formula because you can use it. Whenever the profit is as a percentage of sales, assume sales as 100. If the profit is as a percentage of cost, then assume cost as 100. So if I am saying 20% of sales, that means 100 will be sales and 20 will be the profit. So what will be this remaining will be COGS. You can do cross multiplication and also find the COGS amount. Okay. Then we have fixed asset turnover. Asset turnover means sales upon fixed assets. Right. So now I have sales figure. They have given me this ratio. With that I can find my fixed asset. Turnover is 4. 3 lakhs is sale. Fixed assets. Fixed asset will be 3 lakhs upon 4. 75,000. Capital turnover, I have my turnover, sales. Ratio also they have given me 2. So with that capital employed will be 1,50,000. Okay. So basically I am done with finding sales amount. The moment I got my sales amount, I got my fixed asset also and I got my capital employed also. Now debtors and creditors. That I can do it with the help of the collection period. Okay. Debtors collection period is the reverse of the turnover. No? So average of debtors upon credit sales into 12 I will take because they have given to me in form of months. Debtors collection is 2 months. Average debtors means debtors only now. Okay. There is no opening closing over here. So debtors upon credit sales. Entire sales is assumed to be as credit. Into 12. So debtors will be what? 2 into 3 lakhs. Okay, 3 lakhs will go on the other side. 12 will come on this side. So it will be in form of division. So 2 into 3 lakhs divided by 12. Debtors will be 50,000. Similarly, I will do the creditors payment period. Nah, but creditors payment period, I don't know the creditors also and I don't know the purchases also. This they have given me 73 days. But what about purchases? We know one formula, no? COGS is opening stock plus purchases minus closing stock. Right? COGS we found out. Opening stock, assume it to be X. Assume opening stock as X. So X, purchases also I don't know. Closing stock will be what? It is 5,000 plus of the opening excess. Means 5,000 plus X, no? So opening stock plus 5,000 will be my closing stock. Okay, now 2,40,000 is equal to X plus purchases minus X minus 5,000. When you will open the bracket, okay, when you will open the bracket, it will become 2,40,000 will be X plus purchases minus X minus 5,000, right? So minus X plus X cancelled. This minus 5,000, if I'll take it on the other side, it will become plus, that will be equal to purchases. So 2,45,000 will be the purchase. So purchases I have, creditors I don't know, I know the credit collection period. Into 365 I'll take. Why? Because this is in days. Right? So 73 into 2,45,000, divide that by 365. $49,000 will be our creditors. Superb. So we got the figure of debtors and creditors also now. We got purchases also. Now opening stock and closing stock. Stock turnover ratio. Okay. Stock turnover ratio COGS upon average stock. Stock turnover ratio they have given me is 6. COGS is given. Or sorry, we have found out. Upon average stock. So average stock is 40. Why is 2,40,000 divided by 6? 40,000. Average stock is nothing but opening plus closing upon 2. Opening I had assumed X and closing will become X plus 5,000 upon 2. Right? Now average stock is 40,000. So 40,000 will be equal to X plus X will be 2X plus 5,000 upon 2. So this is going to become 80,000, 40,000 into 2. Okay, minus 5,000 will become 2X. So 75,000 divided by 2 will be equal to X. So 37,500 is going to be my opening stock. Therefore, closing stock will be 37,500 plus 5,000, 42,500. Okay. So, question number 5, question number 5 is also done, opening stock, closing stock. So, all this we have to just use in order to find the answer. Okay. Now, some practice questions I have taken. Quickly we'll solve. Okay. N Limited has a net working capital of 119 lakhs. Total liabilities is 225. Non-current liabilities is 140 lakhs. We have to find the current ratio. That means we need current assets and we need current liabilities. Okay. So, net working capital given, total liability given, non-current liability given. Current liabilities will be what? From total, if I will remove non-current, I'll get current. Both is given, no? Total is given, 225. And this is also given. Current liabilities is nothing but total liabilities minus non-current liabilities. Both is given, 225 minus 140. Okay. So 140 minus, it has to be 225 lakhs minus 140. That will give you 85 lakhs. I got my current liabilities. Okay. Now they have given me my net working capital. Working capital, I told you it is current assets minus current liabilities. You have net working capital, you have current liabilities. So current assets will become what? Working capital plus current liabilities. So current assets is 204 lakhs. Therefore, current ratio 204 upon 85, 2.4 is to 1. Okay. Next, Mahi Limited, they had a closing stock of 648 lakhs and prepaid expenses 32 lakhs. Total liquid assets are 1830 lakh. If liquid ratio is 1.5 is to 1, then working capital will be, for working capital again I need as current assets and current liability. Okay, now given is current closing stock they have given me. They have given me prepaid expense and they have given me liquid assets. and they have given me the liquid ratio. This is all given. I need to find working capital. For working capital, I'll need current assets and current liabilities. Okay. Now, what is current assets? Current assets will be all your liquid assets plus you do your stock plus your prepaid expense. So, liquid assets is given, stock is given, prepaid expense given. I got my total current assets. Now, I'll put this ratio. Liquid ratio is liquid assets upon liquid liabilities, which is equal to 1.5 is to 1, right? So, liquid ratio 1.5. Liquid assets means what? Current assets minus stock minus prepaid expense, okay, upon current liabilities. So, this current liabilities, I don't know. So, it will go in the liquid. There is no other kind of liquid bank OD or something. If bank OD is not there, if there is no bank OD, okay, so your current liabilities and liquid liabilities become the same thing, right? So 1.5 into current liabilities will be 2510, we found out, minus 648 minus 32. So 1830, divide that by 1.5. 1220 will be your current liabilities. So working capital, current assets minus current liabilities, 1290 lakh. You all can practice this sum again as homework. Okay. Following are the details of Beta Limited. Equity share capital 10 rupees each, 8% preference share, 12% debentures, profit before interest and tax, dividend payout ratio, price earning ratio is 25, corporate tax 30%. What will be the earning per share? For earning per share, I need to find the profit available for equity shareholders. Divide that by number of equity shares. Now, number of equity shares I'll get from here, 1500 lakhs. Divide by 10. 150 lakhs are the number of shares. Fine. So, particulars and amount in lakhs. I will start with profit before interest and tax is given to me. 590. Minus interest. Again, this is given 12% of 250. 30. Profit before tax. At the rate of tax, which is 30%, profit after tax. Preference dividend is 8% of 400. 8% of 400. 32. So, profit available for equity shareholders, 360 divided by number of shares, 150. So, 2.40 per share. From the following information, calculate net profit ratio. Gross profit is 1/4 of the cost, okay, and sales is rupees 2 lakhs. Indirect expenses is 12%. Okay, net profit ratio we need. Alright. Gross profit 1%, 1/4 of the cost. 1/4 means 25%. Sales given, indirect expense given. Cost plus gross profit will give me sales. COGS plus gross profit will give me sales. Okay, they are telling profit is 25% of the cost. So then I'll assume cost to be 100. This is 25. So sales will obviously become 125. They have given me the sales figure 2 lakhs. So what will be my gross profit? I'll cross multiply. Okay, 2 lakhs into 25 divide by 125. My gross profit is 40,000. Therefore, since I got my gross profit and they have given me all the indirect expenses, my net profit will be, from gross profit, I'll remove my indirect expense, 28,000. I have my net profit, I have my net sales. Net profit is 28, sales is 2 lakhs into 100, 14% is my net profit margin. Such easy sums. Next, from the following information pertaining to A, current ratio, asset test ratio, current liabilities 31 lakh. Find out the value of inventory stock. Okay. So current ratio is nothing, current assets upon current liabilities. So current assets into current liabilities is your, current ratio into current liabilities is current assets. Current liabilities they have given me, current ratio also they have given me. Therefore, current assets is 124 lakhs. Liquid ratio is nothing but current assets minus stock upon current liabilities. Liquid ratio is also given to me. Acid test ratio means liquid ratio. Okay. So, liquid ratio is equal to current assets minus stock upon current liabilities. Current liabilities is so given. Current assets we just found out 124 and assume stock to be X. Now solve this equation. 2.8 into 31, 124 minus X. Take X on the other side, it will become positive. 124 minus 2.8 into 31 is 86.8. So stock will be 37.2 lakhs. Okay. Next question. P Limited furnished the following information. COGS rupees 6 lakhs, net profit is 3 lakhs, sales return is 1 lakh. Okay. If the net profit margin is 25%, then what will be the gross profit margin? Net profit margin and net profit both is given. Net profit and net profit margin both is given. With that, I'll be able to find my sales. Right? Net profit margin is equal to net profit upon sales. So sales will be 3 lakhs upon 25%. Okay, 12 lakhs. So gross profit margin will be how much? Gross profit upon sales. Okay. Gross profit margin will be gross profit upon sales into 100. What is gross profit? Sales minus COGS. Sales is 12 lakhs. We just found out with the help of the formula. And COGS is 6 lakhs. So 12 lakhs minus 6 lakhs upon 12 lakhs. That will be 50%. Next question. Equity share capital 25 lakh rupees. Face value is 100. Profit for equity shareholders is 5 lakh 15,000 rupees. Earning per share is what? Profit available for equity shareholders 5 lakh 15,000. It is 5 lakh 15,000. Huh? Please correct it. Yes, it is 5 lakh 15,000. Number of equity shares will be how much? 25 lakhs divided by 100 is 25,000 shares. 20.60 per share will be my earning per share. Keeping this same information, dividend payout ratio is 40%. Price earning is 30 rupees. What will be the dividend per share? Dividend per share will be 40%. So earning per share I have already got, na? 20.6 into 40%. That will be my dividend per share. Whatever earning the shareholders are having per share, some is kept in form of dividend payout. 40% we are giving as dividend. So per share dividend will be 40% of 20.6. 8.24 per share will be the dividend payout. Okay. Now next, 9. Profit before interest and tax of AB Limited is 3 lakh 40. Their net fixed assets is 2 crore 10 lakhs. Working capital 27 lakh 70,000. What is the return on investments? NPBIT is given. Fixed assets are given. Working capital given. What is return on investments? NPBIT upon total capital employed, right? If capital employed is not given, I can take net fixed assets upon working capital. Same thing, it will make the total, no? Net fixed assets plus working capital is what? Current assets minus current liabilities, no? If you see this T form of the balance sheet, here first we have equity share capital, then borrowed funds, then we have current liabilities. Here we have fixed assets and we have current assets. Current assets minus current liabilities is working capital, and we take fixed assets over here. It will become the same thing, no? Capital employed. So 3,40,000 divided by 2 crore 10 lakhs plus 27 lakh 70,000. 2 crore 37 lakh 70,000. 1.43%. Yeah. Okay. Debtors velocity 3 months. Sales 25 lakhs. Bills receivable 60,000. Bills payable 36,667. How much is the sundry debtors? Okay, with the help of debtors velocity, average accounts receivable, that is average debtors plus bills receivable upon credit sales. Now this average debtors bills receivable, I'll say it is average, it's debtors amount. Okay, so debtors velocity is 3. I don't know this average accounts receivable. Credit sales is given to me 25 lakhs and I can take months, so it is 12 months. So 3 into 25 lakhs divided by 12 will be X. So I'll get average accounts receivable is 6,25,000. But they are not asking me average accounts receivable, they are asking me debtors. Okay, they are asking me the amount of debtors. So average accounts receivable, or you can say accounts receivable, is nothing but debtors plus bills receivable. Now accounts receivable we just found out, 6,25,000. Debtors they are asking me to find, and bills receivable they have already given it to me. So 6,25,000 minus 60,000 will be my debtors amount. Therefore, it will be 5,65,000. It is an important sum. Why important? Because we miss out on these small details sometimes. It's given very much in the question. We have to apply. Okay. Next, EXE Limited, 31st March 2017. Opening stock is given, closing cost of goods sold, stock turnover ratio. What is stock turnover ratio? COGS upon average stock. Average stock, so I can take it from your only opening plus closing divide by 2. That will be 30,000. COGS is given 8 times. So simple. Okay. Now coming to the past exam questions. Alright. Now past exam questions are also very easy. They are big questions, but it's okay. We will be all able to solve it. Okay. When you will solve, you will feel, oh, it's so simple. Okay. Come on. Let's read it. Komal is a third generation businesswoman in the dairy business of Bharat Ghee and Company. The business is run under the brand Pure Ghee. Okay. Company prepares milk-based products and is known for quality in the market. The sales are made through self-owned stores, other retailers at location where self-owned stores are not present, and they are online. The business is run by Komal's family on strategic and operational basis. However, now the business is growing at a rapid pace. There is a need to get in professional management to run this business. Bharat Ghee and Company hires a new CEO, Garima, who has 3 decades of experience in this industry. Okay, Komal will now be executive chairman and provide a guiding role in the business. The first task that Garima has on the hand is to identify the issue that are hindering the business growth. Komal asked Garima to list the major concerns that the business is facing. They are facing lower margins where sales are made through other retailers and online because online platform are charging commission for making sales. High chance of spoilage because it is a perishable product. Capacity increase may be necessitated in the near future, for which capital will have to be raised. Garima requests the accounts head Naina for key financial metrics of Bharat and Company. Naina provides these following details to Garima. So now the question starts. Key financials of Bharat Ghee and Company, credit revenue and cash revenue. So total revenue is 80 CR plus 20% of total sales. Okay, cash revenue is 20%. That means total sales is, say it is 100. Okay, so 20% of, so this is going to be balance 80%, no? Correct. So 80% is 80 CR. So 20% will be how much? 20 CR. Gross profit is 30%. Indirect expenses 10 CR. Tax rate 25%. Interest on debt is 12%, and interest amount is 12 crore. Debt equity ratio 2:1. Okay, everything is given. Garima does some quick calculations to derive what is the return on equity and return on capital employed. Komal indicates willingness to contribute fresh equity in the business and pay off the loans. However, Garima is not in the favor of repayment of loans. Garima has made a business plan to change this strategy to decrease dependence from the third-party vendors. New plan recommends creation of infrastructure to enable the locations which are serviced by channel partners. A new strategic business unit has to be created for implementation of this business plan. So this unit will require certain facilities, infrastructure facilities, cold chain warehousing 15 crore, new trucks 5 crore, office premises 3 crore, furniture and computers 1 crore. This aforementioned infrastructure will be set up using debt and equity in the ratio of 2:1. The new debt is raised at 14% rate of interest. Average depreciation 30%. The investment of the debt is done on 1st October and company follows April to March as their financial year. Average receivables at the end of the financial year from the new business will be 10 crore 80 lakhs. Receivables turnover days is 45 days. Assume 180 days to calculate receivables turnover ratio. The gross profit margin again 20%. Indirect expenses other than depreciation 2 crore. Income tax rate is 25%. Okay, so now all these details which are given is for this new project, okay, and infrastructure. Komal asked for the projected P&L before approving the required investment amount. First, calculate net profit margin, return on equity, return on capital employed. Okay. If debt is paid off using fresh equity, then what will be the new profit margin and return on equity? Assume debt is paid on the first day of the financial and then comment on the change on return on equity. Prepare projected profit and loss account of the new business unit. You see, this is for 15 marks. Compulsory question. So 15 marks here. 15 marks I have already done with your issue of shares. Another 10-15 marks we have done with consolidation. Okay, so 45 plus 5 marks of your cash flow. 50 marks is already been solved in your marathons. Okay, so now understand one thing. Okay, this is question number 2. So this is your first question. In my first question, whatever ratios I want, I can take it only from here. Okay, so I have made this in the books of Bharatgi. First we will solve what? We will first try to calculate net profit margin, return on capital employed and return on equity. I am focusing on my question number A. This one. Profit margin, return on equity and capital employed. Okay. Everything I have written over here. Now cash sales and credit sales. They have given me credit sales as 80%. Okay. So balance 20% will be the cash sales. No. I'm keeping this open over here. We are referring to this table right now. So 80 crores is my credit sales, which is 80%. So 20% will be how much? Obviously 20 crores. So total sales is 100 crores. Done. Easy. Gross profit they have given me, it is 30% of my total sales. So simple, 100 CR into 30%, 30 crores. Here, I used this, no, 30%. This is done, this is done, this is done. From my gross profit, if I remove my indirect expense, I will get my profit before interest and tax. Indirect expense 10 CR is given. Remove it, minus it. Profit before interest and tax 20 CR. Less interest on debt. Even that they have calculated. See, interest amount 12 crore. Interest rate is 12%. Very good. So 12% it is already given to me. Profit before tax 8 CR. Right? Profit before tax is 8 CR. Less tax 25%. Again this is given to me. So 2 CR. Profit before tax is 8 CR. Minus 2 CR. 6 CR is my net profit after tax. Now I need to know how much is the debt and how much is the equity. That amount is not given. Debt equity ratio is given. Debt amount, how will I come to know? When I know the interest amount. Okay, whenever I calculate interest, what I do, interest amount, how I get? I say debt amount, debt into interest rate, right? Now debt amount I have. Okay, interest amount I have, debt I don't know, interest rate also I have. So what I will do, amount upon the interest rate, I will get the debt amount. Na? That is what I have done. Interest divided by interest rate, interest amount, divide that by the interest rate. So it will be 12 CR. Interest amount divide by 12%. 100 CR is your debt. Okay. And debt equity ratio is 2:1. That means for every 2 of debt, you have 1 of equity. That means 50%. So if debt is 100, so how much will be my equity? 100 divided by 250. So debt equity ratio is 2:1. Therefore my equity will be 50 crores. So 100 crores plus 50 crores is my total capital employed 150 CR. Now I have everything with me to find the ratios, 3 ratios. Net profit margin, net profit after tax upon total sales. What is net profit after tax? 6 CR upon total sales. Total sales is here 100. 6 upon 100, 6%. Return on equity will be profit after tax upon total equity. Net profit after tax 6 CR. Total equity is 50 CR. 12%. 6 divided by 50. 12%. Return on capital employed is NPBIT. Net profit before interest and tax. That is how much? 20 CR. Net profit before interest and tax is 20 CR. Year. This one. Net profit before interest and tax divided by total capital employed. We calculated here 150. See, 20 divided by 150 percentage, 13.33%. Done. Your first is over. Question number A. All the 3 ratios are done. Same thing. Now they are asking me that say on the first day we paid the debt. So now there is no debt. So then now what will be the new profit margin and return on equity? Okay. So same thing. I have made it again. See, cash sales, credit sales, total sales 100 CR. Gross profit 30% of the total sales 30 CR. Less indirect expenses. Net profit before interest and tax. Interest will be nil now because we have paid the loan on the first day. So profit before tax and profit before interest and tax, same thing, 20 CR. Tax will be 25%, which is 5 crores. Profit after tax amount will change, 15 CR it will become now. Loan is repaid, so debt is 0. Therefore total equity will be 150 now. So net profit margin will be net profit after tax, which is 15 crore, divided by total sales, so will remain 100 only. So 15 divided by 100 is 15%. Return on equity will be your profit after tax upon your total equity. How much is your profit after tax? 15 CR. Total equity is 150. 10%. Easy? Okay, now we have to compare the ratio. What has happened? Comment on the change of return on equity. Now return of equity, when there was debt, I had 12%. But now it has become 10%. Why so? Because you have repayment the debt. Since your debt is repaid, your number of shareholders also have become more. And there is no interest, so that you can get some tax benefit. See this. Tax is 5 crores. right? Over there, how much tax was there? Okay, less tax, 2 crore. So you do not get any tax benefit also, na? Since we do not get any tax benefit, obviously we will have a less. That is why debt equity ratio is 2:1. That is ideal. As there is no interest, the tax benefit is also not there. Therefore, there is a decline in the return on equity. You can write in your own words whatever you feel correct. Okay. So number B is also done. Easy now? Now see, they are telling me projected P&L of new business unit. Okay. Fine. So I will come to the new business unit over here. Okay. Now new business unit, how much is the capital needed? 15 plus 5, 20 plus 3, 23 plus 1, 24. 24 crores I need, and that they are telling do it in the form of 2:1. 2 for debt, 1 for equity. That means 16 lakhs, 16 crore debt, 8 crores equity. That debt is going to be at the rate of 14%. Okay. So projected P&L of the new business unit. Okay. We'll have to do turnover, whatever is the turnover. That means sales, total sales minus gross profit. Have they given me the gross profit ratio? Yes, they have given me gross profit ratio also. Then from there I will have to remove my depreciation, and other indirect expenses are given. Other indirect expenses is given, but depreciation I'll have to find. Sales I don't know, I'll have to find. Gross profit is given. Then interest amount also I'll have to find. All this I'll have to do as form of working note. So first I'm taking you all through the working note, okay? Alright. Now how will I find my turnover? Turnover will be nothing but they have given me average receivables. See, they have told me that average receivables for this new business unit is 10 crore 80 lakhs, and the receivables turnovers days is 45 days, and they have assumed 180 days to calculate this. That means what? Your average receivables is given, receivable days is given. What is your receivables turnover ratio? 180 divided by 45 turnover. How many days times are you turning over your receivables? 4 times. Okay. So your average receivables into your receivables turnover ratio. I can find my receivables turnover ratio, right? So in that case, 180 divided by 5 is 4. I got this. Average receivables is given to me. Therefore, my turnover will be how much? 43 lakhs 20,000. Sorry, 43 crore 20 lakhs. So I get my turnover 43 crore 20 lakhs. Gross profit 20% is given. Therefore, this is to 8 crore 64. Now, capital investment and depreciation. They have told me depreciation is 30%, but I'll have to calculate. My total assets are 24 crores. Depreciation rate is given 30%, but all this has happened on first day of October. The above investment and raising of debt both has happened on first day of October. So depreciation also will be from 1st October to 31st March for 6 months. Therefore, amount of depreciation will now be only 3 crore 60 lakhs. 6 months only. Indirect expenses 2 crores is given. Therefore, profit before interest and tax will be 3 crore 4 lakhs. Now, interest working note. Calculation of capital structure and interest. Debt equity given 2:4. Total amount of capital is 24 required, I told you. So, debt will be 16. Equity will be 8. Interest is 14% of 16 crore. 2 crore 24 lakhs. But this is for full year, 1 year. Right? I need only for 6 months because from 1st October. So it will be half, 1 crore 12 lakhs. So your interest figure also 1 crore 12 lakhs. Profit before tax is 1 crore 92 lakhs. Income tax rate is 25%. Therefore, profit after tax is 1 crore 44 lakhs. That is the estimated P&L of the new business unit. All three done. Okay, so though the question looks very big, but everything is there in the question. We have to just put and solve it. Only this was tricky. Average receivables and receivables turnover. So your turnover times 180 divided by 44. 4 times, that means your turnover will be 4 into this receivables 10 crore 80 lakhs to get your turnover in that. Okay, this was only tricky I think in this sum. Otherwise everything was fine. Question number 2, very easy. Opening inventory, purchases minus closing, sales, sales return. We have to calculate inventory turnover ratio and gross profit ratio. Okay. Cost of goods sold. Gross profit ratio, I'll need COGS. Opening inventory plus closing minus plus purchases minus closing. I'll get my COGS. Opening given, purchases given, closing is given. COGS is 9 lakhs. Okay. Average inventory will be what? Opening plus closing upon 2. Opening is also given, closing is also given. Divide that by 2, I'll get average inventory. So I have my COGS and I have my average inventory. So inventory turnover ratio will be COGS upon average inventory. 3.43 times. Easy. Okay. Now sales and sales return both they have given me. Therefore my net sales will be how much? 15 lakhs. 15 lakhs 60,000 minus 60,000. My net sales will be 15 lakhs. Gross profit will be net sales minus COGS 6 lakhs. Therefore gross profit margin will be gross profit upon net sales. 6 lakhs divided by 15 lakhs 40%. Okay, so both done. Easy sum. 3 marks. Okay. Now question number 3. Again some big sum is come. Okay. Prabhuji is the first generation entrepreneur engaged in bakery business. He is the proprietor of B& Sons, a Mumbai-based concern manufacturing bakery products, confectionaries and sweets. Products are manufactured and sold in a wholesale and retailer under a brand name of Bread and More. Products are essentially sold to retailers who would sell that to the final customers. Okay. Since the year 2020, the next generation of Prabhuji's family started participating in the business. New generation is technologically aware and suggested direct sales to the customers through online channels, omni online channels. The bakery brand was also known locally. However, due to sales online and due to good quality of the products, the bakery products started gaining traction nationally. Demand for the products increased. As a result, there was a need to increase the manufacturing capacity. See, something similar which we did with that Komal and Naina and Garima ghee business. The new members in the business suggested borrowing or setting up a special purpose vehicle for new manufacturing unit. Private equity players can then invest into this SPV. Prabhuji is conservative businessman while not being averse to expansion. Prabhuji suggests minimizing the need of external finance while relying more on internal accruals. Okay. Some financial details. Inventory 1st April 22 and inventory 31st March 23. Opening. This is closing. Revenues means sales. Okay, so total sales is 25 lakhs, out of which 80% is on credit. Purchase, wages, carriage inwards. Receivables, opening. This is closing. Total assets, administration expenses. We have depreciation, finance charges, interest. Total debt, total equity and tax. Everything is just given to us. What they want from us. Let's read. Jimisha is a financial expert and a consultant and is a school friend of Prabhuji. One of the key questions was improvement in cash flow. Jimisha made a suggestion regarding study of working capital management. A number of firms ignored the funds balance in working capital. Prabhuji was also concerned about the return on the funds invested in the business as capital. Jimisha advised Prabhuji to use DuPont analysis to check whether funds are used efficiently. Prabhuji mentions the increase in demand and possible need to increase the capacity. The various options are available to meet the demand. Either you outsource the productivity to the third party. Second option is expand the production capacity and incur a new certain capital expenditure. There are concerns around the manufacturing quality if production is outsourced. The cost of additional capacity is likely to be substantial. A capex capital of 5 lakhs, financed by 80% debt and 10% in the remaining. Okay, 80% debt rate by 10% interest. Remaining through equity share is required. Financial projection is as follows. Currently, the revenue was standing at 25 CR. New it will increase by 30%. Total assets 24. New will be 26. Administration expenses 2 lakh 50, which is given. 2 lakh 75 will be new. Depreciation new will be 3 lakhs. Financial charges 50,000 will stay, but plus interest on the new debt. Total equity 20 lakhs. New equity amount. Total debt is 4 lakhs. Tax 30-30. Gross profit ratio remains the same as previous year. On the basis of the information, answer the following questions. Calculate inventory turnover, average collection period, and then interpret the ratios. Then calculate return on equity by using DuPont analysis. Comment on how this can be improved, and then prepare estimated P&L account and what will be the owner's capital as on 31st March 24. Again 3 questions. Okay, fine. In the books of B and Sons, first thing they want inventory turnover ratio. Alright, inventory turnover ratio is COGS upon average inventory. COGS I can easily find. Average inventory is opening plus closing divide by 2. So first let us find COGS. COGS is opening stock. I'll keep this table here. Here. Everything is over here for COGS. So opening stock 1 lakh, add purchases, add all the direct expenses, which is wages, carriage inwards, add it, minus your closing stock. That will give you a COGS which is 17 lakhs. Average inventory opening plus closing upon 2, 1 lakh plus 2 lakh upon 2, 1 lakh 50. So COGS upon average inventory 11.33 times is my average inventory turnover ratio. Receivables turnover ratio, credit sales upon average receivable. How much will be the credit sales? They have told me my revenue is 25, 80% is on credit. So 25 lakhs into 80%, 20 lakhs. And average receivables will be opening plus closing upon 2, both is given to me, opening, closing. 2 lakh 50 plus 3 lakh divided by 2, 2 lakh 75. So 20 lakhs divided by 2 lakh 75, 7.273 times. So simple. Okay. Then they have told me to calculate what? Average collection period, no? Inventory turnover and average collection period. So average collection period will be 365 days. Number of days. 1 minute. Okay. 365 days upon the receivables turnover, which we just found out. Average collection period. It is same, no? We have to just do 365 upon receivables turnover. So it is going to be 50.19, so it's approximately 51 days. Now, after doing this, they are saying interpret the ratios. Now, interpretation I have given it to you all over here. You can write in your own words. First one is your inventory turnover ratio, which is 11.33 times. This has a room of improvement. Means what? Inventory are in the godown. They're staying for 365 divided by 11.33, 32 days. So they should aim to reduce the inventory days with better planning of raw material utilization and demand in the market, right? Average collection period is almost approximately 50 days. So it takes 50 days to collect on the credit sales. Receivables are on the higher side. 50 days means almost you can say you are closing at 2 months. Planning should be done to improve the collection. Factoring as a strategy can be used to sell your receivables. Okay. Now you have to find return on equity based on the DuPont analysis. DuPont analysis return on equity formula is net profit margin into asset turnover into financial leverage. Okay, asset turnover. Net profit margin we know. We know how to find asset turnover, and financial leverage is also there. Now net profit margin means net profit upon total revenue into 100. What is net profit? Sales minus COGS minus operating expenses. Okay. We already found out. We already found out COGS. We have the amount of sales which is 25 lakhs. COGS we just did 17 lakhs. What are the operating expenses? Operating expenses will be your administrative expense. Okay. Then your depreciation. So this is your operating expenses. Administration expenses. And your financial charges, operating expense. All this your P&L items. Okay, minus your tax rate. That is what we do, no? COGS minus all your operating expenses. Then you will get net profit before interest and tax. Right? Now interest is covered over here only. Financial charges. Okay, so directly this is net profit before tax minus tax. So COGS minus operating expense total is 5 lakhs. 2 lakh 50, 2 lakhs plus 50. 5 lakhs. Minus tax rate is 30%. So whatever you will get over here, 25 lakhs minus 17 lakhs minus 5 lakhs. So for 3 lakhs minus 30%, 2 lakh 10,000 upon 25 lakhs into 100. So your net profit margin is 8.40. That is A. Operating expense I have given over here. Asset turnover means sales upon total assets. Right? Now tell me total assets they have given me. Yes. They have very much given me over here. 24 lakhs. Sales 25 lakhs. Both is given. So 25 lakhs upon 24 lakhs. 1.042 B. Financial leverage is nothing but your total assets upon your total equity. How much is the total assets? 24 lakhs. Total equity again given over here. So your financial leverage is 1.20. All these three ratios you will multiply. 8.40. It will be in the form of percentage only, but multiply these numbers first. 8.40 into 1.04 into 1.20, 10.5% return on equity as per your DuPont analysis. Okay. So this is done. Then return on equity calculated, an improvement can be made in this. Again they have asked us to comment, no? So how you can make an improvement? By improving the utilization of the asset. Since asset turnover ratio is on the lower side, operation needs to be studied for efficiency. Increase in asset turnover will improve the expected return on equity. Small amount of debt increase on balance sheet could help the firm. Increase your financial leverage. Okay, then you will have a better return on equity. Passing on some of the cost to the customers through minor price increases can make the organization more effective. Therefore, since you will have a little bit more price charge, your net profit will also increase. So all the three ratios need to be improved in order to have a better return on equity. Lastly, we have to do the estimated P&L based on this. Current, and now we have to find the new. You have given me current, I have to find the new one. So particulars financial year 22-23, 23-24, and I have done the comments. Revenue 25 lakhs was there. They are telling me that it will increase by 30%. So plus 30% will be 32 lakh 50,000. Okay. Now gross profit margin, they say they will remain the same like previous year. So in the previous year, what was my gross profit margin? What was my gross profit first thing? How much was my COGS? 17 lakhs, no? So 25 lakhs minus 17 lakhs. My gross profit was 8 lakhs. Okay, so 8 lakhs divided by 25 lakhs. What is the percentage? 32%. They are saying this percentage will not change. So now also I will use 32% only. 32% of 32 lakh 50,000. So that will give me, see, my gross profit was 8 lakhs, no? Sales minus COGS. I have done it here only for you. So it will be 10 lakh 40,000, 32 lakh 50, 32 lakh 50,000 into 32%, 10 lakh 40,000. Administration expenses, earlier it was 2 lakh 50, now it has become 2 lakh 75. This is given. Depreciation was 2 lakhs, now it's become 3 lakhs. This is also given. So my NPBIT, earnings before interest and tax, earlier it was 3 lakh 50, now it is 4 lakh 75. Financial charges was 50 and now it will be 50 plus interest on new debt. Okay. So how much is my new debt? How much debt am I taking? Okay. They are saying capex of 5 lakhs. That will be 80% of debt with 10% interest rate. So 5 lakhs into 80% is 4 lakhs. On 4 lakhs, if I say 10% is my interest, that is 40,000. So now my new interest will be 50 plus that 40. Additional that 10% of 4 lakhs, 90,000 here. So earnings before tax, 3 lakh and 3 lakh 75. Tax rate is same, 30%. So profit after tax. Okay, estimated PNL. Owner's capital as on 31st of March 2024. Equity share capital as on 1st of April was 20 lakhs. They have given me on 1st of April 22. That means 31st of March. 1st of April 2023. It is 20 lakhs. Yeah. Then profit for the year which I made, 2,62,500 PNL account. And additional equity which I raised, 5 lakhs. From that 5 lakhs, 80% was debt. That means balance was equity, no? So this also I will add. So total owner's equity or owner's capital is going to be 23,62,500. Okay, everybody. So we have done this also question now. Owner's equity, profit. All this is done. I have given you all in the answers. Okay. Now coming to question number 4. Following information is provided for X Limited. They have given me a balance sheet. Okay. Shareholders funds. Equity share capital divided in shares of face value 10 each. X amount for equity share capital. And preference share capital divided as shares of face value 1000 each, X amount. So total X plus XX. In reserves and surplus, we have general reserve and PNL. 7,800 plus 15,000, 22,800 reserves and surplus amount we have. In non-current liabilities, we have only long-term borrowings. They have not told us how much. In current liabilities, okay, sorry, this has just become a little here. Short-term borrowings, okay, current liabilities is 5,000. Okay. No, 1 second. Short-term borrowings. Okay, this is your short-term borrowings. This is your trade payables. This is your short-term provision, and this is your outstanding expenses. Okay, so total of your current liabilities is 8,600. Then in case of non-current assets, you have property, plant and equipment 30, intangible assets 1,000 and capital work in progress 2,500. So total is coming to 33,500. Non-current investments they have not given. In current assets, inventories they have not given. Trade receivables, cash and cash equivalent they have given. So now total also we will not know. We have to complete the balance sheet with all these other information. Investments are fixed income securities and they have an interest rate of 8%. The payout of interest amount is rupees 100 lakhs. Inventory turnover ratio is 5. COGS is 15,000 lakhs. Opening and closing inventory figures are same. Equity share capital of rupees 10 each is twice of preference share capital. Equity share capital is 2 times of preference share capital. Long-term borrowings have an interest payout, interest amount of 1,000 lakhs and rate of interest is 10%. Okay, easy it is, simple. It looks little difficult but it is fine. First I will find out my non-current investment. Very simple, no? Because they have given me my interest received on non-current investment amount is 1,000 lakhs. Rate of interest is 8%. So non-current investment will be interest amount upon interest rate. I have shown you all this before also. Interest amount is 100 lakhs and interest rate is 8%. So 1250 lakh. So in my this balance sheet, non-current investment is done. Inventory turnover ratio is 5 given. COGS given. Average inventory I don't know. So average inventory will be 15,000 upon 5, 3,000 lakh. And they have told me opening closing is the same. So here also I will write 3,000. So 3,000 plus 5,000 plus 300. This total I will bring it here. So now I know it 8,300. So current assets total I know, current asset side 33,500 plus 1250 plus 8,300. Total will be 43,050. So if asset side is total 43,050, liability side total also has to be 43,050. Chalo, no problem. Next is, so total of the asset side I have done. Non-current assets given, non-current investment and current assets. Okay, 8,300 it is. 8,300. Done. Now long-term borrowings I can find in case of current liabilities. Once I have this, no? So I know the total, I know current liabilities, I know everything, I can just find this. And non-current liabilities, they have given me the interest amount and they have given me the interest rate. Super. Interest amount and interest rate will give me the figure for the long-term borrowings. How much it is? 1,000 divided by 10%. 10,000 lakhs. Simple. Put it over here. 10,000. So from 43,050, remove 8,600. Remove 10,000. And remove 22,800. All these figures, no, remove it. Remove this, and remove this from 43,050. So your shareholders funds will become, not shareholders funds, your equity share capital and preference share capital will become 1650. See? Equity share capital. Balance sheet liability side total also has to be this. That will be what? Your shareholders capital, own funds, owners capital, not shareholders funds. I will say owner's capital. Owner's capital plus long-term borrowings, own capital, plus long-term borrowings, plus reserves and surplus given, current liabilities is given. So your owner's capital own capital is going to be 1650. That means equity share capital plus preference share capital is equal to 1650. In that, equity share capital is nothing but 2 times of preference share. So now I am putting 2 times preference share plus preference share 1650. So 3 times preference share is 1650. Preference share is 550 lakhs. Therefore, equity share capital will be 1650 minus 550, 1100 lakhs. So this is going to be 1100. This will be 550. So this total will become 1650. Balance sheet is done. Okay. Equity share capital. There is one extra zero here. Sorry. Remove it, please. I'm extremely sorry. 1100 plus 550, 1650. Reserves and surplus given. General reserve P&L. Okay, so total of the shareholders fund is 24,450. In non-current liabilities, we found out this is 10,000. In current liabilities, this is trade payables, short-term provisions, other expenses and short-term borrowings. 8,600 total. 43,050. Same, you have to just copy paste your entire balance sheet. Plant, equipment, intangible assets, work in progress, non-current investments we found out, inventories also we found out, all this else is given. 43,050 tallied. Obviously it will tally. That is how we have done the sum. Okay, just we have to fill in the entire blanks. Calculate net profit margin from the given information. Revenue from operations, that is sales, turnover. Cost of operations 10 lakhs. Selling expenses, administrative expenses, depreciation, interest, other income and tax rate is 30%. Okay. Okay. Net profit margin is net profit upon total revenue. Sales is 17 lakhs given. Cost of sales 10 lakhs. Gross profit is 7 lakhs. From there, remove selling expense, remove administrative expense, EBI, earning before interest, tax, depreciation and amortization. Remove depreciation given. Interest before EBIT before means in earnings before interest and tax is 2 lakhs. Minus interest, this is also given. EBT is 1,50,000. But there is something over here, other income. So earnings before tax plus I will have to add this other income. So your actual earning before tax is 1,95,000. On that I will apply tax rate. Okay, so this was one small tiny thing. If you would have forgotten this, you would have directly done earnings before tax. Tax rate 30% on 1,50,000. No, you will have to add this other income. Okay. So your net profit margin is what? Net profit upon your total revenue. So your net profit includes this profit 50,000. So your revenue will also include this 45,000. Okay. So your revenue will also include, no, when you make this P&L, when you make this profit and loss, you write your gross profit here. You also will write your other income, na? So basically your total revenue will include everything, no? Your sales plus your other income. So net profit is 1,36,500 after tax. Upon total revenue will be 17 lakhs plus 45,000. Okay, so 7.82%. Total revenue and not net profit includes other income. This is given in your guideline answers with the note. Okay. Next. Okay, following summarized balance sheet, following summarized statement, P&L and balance sheet is given of ABC for year ended 31st of March. Amount in crores, sales, add back other income, less cost of sales, you get gross profit margin excluding other incomes. Okay. Okay, so sales minus cost of sales, they have taken gross profit. See, 144 minus 110.02, 33.98 na. 144 minus 110.02. Yes, this they have taken sales minus cost of sales. Yes, only then you will get gross profit. Other income is going in the P&L item. No, it is in gross profit, then you add this other income. In operating expenses, you have administration, selling and distribution. You get profit before interest and tax. Minus interest, you get profit before tax. Then you have provision for tax, profit after tax. In case of balance sheet, we have fixed assets 37.5. In current assets, inventory, receivable, cash at bank. Current liability is 11.25. So your net current assets is 22.57. Okay. Total assets will be 60.07. Why total assets? Net current assets plus your fixed assets. Liabilities and owner's equity, they have given separately. Share capital, reserves and surplus and long-term debt. So your total is again 60.07. We have to find current ratio, liquid ratio, gross profit margin ratio, net profit margin ratio, return on equity. Okay. Okay. Current ratio is what? Current assets upon current liabilities. They have given me my current assets here. Inventory, accounts receivable and cash at bank. 1, 2 and 3. 16.64, 15.43, 1.75. What is current liabilities? Also they have given it to me. All is given. So current ratio is current assets upon current liabilities 3.01 is to 1 times. Liquid ratio will be liquid assets upon current liabilities. Which will be the liquid assets? I will not take inventory. Accounts receivable plus cash and cash equivalent. That means 15.43 plus 1.7. 17.8. Divide by current liability, liquid liability, one and the same thing. So 1.53 is to 1. Then what they want? Gross profit margin ratio. Come here. How much is the gross profit? 33.98. Given. Net sales given. Margin you can just find it out. 33.98 divided by 144%. Okay, 23.60 approximately. Net profit margin, net profit after tax divided by net sales. Net profit after tax also they have given it to me. 15.78 divided by 144%. 10.96. You didn't have to make even the income statement. Return on equity will be profit available for equity shareholders upon equity shareholders funds total. What is the profit available for equity shareholders? This only, net profit after tax. How much equity shareholders funds we have? Equity share capital plus reserves and surplus. 27 plus 6.36. 33.36. So 47.30%. Total equity is what? Equity share capital plus reserves and surplus. Done. Return on equity. Current, liquid, gross profit, net profit, return on equity. Question number 6 is also over. Okay, 5 marks. 1 mark for each ratio, which everything is given in the problem. Nothing is to be done. No, there are no adjustments only, na? So obviously you have to take everything from this. Okay. So now let us move on to the next sum, which is again a past exam question, and these were asked in your June 2025 attempt. Okay. So very simple questions, but carrying good marks in the paper. So let us understand the question first. Calculate trade receivables turnover ratio. Very easy. Trade receivables turnover ratio and average collection period from the following information. Right. So we do know that about receivables, average receivables, which is average debtors plus bills receivables. Correct. And we have to also find the average collection period, creditors, basic debtors. Okay. So based on that. So debtors we generate only if there is a credit sales. So total revenue from the operation they have given me rupees 78 lakhs. Revenue from the sales on credit is 65% of this 78 lakhs, means there is total sales and I am doing certain sales on credit. Trade receivables at the beginning of the financial year and at the end of the financial year, and assume 365 days for calculation. Such a simple sum and it is going to cover 5 marks. Okay, so let us have a look at the solution. Simple. Total revenue given 78 lakhs. Simply do 78 lakhs into 65% because this is what they are saying is on credit. So this is like basically I am going to generate as debtors. Okay, debtors. Average of my trade receivables. They have given me opening and closing. Right? So I need average because the formula for the trade receivables turnover ratio will be my credit revenue, credit sales upon average receivables. This is the formula, important. So credit revenue is given to us. We calculated 65%. What is my average receivables opening plus closing upon 2? Opening 5 lakhs, closing 7 lakhs given, divide that by 2, you are going to get 6 lakhs rupees. So simple, 50 lakhs 70,000 divide by 6 lakhs, 8.45 times is your trade receivables ratio. Now they are asking us average collection period. For average collection period, we do the opposite, vice versa. Right? We take average receivables upon credit revenue. Okay, so you can directly take 1 upon 8.45 into 365. Same thing, no? Because this we have already calculated. So we are just reversing the formula for collection period. So average receivables upon credit revenue into 365, that is 1 upon 8.45 into 365. You will approximately, you will take the whole number, okay, before the decimal. So 1, divide that by 8.45 into 365, you will get 43.19 something. So you cannot take 0.19. 43 days approximately will be my average collection period. Okay. So 5 marks in the pocket. So simple. Okay, now let us read another question. Even this is very easy. The following data is given for 2 similar companies, A and B Limited. Okay. Net profit margin, A is making 23% and B is making 20%. Asset turnover ratio. Okay, these all ratios, turnover means sales, revenue, is 1.25 and 1.5. Financial leverage is 1.5 and 1.40. We are supposed to calculate return on equity of A and B. Which company has a higher return on equity and what is the reason for this higher return on equity? Okay, so basically it is divided as 3 marks for calculating this, 1 mark, 1 mark. Just giving for reasons. Here we will use this formula, return on equity. You all remember we had done a sum wherein return on equity, if net profit margin is given, asset turnover ratio is given and financial leverage is given. It was like kind of a DuPont analysis. So in that case, we are using this formula, return on equity, very important formula. Okay, very important. Otherwise, we do return on equity, net profit after tax, okay, net profit available for equity shareholders, divide that by the equity share capital plus paid, the entire shareholders items. Correct. So we have that return on equity formula, but this is also one of the very important formula when net profit is given, asset turnover ratio is given and financial leverage is given. When all these 3 is given and they are asking you return on equity, see they have given us all the 3. Net profit, asset turnover and financial leverage. So when all these 3 is given, we will use the simple formula of multiplying everything. Net profit into asset turnover into financial leverage. Just simply multiply. Don't put the percentage sign. For A Limited, it will be 23 for net profit. 1.25 is the asset turnover and 1.5 is the financial leverage. Multiply all that, you will get 43.13%. And for B Limited, 20, 1.5, 1.4, 42%. I calculated. Now I know which one has higher return on equity. A Limited has higher return on equity. A Limited has higher net profit margin and slightly better financial leverage as compared to B Limited. Yes, we can see it from the chart only. If you see the chart, A Limited has a better net profit. They have got a better financial leverage also because of, as compared to B, because of which they are getting a higher return on equity. Okay, clear everybody? And now for today's marathon, the last sum, again a past exam question, 5 mark. Okay, this is also very easy. Calculate materials consumed in the production and payment for the inventory from the given figures. Assume entire purchase is on credit basis. Okay, so you are not getting any purchases on cash. Everything is like creditors. Inventory at the beginning of the year, credit purchase is 3,20,000. Inventory at the end of the year. Trade payables at the beginning of the year and trade payables at the end. Simply make the ledger. This is what even the institute has done. Simple. What are they asking? Inventory account. They are asking us, no, materials consumed in the production and payment for the inventory. Okay. So first make the inventory account, debit and credit. Why inventory? Because they have given me opening, closing of the inventory and they have given me opening and closing of trade payables. Okay, so I am going to make these two accounts, inventory account and trade payables account. I will get my materials consumed. So basically, just a rough working I am showing you all. Okay. For inventory account, they have given me inventory is an asset. So I will start with the debit side, to balance brought down, opening 3,000, opening balance. And I will close it on the credit side. Closing balance, they have given me 76,000. Right? Now, two trade payables. Two trade payables and, okay, fine. Now we'll make a trade payables account also first and post the opening. Trade payables is a liability. Therefore, it will be coming as a credit side opening 28,000 and on the debit side it will be closing 29,000. Okay, so I'm just writing the opening and closing and keeping. Okay. Now we have also done some credit purchases and entire purchases, like these are all credit. So in my trade payables, obviously I will have this credit purchase. In my trade payables, this particular credit purchase is also going to come. Okay, so because of which my inventory has increased. So what will be my journal entry? My inventory has increased, inventory account debit to trade payables. So inventory account debit, okay, to trade payables. So in trade payables, I am going to get buy inventory account. And here, two trade payables, 3,20,000. This particular entry, this entry will be what? My stock is increasing, right? Inventory coming in. I am taking everything on credit. Okay, so it is going to be my trade payables. Inventory account debit to trade payables, 3,20,000. My journal entry. Okay, understand why these ledgers are there. It is very easy to finish it with the ledger. So when I know my inventory account is getting debited, so in my inventory account on the debit side, I will write two trade payables, 3,20,000. And my trade payables account is getting credited. So in my trade payables account on the credit side, I'll write buy inventory account, 3,20,000. Now close these both the accounts. When you will close the accounts, so in inventory we came to know, we had opening, closing, we also bought something. So how much we have consumed will be my balancing figure. This is what we have consumed, used, 3,24,000. And in case of trade payables, I have opening, I have closing. I brought more inventory on credit. So there is a balance which is getting created on there is a credit balance. Okay, that means we have paid Credit side is more than the debit side. Correct? So that means we have paid some amount. 3,19,000, the balancing figure we must have paid to our creditors. So that is why it is showing, okay, payment for the inventory. How much we have finished paying? 3,19,000. Okay, so payment for inventory, we have done 3,19,000, and materials consumed, we have got 3,24,000. Okay. So this was it with your ratio analysis. We have already solved quite a few sums with all the ratio analysis formulas which I have given you, and with this we complete the entire session for ratio analysis marathon. Okay? So try to solve all these sums which are there in the notes. The notes are available along with the solution notes. So try to solve them all properly. Okay, past exam questions also. Though they look so big, but you all saw how simple it was, to finish it. So see you all my next class. Till then, all the best. Bye. Okay, so now let's solve the next exam question. It was asked in your December 2025. Okay, easy question, very easy, 5 marks. The following information is given for Kabir Limited based on 360 days working in a year. Total revenue from the operations is 40 lakhs. Total receivables on April 2024 and March 2025. So this basically becomes your opening. And this is closing, right? Because of the year we understand. April 24 ending 31st March 25. Cash revenue is 20%. We are supposed to calculate the trade receivables turnover ratio and average of the credit period. Okay. So now what is given to us? Given. Revenue from operations total is 40 lakhs. From that 20% is cash. So I am not concerned with cash. I have to understand what is my credit revenue, credit sales. So credit revenue will be 80% of 40 lakhs, which is 32 lakhs. Opening trade receivables given, closing is also given. So average will be 4,15,000 plus 4,75,000 divided by the 2. So 4,45,000 will be average trade receivables. Now I have to just put my formula. They are asking debtors turnover ratio. What is debtors turnover ratio? Credit revenue upon average of the debtors receivable or trade receivable. Correct. Average receivable we have already calculated. Credit revenue is given 80%. So 32 lakhs divided by 4,45,000, 7.19 times. Second thing they are asking is the average of the credit period. What do we do for average of the credit period? We reverse the debtors turnover ratio. We will say average receivables upon the credit revenue. Right? We do what? Average receivables upon the credit revenue, credit sales into, they are saying 360. So now this is the reverse only, no? So it is like basically 1 upon the debtors turnover ratio. I can write like that. 1 upon debtors turnover ratio. This is how it has become reversed. So 360 into 360. Therefore 360 upon debtors. This is a shortcut. Debtors turnover ratio. We have already found out debtors turnover ratio. Now we want the average credit period. So 360 divided by the debtors turnover ratio, which is 7.19. 360. Why? Because they have told us to take 360 in a year. 50 days will be your average credit period. Okay. So both done for 5 marks. Okay. So even ratio analysis here, it is completed. Okay. We have solved all the past exam questions. I have given you some practice questions also. You all can just do this revision and you are just good to go even for ratio. We have done all extremely difficult to the most easy sums, applying the formulas. Everything is completed. Okay. So with this, we have finished with ratio analysis. Thank you everyone. Bye. Hello everyone. Welcome back to our corporate accounting marathon wherein we are going to start with another important chapter, which is cash flow statement. Okay, so cash flow statement, why it is important? Because yes, it is important for the shareholders and stakeholders who are deeply invested in a company. Okay, for them, this statement is one of the four pillars of the financial statements. So now, whenever you see any, if you have ever seen a corporate financial results, you will see cash flow statement as a most important part of that particular annual accounts. Okay, so we have P&L, we have balance sheet, we have directors auditors report, but along with that, cash flow statement is the most important statement which helps the investors understand as to what and how much is the company doing in form of their management of their cash. Okay, payment or receivables of the cash. Now basically, what does this cash flow give you, like what has to be done in the cash flow statement? First thing, the applicability of cash flow statement is as per the accounting standards 3. Okay, so Company Act 2013 also says that cash flow statement is a part of first balance sheet. We have P&L, income statement, we have cash flow statement as a part of our financial results. Okay, so important terms to understand for cash and cash flow. Basically, in this chapter, we are going to see how much does the company do to have their cash coming in, what are the activities by which cash comes in, and what are the activities by which the cash goes out. Okay, this chapter is basically on these two important words, cash coming in and cash going out. Now, we all know that we prepare financial statements based on the accrual. Okay, so if I have done some services, or I have rent, or I have sold some goods, even if I have not got the money for that sale, okay, I have sold goods on credit, we put it in our accounting statement, we show it as a revenue. Okay, but when I'm talking only about cash, cash basically can be for various activities. I must have just taken some plant and machinery and cash has moved out. Or I have sold some plant and machinery which is not related to my operations and cash has been coming in. Because of which the profit shown in the P&L is not something which the investors or stakeholders are interested in. Investors wants to know that how is the activities managed with the help of keeping cash properly. Okay, because how liquid are you? Okay, the organization, how able are you to pay your liabilities? Something which is very, very important, and it has to be shown in the form of a statement. So now cash, basically there are three terms, important terms. See, cash is everything available as cash in hand and available as deposits in the bank, okay, in your bank account. Cash equivalents are those investments which can be sold immediately. They are short term. Okay, they are readily to be converted into cash in the market. So those are also known as cash equivalents. Okay, like treasury bills, commercial paper. So companies might have kept that extra cash in form of such investment which can be readily converted into money in no time, is also a part of the cash equivalents. Why we need to know this term? Because the cash flow statement has a particular method to be solved. It has a particular statement format, and in that format these terms are very, very important. So we are going to see how the cash inflows and how the cash outflows are happening of the cash and cash equivalent. Whatever will be the difference of inflow and outflow, we will say that will be the cash, net cash inflow, or it can be net cash outflow, depending. Obviously, if my outflow is more and my inflow is less, so it will be net cash outflow. And if my inflow is higher than my outflow, my net cash inflow I will get. Correct? But, okay. What is important? Classification. Okay, classification of cash flow statement is very important because this forms our statement. Okay, in our statement we have to follow accounting standard 3. So they want us to tell that how much is your cash flow from different activities. The most important activity is our operating activities. Okay, your principal activity for which you are running this business, okay, related to your income and expenses statement, or all everything related to your operations. So in case of your operation activities, it is of those activities of the enterprise. It is not related to any investment and finance, etc. Okay. So operating activities will determine how much cash receipts and cash payments you are able to do and manage based on your operations of the company. Okay, this is one of the activity. Second activity is the investing related activity. Okay, now investment is all related to assets. My operations is selling of goods. Say I'm selling mobile phone. Okay, this is my operations. Okay, I'm a manufacturer of, or say I'm a manufacturer of pen. Okay, I sell pen. Okay, so my product is pen. Everything related to that pen, from buying the raw materials, making the ink, putting the plastic, everything will be related to my operations. But for the purpose of doing this activity, if I'm buying any kind of an asset, I'm buying some plant, I'm buying some office, or I'm taking some office on rent. Okay, all that is relating to my assets. Okay, they will help me in operations for sure, but it has nothing to do with my operations, which is year to year basis. Okay, cash flow for year to year basis. So in that case, those activities are related to investing activities. So if I'm buying some asset, it will be a cash payment to acquire that asset. Okay, or disposal of the fixed asset, that is not related to my operations. I don't have the business of selling the plant and machinery. Okay, I am into other business, but selling of plant and machinery or acquiring any kind of shares, or any kind of doing any investment in other companies, shares, warrants, debt. Okay, you acquiring that share capital, that is again investment for a company. You are either cash receipts from disposal of your shares, warrants, you are selling those shares, again it is related to your company's investments. Okay, you are taking some kind of a loan, or you are paying off the loans, all that is related to your assets. It's related to your separate assets of the company. Okay, so this is a second important thing, that cash flow from investing activities is how much. And the last one is cash flow from financing activities. Okay, financing activities is all that relating to your equities and loans. Okay, equity and loans in the manner like what? You wanted to buy this asset. Okay, you wanted to buy a plant and machinery. Now that plant and machinery, you have taken capital from the public, and then you are going to invest in that. So equity share capital will increase. So you are doing this financial activity. Correct. You are going to pay dividend on that capital. Again, it is related to your finance cost of your capital. You have taken loan from the bank. Okay. Again, it is related to your financial activities. Right. Interest you are paying. So all that which are relating to your financial instruments. Okay, that will be known and gone into the financial activities, and we are going to get cash flow from these three separate activities, and then we will come to know whether it is an inflow or an outflow. Okay, so there is a way to show this particular statement. Okay, there are two methods which we have to follow. One is the direct method and the other is the indirect method. Now from your exam point of view, both are important. They might just generally ask you, give you certain information and ask you find cash flow from either investing, financing and operating activities, or they might ask you full-fledged sum. Okay, and it can be of indirect method also. So understand one thing first. Okay, I'm just taking you all through the direct method because it is very simple. It is very easy to understand what all is happening in operations. Okay, when I'm talking about operations, Obviously, I must be receiving money from my customers. That is some cash inflow. Everything related to cash. Okay. Everything related to the operating activities and cash related activities in operations. Okay. So if my customers are paying me money, I will have that amount. If I go ahead and I pay my suppliers, I will subtract that amount. So I will get some cash generated from operation. Right? Simple. I had to collect money, so I got money in, and I had to pay some money. I have paid some money. I have got my cash from operation. From that, income tax we have to pay. There is no way that we can evade tax. Income tax has to be paid. I get cash flow before extraordinary items. If there is any. Extraordinary means because there was something which had happened, unusual thing, an unusual condition took place, because of which we got some money in. Because of there was a strike, or say there was an earthquake disaster settlement, etc. Only then any kind of an extraordinary item which may or may not be there, we have to just add that back. We get cash flow from operating activity. Okay. Though here it is looking very simple, there are a lot of things which can be there in the operating activities. Okay, there can be changes in the closing stock. There can be changes in your outstanding expenses depending on the balance sheet they give. We will do a sum, only then you will understand this. Cash flow from investing activities. If I am purchasing a fixed asset, my cash is going to go out, obviously minus. Okay, if I am selling some asset, I am going to get the cash in, so it will be addition. Okay, I am receiving interest. Why? Because I have done investment in some other company in form of debenture or loan I have given to some company. So I am receiving interest. It is relating to my investment activity. It has nothing to do my operations. So I will add it. Dividend income I am receiving. I have invested in form of capital in another company and I am receiving dividend. Dividend we put it in P&L. Interest received also we put it in P&L. Profit from sale of the equipment also we put it in P&L. Everything goes in the profit and loss statement. But this particular statement tells me that from which activity I am getting that cash in, or for which activity that cash is moving out. Okay, so you can get cash from investment activities. And last one is a cash from financial activities. If you have raised capital in form of share capital, money is going to come in. If you are raising capital in form of loans or debentures, money is going to again come in. You might be paying your previous loans, money is going to go out. Interest you are paying. Why you are paying interest? Because you have taken loan. And dividend also you are paying because you have taken shares. Okay. So all this is relating to your financial activities. We will have to add all the three. Cash flow from financial, from investment and from operating activity. We will come to know whether there is an increase or decrease. Cash coming in, inflow or outflow. In that we add the opening. That means this is your current year's cash flow. Net cash flow. Net. It can be in form of inflow. It can be in form of outflow. Okay. From that you add the opening cash and cash equivalent. Opening. Okay, you are going to get your closing cash and cash equivalent. Alright. So this is just a direct method. This is how in case of direct method you are supposed to solve it. Just see whether cash is coming in or whether it is going out, and if it is yes coming in, going out, which activity it is. Okay, so we are going to read a sum. We are going to classify which activity, and then we are going to understand whether it is coming in or it is moving out from the business. Okay, so this was direct method. In case of indirect method, I will come to this format later when we will solve a sum on indirect method. Now let us read one question. Something like this they will give you in the exams. There is this information available of exclusive limited as on 31st March 2005. Though they don't give you such full-fledged sum for direct method, they will give you only one activity. But we will do all the activities in this one sum. Okay, there are cash sales for the year rupees 10 lakhs and sales on account is rupees 12 lakhs. Just give me a minute. Okay. So there is a cash sales for the year 10 lakh rupees and sales on account is rupees 12 lakhs. Now cash sales means you're directly selling the goods on cash and on account means it is on credit. You will receive money later on, but there is a sales happening of rupees 12 lakhs. Then there is some payment you have done on accounts payable. Must have bought some inventory stocks, did a payment of 7,80,000. Then there was collection against accounts receivables. Some money came in due to the debtors who has paid you. 7,60,000. Rent you have paid in cash 2,20,000 and outstanding rent being 20,000. 4 lakh equity shares of rupees 10 each were issued for 48 lakhs. Equipment was purchased for 16,80,000. Dividend amounting to 10 lakhs was declared but not yet been paid. Rupees 4 lakhs dividend declared of the previous year were now paid. Equipment having a book value of 1,60,000 was sold for 2,40,000. The cash account has been increased by 37,20,000. We are supposed to show the cash flow statement using the direct method. Now before I move to the cash flow statement, just to bifurcate which activity will be belonging to each and every entry they have given. Cash sales, accounts on credit sale, everything related to operating activity. Accounts, we have made payments on account payables, again operating, right? Collections done on account receivables, operating activity. Rent paid, rent outstanding, these are all your year-to-year expenses related to your operations. Correct? Equity shares, financing. We have raised equity shares capital, right? We have done equipment purchase, investment activity. Dividend was there but we have declared but it is not paid. But dividend related activity will be obviously investment related activity. Sorry, financial related activity. 4 lakhs of dividend, again financial related activity. Equipment of a book value was sold. So now this is going to be your investment related activity, asset. And then they have given that the amount was increased to 37,20,000. Okay, now see this cash flow from operating activities. I am interested about cash. In case of direct method, we are interested about everything actually happening in cash. So I know my operating activities. There are 4 operating activities here. I have cash sales, amount paid to my creditors, collections done against receivables, and rent paid in cash. Okay, so these 4 things I am going to take into consideration. One is my cash sales, 10 lakh rupees. I paid to my suppliers, cash is going to go out, so put it in the bracket, 7,80,000. Okay. Collection done against accounts receivable, cash is going to come in. And I have paid rent of 2,20,000 in cash. So cash is going to go out. Okay, so if you will do the net cash flow from operating activity, add the positive ones and then subtract the negative, you will get a proper answer. 7,60,000. Okay, just write it in the outer column. Everything related to cash only I am interested in my direct method. This is a direct method sum. Okay, direct method. Cash flow from operating activity. So if you will see, I did nothing about my credit sales. Nothing. I just took my cash sales. I did nothing about my outstanding rent. I just took the rent paid in cash. Simple. All the 4 operating activities are over. There is no operating activity in the sum now. Now moving to your investing activity, which is related to your assets and equipments. Okay, cash flow from investment activities. We have only 2 na. Equipment was purchased and then there was one equipment sold. Okay, so when I have purchased the equipment for cash, my cash is going to move out, will be negative. And when I am selling that equipment, I am going to get my cash coming in. How much? It was of book value 1,60,000, but how much cash is going to come in? 2,40,000. So I am going to just add that 2,40,000. But when I will do net cash flow from this investment activity, I am getting an outflow, negative 14,40,000. Obviously, because purchase of equipment is more than what I have sold, right? So we are done with the investment activity. Both investment activities done. My operational activity is also done. Now we are left with the financial activity. We have raised capital, 4 lakh shares. Okay, but the share capital is 48 lakhs rupees. We must have raised it in form of premium. So my share capital, okay, issue of shares is 48 lakhs for cash. Then there was a dividend which I have declared but I have not paid. Though it is related to my financial activity, but I have not yet paid. But dividend of previous year, which was 4 lakhs, I have paid now. Okay, dividend which was of previous year, I have paid now. So that is going to go in form of cash outflow. So 48 lakhs coming in and 4 lakhs moving out. So my net cash inflow from the financial activity is 44 lakhs. They have already given me net increase and decrease in the cash and cash equivalent because they have given me the answer. So calculate and see whether 44 lakhs plus 7,60,000. Okay, 2 positives I am adding. And then subtract 14,40,000. See, you are going to get 37,20,000. Right? Got it? Okay, so direct method, understand one thing, that in direct method all the 3 activities bifurcate. Whatever is happening in cash we are going to take into consideration. Okay, so this was for you all, just a simple sum for you all to understand how does a cash flow statement look like. So in case they happen to ask you direct method, simple, do cash flow from operating, from investing and from financing. You will get the net increase or decrease the cash and cash equivalent. Okay, if there is any opening cash and cash equivalent given, add it and you will get the closing. In this sum they have not given me anything, so my closing is the same, like net increase and decrease. Okay, now let us read another question. Madhuri Limited gives you the following information for the year ended 31st March 2006. Sales for the year total 96 lakhs. Company sells goods for cash only. Okay. Now they are saying this is going to be operating activity, right? Cost of goods sold was 60% of sales. Closing inventory was higher than the opening inventory by 43,000. Again operating activity, again operating activity. Trade creditors on 31st March 2006 exceeded to those on 31st March 2005 by 23,000. Again, this is related to your operating activity. Okay. Tax paid amounted to 7 lakhs. Again, operations related only tax. Depreciation on this fixed assets for the year was rupees 3,15,000, whereas other expenses totaled to be 21,45,000. This is also operating related expenses. Outstanding expenses as on 31st March 2005 and 31st March 2006, opening and closing, total to 82,000 and 91,000 respectively. Again, this is relating to your operation. New machinery and furniture costing 10,27,000 in all were purchased. New machinery will be investment relating to asset. A right issue was made for 50,000 equity shares of rupees 10 each at a premium of rupees 3 per share. Entire money was received on applications. Financial activity. Dividend of 4 lakhs was distributed. Financial activity. Cash in hand and at bank, that is your cash and cash equivalent, at 31st March total to 2,13,800. 31st March total means opening. Okay, there is 2 years involved, 2005 and 2006. So 2005 is going to become my opening. Previous year is current year's opening and this year's is closing. Right, so all this is related to my opening and closing. This time they have given me. It is very easy, nothing. There is nothing to worry about. Okay, let's see. Cash flow from operating activities. They are telling me all my sales are in cash only, directly. Okay, so this entire 96 lakhs is going to be cash coming in because of sales, positive. Okay, now they have given me the cost of goods sold directly. Cost of goods sold is basically what? You do opening plus purchases minus your closing stock, materials consumed, use, etc. All that cost which was involved in generating this sales is already given to you. So you will directly subtract this cost of goods sold, which is how much? They are saying it is 60% of the sales. Directly variable, directly related. So you will subtract 57,60,000. Now, closing inventory was higher than the opening inventory by 43,000. Just think one thing, that if you are having more stock in your godown at the end of the year, that means that much of your cash flow is blocked. If you would have sold that, okay, your closing stock is more. Basically, they are saying what? Closing stock is more by 43,000. That means your cash flow has got blocked by this 43,000. You have not sold it. So you have not got inside the cash. That means the cash has gone out, like, because you have purchased it, no? Then only it is there in your inventory. You must have purchased this particular stock and you have not sold it also. Therefore, it is in the negative 43,000. Next is, because they have given this opening closing, we have to take care. Trade creditors on 31st of March was exceeded to those on 31st March 2005 by 23,000. So when your creditors have increased by 23,000, there is increase in the creditors for the current year. Increase. That means your cash flow has not gone out. You must have purchased some more inventory. There is no money going out because we have taken cost of goods sold over here. Okay, and the other things are given to us in the form of opening and closing. We will have to analyze that how much cash has got blocked in coming in or going out. Since my creditors have been increased, that means cash is staying with me. I have not taken it out from my pocket. If creditors have increased, cash is with me. Therefore, I will add it. right? Taxes are paid. We have to pay the tax. Tax subtract. Simple. Outstanding expenses. Okay, there is something. Where is it? Here. Outstanding expenses. As on 31st March and 31st March 2005, it was 82 and then it became 91,000. Okay, 82,000 and 91,000. So my outstanding expenses have also increased. Outstanding expenses increased means what? They are outstanding first thing in nature. I have to pay. I have not yet paid. Increased means what? Not paid. So to that extent, I am holding the cash with me. That is 9,000 rupees. To that extent, from that opening and closing, 91 minus 82,000. Right? Closing minus opening, 91,000 to 82,000. How much is the cash flow? The increase in the outstanding expense, 9,000. So to that extent, my cash is not moving out. So I am going to put it as a positive. Outstanding expenses increase. Creditors, see, even the creditors has got the same effect. Since there is an increase in the creditors, I will put a addition sign to my cash flow. Why addition? Because to that extent that money is staying with me, not moved out. Otherwise, I would have had to pay. Even for the closing stock. Now in closing stock being my current asset, if it is staying with me more, that means I am blocking the money. Money is not coming in. So to the extent of 43,000, it is considered as money gone out. You must have purchased this stock, right? And the last one is your operating expenses. Now in case of operating expenses, they have given you depreciation on fixed assets of 3,15,000, whereas the other expenses total to 21,45,000. These other expenses here, other operating expenses. We will not take depreciation. Why? Depreciation is a non-cash expense. So depreciation is not taken into consideration. Any kind of provisions, depreciation which does not actually have any cash movement out. Depreciation is just to show as an expense in your P&L. Provision for tax just to show as an expense in your P&L. Okay, so all that is not related to your cash moving out. Therefore, I am not going to take it into consideration. Operating expenses subtract. Now, when you will do the total, first do all the positives and then subtract the negatives. Okay, so 96 lakhs plus 23,000 plus 9,000. I think something like 96 lakhs 32,000 you will get. From there, now minus 57 lakh 60 minus 43,000 minus 7 lakhs minus 21 lakh 45. 9,84,000 you will definitely get it. Net cash inflow from your operating activities. Okay. So all the operating activities are done. 1, 2, 3, 4, 5, 6. Okay. Now the seventh one is your investment related. You have purchased some furniture. If you have purchased, cash will go out of the business. So purchase of furniture, you will show it in the negative sign, 10,27,500. Anything else related to investment? Nothing. Only one entry was there. And the last one is cash relating, cash flow from the financial activities. There are two things. One was dividend and one was right issue. For right issues, they are saying 50,000 equity shares of rupees 10 each. Premium is 3 rupees per share. So obviously, I will take 50,000 into 13 rupees. No, I'll get 50,000 into 13. 6,50,000 will be my cash coming in because of this right issue. And dividend paid is 4 lakhs distributed to the shareholders. That will be my cash going out. So my cash inflow from financial activities is going to be 2,50,000. Now there is positive 2,50,000. There is positive 9,84,000. Add them both. 2,50,000 plus 9,84,000. And then subtract 10,27,500. You will get net increase or decrease in cash and cash equivalent. This will be your net increase or decrease. There is an increase, 2,06,500. Add back the opening. They have given you the opening, 2,13,800. You will add the opening to the current year's increase and decrease. We will arrive at the closing cash and cash equivalent, which is 4,20,300. Okay, everybody? Understood? Cash flow. This was also a part of your direct method, but it was a little different. Why? Because they had given us the financials of 2 years, opening and closing, with the help of which we had to ascertain whether the operating activities there is an increase or decrease. Generally, even in your past exam questions, if you'll see, they will give you financials for 2 years, and based on that, you'll have to compare to see whether there is an increase or decrease. Okay. Now, I am coming back to my theory which I had given to you all. Just to make you all understand now, you will be able to get it. So, we did cash flow from financing activities, did it from investment. We also did it from operating activities, right? Direct method. So, see, there are certain examples. Cash sales of goods and services, cash collected from the debtors, cash receipts on interest or dividend. Now, why will this come over here? Interest and dividend is relating to your investment and financial activities, no? If you have received interest or you have received dividend and you're putting in the operations, that can happen when you are into the business of investments. Okay, so this is something different. I will explain you again. Cash received from royalty, fees, commission, these are your revenues. Paid to your suppliers, you're paying rent rates, wages, income tax, all this is your operating related activity. There are some formulas how to find some cash collected from debtors if they have given you opening, closing and all that. So you have opening balance of the debtors, you have got the closing balance of the debtors, right? Opening plus credit sales minus closing balance, that will give you the balancing figure will be the money coming in. Even if you will make the ledger of the debtors, you will write to balance, opening, by balance, closing. Okay, you have done some purchase, so debtors have increased, okay, to sales. So whatever will be the balancing figure means you have got the money in your bank account by bank. Right, so this will be the money coming inside. Same thing for suppliers. Opening balance of creditors plus whatever credit purchase you have done minus your closing creditors will get you cash paid to suppliers. Payment to employees, opening outstanding salary plus your current year's salary minus closing. And then interest paid out, opening outstanding interest plus interest for the current year minus closing. Insurance, same, opening. Insurance is always prepaid. So insurance expenses for the current year plus closing minus you will do your prepaid. Only this is different because insurance premium is always paid in advance. So closing plus your current year's minus opening will give you your insurance premium paid. Okay. Now there is this one table I want to see. Okay. Interest and dividend. What does interest and dividend? It depends upon the nature of the enterprise. Okay, it depends upon the nature of the enterprise, how you will treat this interest and dividend. Right now we did two questions. We did dividend in the financial activity only, right? In both the sums. Say if this enterprise, they are telling you it is a financial enterprise. Okay, financial enterprise means what? They are dealing only into shares and debentures, etc. They are dealing only into this financial instrument. Okay, so cash flow arising from interest paid and interest and dividends received have to be classified as their operating activity because it's a business. Okay, that will be their operating activity. So if they are paying interest, okay, or they are kind of receiving interest paid and interest and dividends which they are receiving is going to be classified as their operating activity. Okay, however, dividend paid will be classified as financing activity because they will pay dividend only if they have raised capital. No, if they have raised capital, they have shareholders, only then they will pay dividend. So receiving payment of dividend, whatever it is, payment of dividend which they are doing, only that will be classified as under financial activities. But otherwise, receipt of dividend, receipt of interest, or payment of interest will be classified as an operating activity if it is a enterprise which is a financial enterprise in nature. For all the other enterprises, interest paid should be classified as cash flow from financing, interest paid. Yeah, because you must have taken loan and you are paying interest, financial activity. Cash flow arising from interest and dividend should be classified as your investment activities when it is in case of your when you are into financially dealing into financial scripts. Okay, all this is your financial business. Dividends pay should be classified as cash flow from the financing activities. See this. Financial enterprise and other enterprise. You are paying interest. If you are paying interest and you are into financial enterprise itself, obviously this is related to your operations. You are receiving interest, okay, and you are a financial enterprise. Obviously this is related to your operations. You are also receiving dividend. You are a financial enterprise. It is related to your operation. Okay, but dividend paid will be related to your financial activity. For any other enterprise, if you are paying interest and if you are paying dividend, it is related to your finance. But if you are receiving interest and receiving dividend, that means you must have done some investment in another company. That is why it is related to investment activities. So this table is important. Even if you don't read anything else above, just keep in mind, if they have mentioned financial enterprise, then take into consideration that interest paid, interest received and dividend also received. These three will come in the operating activities. Okay, interest paid received, dividend paid received. There are 4 elements. Okay, interest paid, interest received, dividend paid, dividend received. If it is a financial activity, except dividend paid, everything will be into operations. But if it is in any other enterprise, interest paid and dividend paid will be financial activity. Interest received and dividend received will be due to your investment related activities in another organization. Right? Here. Now, I am coming to your indirect method. Okay. Before we solve a sum, I am taking you all through the format of indirect method. Now, in case of indirect method, only cash flow from operating activities, only this format changes. Cash flow from investment and finance remains the same like what we did in the direct method, no change at all. But in case of indirect method, only operating activities, now we will have to change it. Why change it? Because in this type of sums, no, they will kind of give you net profit. They will not give you your sales figure and all that. They will give you the balance sheet. From that balance sheet, you are supposed to take the profit amount, and in that profit, now you will have to make the adjustment that this profit is appearing in the P&L. What all we must have done in order to arrive at that profit. Okay. So when you take profit before tax and extraordinary items, we will have to do adjustments for those things which are non-cash in nature, because in P&L we put all this depreciation, we debit amortization, all that we debit, and then we arrive at the net profit. So now with this net profit which we have already arrived, I will have to do all the adjustments. Non-cash expenses, I have to add it back. Anything related to financial activity, if I have already put, I will have to add or subtract it. Like profit on sale of investment or profit on sale of fixed asset. interest or dividend, whatever I have done relating to financial activities, okay, that all again I have to add back or subtract in order to arrive at a profit for operational related activity. So then I will get operating profit before working capital changes. Now working capital relates to current assets and current liabilities. So any changes happening in the current assets and current liabilities, that will affect my working capital. So if there is increase in my assets, if my assets have increased, obviously it is understood I have paid and I have bought some asset. Right? Assets increasing, money is kind of going out. If there is a decrease in my current assets, that means money must have come in. If there is increase in my current liabilities, that means I have not paid cash. And if there is decrease in my current liabilities, means I have paid to my creditors. Think in that way. Then you will less your tax, any extraordinary items, if there is any, you less it, you get net cash flow from operating. Investment and financial activities remain the same. What all we have to do in case of indirect method for cash flow from operating? We take the net profit. In that net profit, we do all the adjustments to be done. Say adding back of depreciation, adding back any provisions, adding back anything which was relating to finance, adding back everything relating to investment. We will add all that back, add or less, whatever depends on what is the situation. And then we will, through that profit, we will do working capital changes and then arrive at net profit from operating activity. Okay. For this, we will read a given question. Balance sheet of X Limited as on 31st March 2010 and 2011 was as follows. When in your exams, you all will find this type of sum zone. They will give you 2 years balance sheet. So this will become your opening. Previous year. This will become your current year closing. Okay. We have share capital from 5 lakhs, this 7 lakhs, general reserve 50, 70. Profit and loss was 1 lakh, now it is 1 lakh. Sundry creditors was 1 lakh 53, now we are standing at 1 lakh 90. Bills payable from 40, now we are standing at 50. Outstanding expenses from 7, it has reduced to 5. In case of asset side, land and building from 80, we have got 1 lakh 20. Plant and machinery from 5 lakhs to 8 lakhs. Stock 1 lakh to 75. Sundry debtors from 1 lakh 50 we reached to 1 lakh 60. Cash is 20 and 20. Opening 20, closed also 20. Additional information. 50,000 depreciation was charged to the plant and machinery in the year 2011. A piece of machinery costing 12,000. Depreciation provided thereon was 7, was sold at 60% of profit on the book value. You are required to prepare the cash flow statement. Now, whenever these type of sums are there, okay, working capital related, we will take it in the working capital changes, right? Working capital is your current assets and current liability. So, current assets, working capital, sundry creditors, bills payables, working capital, outstanding expenses, working capital. Stock, working capital, sundry debtors, working capital. Cash, so we will take in cash and cash equivalent, right? So we have 5 items of working capital changes, right? I'm just putting it in the balance sheet for you all to understand the bifurcation. Okay. Anything relating to my share capital will be what? Financial activities, right? Anything related to my share capital, financial activity. Anything related to my fixed assets be what? Investment activity, right? General reserve, profit and loss account are everything which will come when I will put money in my general reserve, when I have balance left from my profit. After finishing all the expenses, I have some profit left. That profit I will appropriate. I will put some in general reserve. I will put I'll pay some dividend out of it, or I will do some kind of a thing from that profit. So P&L and general reserve is something which we will have to understand. Okay, with the help of which we will be able to find the profit. Now they have given me 2 adjustments related to plant and machinery. Okay, one is about its depreciation and one adjustment that machinery was also sold. All the adjustments which they give, will take that in the form of working note. Okay. There are two adjustments. I have passed two journal entry, working notes, journal entry and ledgers. It is very important for us to make ledgers when this type of sums is. Okay, first journal entry. Depreciation charge to plant and machinery, simple journal entry. Depreciation account debit to plant and machinery, 1000. And there is one machinery which I have sold. Whenever I will sell a machinery, I will get money, no? I will get money, cash or bank. I will get that money. And what will go out? That machinery will go out. And profit or loss on the sale of machinery, then we will get. So see this. There was a machinery costing rupees 12,000 and depreciation on that was 7. So costs 12 minus depreciation, so its written down value is 5,000. It was sold at a profit of 60% on the book value. What is the book value? 12,000, na? Costing. 60% above if I am selling, that means I am making a profit only of 7,200. So how much money must I have got? 12,200, no? I got 5,000 plus I got this 7,200. I have sold that machinery at 60% above the cost. So cost was 12,000 rupees. I have sold it 60% above. That means my profit is 7,200. So how much money I got in selling? Sold. Okay, this is the amount of money I got, cash coming in due to the sale. This is the money coming in, 12,200. Plant and machinery, I will write it at the written down value only, no? And what is the profit on sale? P&L, it will go 7,200 rupees. Okay, because this is a profit. Profit on sale of P&L, also we put it in the P&L only. Plant and machinery, written down value, how much machinery is actually going out? 5,000 only. But how much money I received is on my cost, 60% above, I got it on sales. Okay, so 12,000 plus 60% if you will do 7,200 is the amount you got as a profit. Okay. So now these two journal entries are there. I will make the ledgers. Simple, I will make plant and machinery ledger and I am going to make my P&L appropriation ledger. Why? Because P&L appropriation if I will not make, I will not be able to find my profit amount. Plant and machinery, debit side, credit side. Rest all is very easy. So in case of plant and machinery, opening will be 5 lakhs, closing will be 8 lakhs. So 2 balance brought down opening, 5 balance carried forward closing. Right? Now I have a journal entry. Depreciation account debit to plant and machinery. So this depreciation will go, na? One, so I will have to add it back to the operating activities, non-cash expense. And one I will put it in the plant and machinery account credit side. So by depreciation 50,000. Right? Then there is one more journal entry. I got some money, no, due to the sale of this plant. So how much plant has gone out will go, no, in the ledger. Right? It will go on the credit side. By bank, I received money on that. Correct? So opening, closing and all this journal entry when I will pass, I will get I'm getting a credit balance. That means I have purchased more machine. 5,000 plus 50,000 plus 8 lakhs. 8 lakh 55, 8 lakh 50. There is a credit balance. That means there is a purchase of machinery happened. Purchase to the extent of 3,55,000. Okay, so this purchases will go in what? Investment activity now. Right? So my plant and machinery, I am done. Because there was depreciation, I had to pass the journal entries and make the ledger. Rest all the items, I can just compare the amounts and see whether there is an increase. Here if I would have tried to see that there is an increase in 3 lakhs, of plant and machinery, I would have been wrong because there is adjustments to that. There was certain plant and machinery being sold also, and there was a depreciation which we had to charge. So now I need to know the net cash investment done in my plant and machinery. There was opening, closing, understood. But then there was depreciation which I had to charge. There was some plant's WDV value, the extent of which has been gone from my plant and machinery's ledger. Okay, so two purchases will be how much? There is nothing here. Purchases of the balancing figure 3,55,000. This they can ask you as a separate question for 3 marks. Now I need to find my NPBT. They have given me my PNL account. Simple. Profit and loss, they have already given me 1,60,000 and 1 lakh. So I will start by balance brought down, opening 1 lakh, and to balance carried forward 1,60,000. Okay. Then, okay, there is a transfer to general reserve. See this. From 50, my general reserve became 70. Now, transfers also will happen from my PNL appropriation only, no? Whatever profit I have, okay, after tax, from there I will do appropriation. Means what? Allocating that profit to different reserves or provisions, etc. So that means this transfer to general reserve also has happened from here only. 20,000 rupees, the change. This is also done general reserve and PNL. Okay, so my NPBT is now 80,000 rupees. I'll have to start the sum with the net profit before tax, do the adjustments on that, and then arrive at cash flow from operating activity. Now see this, taking this 80,000 the sum. Net profit before tax 80,000. Any financial related or investment related activities I will add back or subtract. Okay, is there any interest related? Nothing is there. Okay, there is nothing, dash. Add back interest. Add back interest received. Add back any depreciation. Yes, we have provided depreciation 50,000. Add it back. Okay, any kind of written off or any kind of a provisions also we added back. Is there anything? There is nothing. I put a dash. Add non-operating expenses. Is there any non-operating expenses? There is nothing. Is there any non-operating income? Yes. We had put that profit of 7,200. It is non-operational. There is a profit of 7,200 which we had put it in our PNL. No? So my profit has to be now reduced because it is non-operational in nature. So subtract 7,200. You will get cash flow from operating activities before working capital changes. Okay. This is your non-operating activity, this 7,200. Okay, this cash and cash equivalent, one entry has gone in the plant and machinery account. Okay, one effect will go in what? Your profit, no, in your PNL. So 1,22,800. So all this is done. Now I will do my working capital change. Working capital changes, you have to just compare whether there is increase or whether there is a decrease. Okay, so starting with the creditors. Creditors have increased 1,90,000 has become from 1,57,000. There is an increase in working capital, so I will add back. Increase in liability. I must have made more purchases. I have not paid. So increase, add back. Increase in bills payables by 10,000, again add back. Okay, so whenever there is an increase in the liability, I will add it back. 10,000 added back. Bills payable, outstanding expenses was 7 and now it has become 5. That means I must have paid, no? Only then my outstanding expenses has decreased, no? So if there is a decrease in the liability, I will subtract. Money has gone out. Now there are two assets, current assets, stock and sundry debtors. Stock has reduced by 25. That means I must have sold it. I must have got cash because of that. So add it back. Decrease in the asset, I'm going to add it back. Increase in the asset, I'll have to subtract. Now increase in the debtors. Debtors was 1,50,000 and now it has become 1,60,000. That means I'm not able to get that money from the debtors. There is still this additional 10,000 blocked in form of cash, right? So I'm going to now subtract it then. So if there is an increase in the current assets, I will subtract. Okay, if there is an increase. If there is a decrease in the current assets, I will add. If there is an increase in the current liability, I will add. And if there is a decrease in the current liabilities, basic logic you have to apply. So now from 1,22,800, first add all the positives, plus 37,000, plus 10,000, plus 25,000. Then subtract 10,000 and subtract 2,000. You will get 1,82,800. Operating profit after working capital changes. Okay. Tax paid related, any entries there here? No. There's nothing. They have not given me. So I am putting dash, minus tax paid dash. 1,82,800. Now I am left with investment and financial activities. We have already mentioned what is investment activities for us. Land and building and plant and machinery. Land and building we have already calculated, purchase of land and sale of land. See, this purchase of land from 80, it has become 1,20,000. Okay, so basically 40,000 I have purchased it only. Na? If I have purchased it, my money is going out. So negative 40,000. In case of plant, I have made the ledger. So I will go and see my ledger only. In sale of plant, I have received money, 12,200. That will come as sale of plant, positive. And my ledger shows me that I have made more purchases of plant, which amounts to 3,55,000. If I am purchasing, it will be in the negative sign. He is going out. So add 3,55,000 plus 42 negatives you add and then subtract 12,200. You will get 3,82,800. Put it in the negative sign. That is a net cash outflow. Because of investment activity. And last one is your financial activities. Only one financial activity is the share capital. From 5 lakhs it has become to 7 lakhs. Means what? You have issued shares, got money in the account. Issue of shares by 2 lakh rupees. So this is cash inflow. 2 lakhs inflow and 1,82,800 inflow. 3,82,800 is the inflow minus 3,82,800. You have to do all the three, no? A, B and C addition. This one you have to add. This is the 2 you have to add. And 3 you have to add. Right? That is 1 plus 2 plus 3 you will do. When you will do, you will get nil. Positive and negative, same number. Is there any opening cash and cash equivalent? Yes, they have given me. Cash opening 20,000. Add that back to the nil. You will get closing 20. See, closing is also 20, no change. Opening also we started at 20, closing also at 20. We have verified this sum. Clear? Understood? Okay, so cash flow statements, try to focus on your practical questions only. They are not going to ask you anything related to the theory in cash flow. Okay, now coming to your past exam questions. Your past exam questions are pretty simple than what we have done. See this. They have given me capital structure of Sangam. Okay, they are saying there is share capital. Shares are of rupees 10 each, 5,000 crores. Secured loans 4,000 crores and unsecured loans is 2,500 crores. In the next year, the company is planning to expand the project and they need 1500 crores. The project will be financed at 40% with fresh owners capital and 60% they will take a debt. And the old debts is not repaid also during the year. Equity capital will be raised at rupees 15 per share and average interest on the debt, your old debt plus your new debt will now become 13%. Your tax rate is 25%. You are supposed to show the forecast of cash flow from financial activities. So easy, everything related to financial activities only they are given. Share capital, secured loans, unsecured loan, everything is relating to your finance. Okay. So let's see. Just give me a second. Okay. So this is your December 24 attempt sum. Okay. Capital structure of Sangam Limited. Now what I am writing is, they want us to find cash flow from financing activity. Okay, particulars amount, rupees in crores. Okay. First I will do the working note for you all. Now you see this breakup. Okay. We have to first understand the requirement of Sangam. They are saying Sangam is going to require 1500 crore rupees. Now that 1500 crore, they will take 40% in form of equity and 60% they will take in form of debt. Understood? So if they are taking 40% in equity, that means 600 crores in form of equity and 60% that means 900 in form of debt. So if I am taking 600 crores in form of equity and my value of the share they are saying has to be raised at rupees 15 per share, right? So 1600 crores is the amount divided by the issue price. So how many shares am I raising? 40 shares of rupees 10 each. 40 crore shares of rupees 10 each. 40 crore shares of rupees 10 each. Why 10 each? Because that is the face value and 5 rupees is the premium. So 40 crores will be what? 400 crores. 40 into 10, right? Face value into number of shares, and here number of shares into the security premium. Security premium is 5 rupees, so this will be 200. So 400 and 200, right? Next is your interest cost. Interest is important. You have secured loans, you have unsecured loans, 4000 and 2500. Again, we are doing a debt 900 crores. Okay, so now total debt will be how much? This is already their previous given. Unsecured is also previous already given. This is new. So when I do the total, they are saying average of this total, we will be paying 13% of average rate of interest on old plus new debt. So if I am paying 13%, that means I am paying 13% on how much? 7400. This will be my interest. 962 crores will be my interest amount. It is important, no, for my financial related activity. Interest paid. So now I can find out what is my cash flow from finance related activities. First one is issue of shares. The share capital which I have raised. I got it in form of capital 400 crores and in form of share premium 200. So total became 600. There is new security debt raised. They have told me 900 CR. Correct? And then there was a debt interest which I have paid, which is 962 crores. So cash flow from the financial activity 538 crores. Right? Cash flow from the financial activity. This was already there previously. Okay, now they are telling me to find the cash flow from the financial activities, forecasted cash flow because of this particular raising of the capital of 1500 crores. Now what will happen? From 1500, 600 I am raising in form of shares. So that I have mentioned. Share premium also and share capital separately. 400 and 200 becomes 600. I am raising new debt also of 900 crores. And on that interest also I will have to pay. Interest will be going out. This is going to come in. Cash flow coming in due to the financial activities, and this is cash outflow. Okay, so 900 plus 600 plus minus 960. From 1500 I will minus to get 538. Could have done directly also, but it is for 5 marks. We have to show some kind of a format, some working note to the institute that we have solved this. Okay. Clear? Understood? Now the next one. The summarized information of CBA Limited is given. That is the 31st April 2022 and 31st March 2023. So opening and closing balance sheet. Share capital from 9 lakhs, it has become 10,50,000. Share premium is 90,000. General reserve has also increased. PNL from 90 to 2,42,400. Debentures was not there. Now it has come. Okay. Sundry creditors has increased. Provision for tax has increased. Proposed dividend has also increased. In the asset side, land and building, plant and machinery, furniture has increased. Stock has increased. Sundry debtors increased. Bank balance has increased. Everything. Now depreciation during the year was for land and building 1,80,000, plant and machine 1,50,000, and for furniture it was 3,600. Debentures were issued on 1st of October 2022. We are supposed to prepare the cash flow statement of CBA Limited for this financial year. So only adjustment required is for the depreciation. Okay, basically. Only depreciation related is what is there. So this sum I have solved it currently like this. First, okay. You see your profit and loss account. From 90,000 it has become 2,42,400. 2,42,400. I subtract 90. I am going to get 1,52,400. Net profit before tax, PNL difference I have just. Okay. Now I am going to do the adjustments. Okay. Add back all the expenses which are not supposed to be taken for operation. Add back or subtract. Depreciation, non-cash expenses, I will have to add it back. Okay, because I am doing a reverse treatment. No, this is net profit before tax. I did the PNL difference and took it here. Now I have to do the adjustments of financial activities, investment activities, any provisions, transfers, depreciation, everything I'll have to do here. So depreciation I will add back non-cash related. So add it back. All the 3 depreciations I have already given 1,80,000, 1,50,000 and 3,600. Here 1,80,000, 1,50,000, 3,600, 3,33,700 600 depreciation I've added. Right? Now see this general reserve we had done in our previous sum also. General reserve has increased. 1,95,000 has become from 1,35,000. That means the 60,000 in general reserve I must have put due to my provision P&L appropriation. Add that back. Any transfers I will have to add it back. There is an interest factor also involved in case of debentures. This is 2,10,000 issued on 1st of October. My balance sheet is as on 31st of March. So how much months debenture interest I can take? Only 6 months. 6 months debenture interest I can take. So on my 2,10,000, 10%, okay, it's 221,000 divided by 2. 10,500 will be my 6 months interest on debentures. This is my financial related activity. It has gone in the profit and loss statement. It has reduced my profit. I'm going to add it back. Interest on debentures for 6 months, 10,500. Any provision for tax, any proposed dividend, they are not paid. They are provision. They have been removed from the P&L appropriation account. Okay. So any provision for tax, now they have not given me anything related to provision. So the opening one, the previous year will be the tax paid and current years will always be provided. Previous year I'll pay and current years I am providing, I am not paid. So provision for tax I am going to add back for the current year. Proposed dividend also same thing. Previous years gets paid, current years gets provided. Okay, so 1,05,000 also added back. So all the adjustments which were required, anything else is there? Nothing. Right, land and building, plant and machinery, furniture. For land and building, plant and machinery and furniture, there is depreciation only. This is again working capital, stock, debtors, working capital, sundry creditors, working capital. This we have already completed. Okay, the one which will be paid, we will take it, no? Tax paid. Proposed dividend is your financial activity. Right? This also we removed it. We'll have to put it in the financial activity. General reserve is done. P&L is done. Share premium and equity share capital again related to your financial activity. Right? So, cash flow before working capital changes. Everything in addition only. From your 1,52,400, you have to add back everything. 1,52,400 plus 3,33,100 plus 6 plus 10,500 plus 1 lakh and plus 10, 1,05,000. 7,83,000 you're getting. Now I will do my working capital changes, increase or decrease in the current assets and current liability. If there is an increase in the liability, I am going to add it. If there is a decrease in the asset, I am going to add it. But if there is a decrease in the liability, then I will subtract, and increase in the asset also I will subtract. Basically based on this is the common treatment which we do now. So see this creditors. Creditors have increased. That means I am holding on to cash. Liability is increasing. Right? So this is going to be positive. Increase in the creditors. Add. Much I'll add the difference. 72,100. 17,100. Right? So creditors is done. Stock is increasing. If stock is increasing means I have not made the sales. That much of amount of cash I did not get. Stock has got increased. If stock has increased, my current asset has increased. I am going to subtract it. 39,900 difference here. 2,87,100 minus 2,47,100. And even the sundry debtors. 2,25,000 to 2,56,500. It has increased. That means payment has not been done to me. I have not received that much of cash. Debtors are in fact increasing. So I'll again subtract increase in sundry debtors. So from 7,83,000, add your 17,100, two positive figures added. Okay. Don't do this mistake in the exams. Huh? See that you are adding back positive figures and then you subtract. You will do 7,83,000 plus 17,000 and then subtract 39,900, 31. Only then you will get the right answer. That will be 7,28,700. From there I can pay my tax. Tax paid. Opening one, the current year will be provided, but the opening one is going to be paid. Previous year is paid. Previous year is paid. Current year is provided. If nothing is given, then we are going to. Current year will be provided, previous year. Minus tax paid, so I am going to get 6,60,000. Cash flow from operating activities is done. Okay, now coming to the purchase of land and building, plant and machinery and furniture. Okay, now these accounts are important. Now if you see land and building, since they have given me depreciation as an adjustment, I have not passed any journal in this sum. We will directly do it. Land and building, since depreciation has been given to me, I have to make the ledger. Okay, so 6,90,000 openings, 11,70,000 closing. So two balance brought down, by balance carried forward. Depreciation is given to me, so I am going to say by depreciation 1,80,000. When I will close this, I will get the balancing figure. Since the credit side is more than the debit, I must have purchased it, right? 6,60,000 is purchase of land and building. This will go in my investment activity outflow. Same thing I'll do for plant and machinery. They have given me the balance opening and closing, 2,56,200, 4,20,000. Depreciation is also given to me. I'll just put the depreciation in my plant and machinery. The balancing figure will be my purchase. Obviously, if it is appearing on the debit side, credit side is more than your debit. Okay, so that means you have purchased it, no? So to bank, 3,13,800 will be your investment activities cash outflow. For furniture also same thing. You will write the opening and closing. Opening on the debit side, closing on the credit side. Depreciation is given. So your balancing figure will be your investment activity cash out. Okay. See this provision for tax account I have made. By balance, to balance. Given to me opening and closing. Right? You see there is a tax paid which we took 67,500. I'm just showing you all. Okay, you don't need to make this provision for tax. But 67,500 is the amount of I have paid for tax. So to bank, provision for tax account debit to bank. So your balance figure is your by P&L provision for tax. See, it is the same thing. 2,21,500. So for provision for tax and proposed dividend, always remember that your current years is kind of proposed. Previous year will be always paid and current year will get proposed or provision. Okay. The previous year I paid it, current years became the provision for provision. Now taking my cash flow from investment activities, purchase of land and building, it will be negative. Purchase of plant and machinery negative. Purchase of furniture negative. So there is a cash outflow from investment activity. 9,80,400. And financial activities, yes. All the financial related activities. Equity share capital has increased. So share capital, issue of shares by 1,50,000. Share premium has increased by 90,000. There was nil. From there I made it 90. So there is an increase in the share premium. There is an increase in the debentures account 2,10,000. That also increase will come here. Interest on debentures I had removed from my net profit, no? I had added back to my net profit. So from here I will have to subtract it 10,500. And for dividend, year, current year will be provided. The previous year will be paid. So previous year is 90,000. The dividend paid will be money going up. So 1,50,000 plus 90 plus 2,10,000. From there now subtract 10,500 for interest and 90,000 for dividend. You will get 3,49,500 positive. Okay, so 3,49,500 is positive. There is another positive figure. Yes. Plus 6,61,200. From there minus 9,80,400. You will get 30,003. Add back the cash and cash equivalent at the beginning of the year. Is it 1,02,600 given cash and bank? 1,02,600. I will add it. I'm getting 1,32,900 cash and cash equivalent at the end of the year. Verified. Right? So this sum is important. Sum they can ask type of questions. Good for 7 marks. Now let's see the next question. From the following summary of bank account of X Limited, prepare cash flow statement for the year ended 31st March 2023. To balance brought down and by balance carried forward they have given. This is what? Bank account summary. In that they have debited issue of shares, receipts from customers, sale of fixed asset. Money must have come in. And money gone out, payment to suppliers, purchase of fixed asset, overhead, wages, income tax, dividend. They repaid a bank loan. So easy. Assume that the company does not have any other cash and cash equivalents and there were nil cash transactions. Okay. We are supposed to prepare what? Prepare cash flow statement. Cash flow statement in the books of X Limited. So we will start with cash flow from operating activities. They have directly given me. Cash received from customers 2,800 positive operating activity. Cash paid to the suppliers operating activity negative. Overhead expenses will be operating activity. Wages and salaries operating activity. Income tax also will go into operating activity. So cash receipts from customers plus 2,800, cash paid, suppliers negative, overhead expenses negative, wages and salaries negative. We get cash from operations minus income tax. You show it separately always. Income tax is how much? 250. But it forms a part of operations. So from 500, 250 is gone. 250 is cash flow from operating activity. Cash flow from investment activities, this is related, no? Investment activities, purchase, negative. Dividend will be finance related. Sale of fixed asset, investment activity, positive. Right? So cash flow from investment activity, purchase of fixed assets, negative. Sale of fixed assets plus 100 will be plus. Purchase will be outflow. So plus 100 minus 200 minus 100 will be cash outflow due to investment. And in case of financing, we have equity shares and we have dividend and we have repayment of bank loan. All this is related to my finance. So cash flow from finance activity, equity shares is issued. So I'm getting cash coming in. Repayment of loan will be cash going out and dividend also will be cash going out. So cash flow from financing activities is also 50, negative. Negative 50, negative 100 will be negative 150 plus 250. Net increase or decrease, which is net increase actually in our case. A plus B plus C, cash and cash equivalence is 100. Cash at the beginning of the year they have given me, opening balance 50, opening. This is closing. So opening balance is 50, I will add it. Arriving at 150, verified. Same 150 here. Okay, so yeah, in cash flow, this is one very good thing. Be able to understand what you have done is right or wrong. Most of the time. Now there is this June 2025 question, a really big one. Let us read and understand. There is a lot of history, geography, but the sum is very simple. Ashna is a mechanical engineer from a premier institute based in Kolkata. After working for a decade in the engineering industry, Ashna completes a management development program from a top grade business school. Subsequently, Ashna, along with her 3 colleagues, sets up a venture capital fund, GKJ and Company. The aim is to invest in companies that manufacture, import, substitute. There is an impetus from the government to manufacture in India to meet domestic demand and for the world, and hence felt that any investment made in the manufacturing industry is likely to grow on an above average rate. GKJ and Company has raised an initial amount of 80 crores from the investment and is scouting for an initial development opportunity. One such opportunity investment is in Royden and Company. Royden and Company is a manufacturer of equipment and tools which are used in dental clinics. The equipment is essential as an import substitute and has potential to be exported as well. Balance sheet of Royden they have given me. Balance sheet in the financial year, rupees in lakhs, ending and beginning. Okay, opening and closing. Share capital 1400 to 1600 rupees in lakhs. Okay. Share premium 180 to 220. Retained earnings have gone from 476 and 60. Loan was not there, now it is there 400. Creditors 138, working capital. Outstanding salaries, working capital, and provision for taxes. In case of assets, plant and machinery has increased. Accumulated depreciation they have given me on the asset side, that is why they have given me in the negative form. Building, again accumulated depreciation on building. Land, stock working capital item, debtors working capital, prepaid expenses working capital, cash and cash equivalent, cash and bank, opening and closing total. Now there are certain details they have given. Plant was costing rupees 320 lakhs, on which there was an accumulated depreciation of 296, was sold during the year for 24 lakhs. Building which was acquired during the year costed 4 lakh 20. In addition to the cash payment of 20 lakhs, mortgage of 400 lakhs was raised for that balance. Dividend of 160 lakh was paid during the year. A sum of 278 lakhs were transferred for provision of taxation account. Royden and Company wants to set up a plant to manufacture advanced dentistry equipments. The said equipment is imported from USA. The Indian government is giving benefits in terms of tax holidays for such type of businesses. It is estimated that the turnover of rupees 800 lakhs could be generated at a profit in the first year of operation. The new business setup requires significant investments. Royden and Company have reached out to GKJ and Company for the first round of funding. GKJ and Company has requested Royden for some further information before investing, and Royden Company is requested to prepare profitable projections under different scenarios, and these scenarios are given as follows. So the base case, they say that they will make 800 lakhs of revenue, having 60% of cost as variable. Fixed cost will be 80, depreciation 100, and income tax they will pay 40 lakhs. In case of best case, that means if their sales are increasing by 37.5%, then their variable cost will become 56% of sales. Fixed cost, depreciation, and income tax, same tax rate as the base. In case of worst case, sales can decline by 25%. 65% of the sales will be variable, fixed cost depreciation, and same income tax rate as the base rate. Prepare cash flow statement in direct method of Royden Company for the current financial year with the available details. Calculate return on equity and return on assets of the Royden Company. Calculate profit under different scenarios. There are 2-3 chapters which they have mixed and they have asked. They're asking ratio analysis, they're asking financial statement interpretation and cash flow statement. 15 marks compulsory question. Okay. Let us do this. First part, A. Now part A, before making any cash flow statement, let us understand the journal entry. Okay, I am passing the journal entry for this sum as a working note. You want, you may not pass it. So first one is plant was costing 320. It had some depreciation of 296 lakhs. It was sold for 24 lakhs. So simple journal entry will be what? If I am getting money in due to sale, I am getting cash and cash equivalent 24 lakhs. Why? Because plant is going out 24 lakhs. On that same plant, there is a depreciation accumulated. So it has to be depreciation account debit. It is an expense to plant machinery. 296 lakh 90. So this first journal entry is done in 2 forms. Cash and cash equivalent 24 lakh. This is related to your investment activity, no? Positive. And this will go in my ledger. Depreciation also I will make a separate ledger. This also will go in my ledger. Next is my building. I had acquired a building costing 420 lakhs. So building coming in, building account debit 420. They are saying we did cash payment of 20 and balance we took a mortgage loan. So see, this mortgage loan is showing here 400. Right, this mortgage is here. And we have done cash payment also of 20. So again, this is related to what? Investment activities. Paying negative. This is mortgage loan. This will be related to your financial activity. Money coming in. And this will go in your ledger. Then we have done some payment of dividend. Dividend of 160 lakh was paid during the year. If I am paying dividend account debit to cash and cash equivalent. This will go in my financial activity negative. And this dividend I will have to add it back to my net profit before tax operating expense. Add it back. Okay, this we will see. It's like same thing like provision for tax, dividend paid. A sum of 278 lakhs was transferred to provision for tax account. Now from where will I transfer any sum? From P&L appropriation to provision for tax. Anything which I am left after whatever profit I have left with, I will then do payment of dividend, then I will provide for tax, etc. So now for this I am going to make my ledgers. Whatever journal entry I am passing, especially my plant and machinery, building, P&L, everything I will make as a ledger. Okay. So see this. I have made a ledger for plant and machinery account. To balance and by balance, I am going to take it from the opening and closing. Okay, so see this. Plant and machinery. Accumulated depreciation. Okay, opening and closing. So opening depreciation. Plant and machinery I am taking opening first. 1240 and closing is 1320. So opening and closing. Right? There is a plant and machinery which I have sold, for which I passed the journal entry. So this plant is going to move out, no? 24 lakhs. Also there was an accumulated depreciation on it. So by depreciation of the plant sold, by bank for sale of that plant 24 and 296. So now when I'll close my plant, all the journal entries are done, adjustments are done. The balance will be my purchase. This will go in my investment activity negative. Since I am doing my plant and machinery, I'll do accumulated depreciation on my plant and machinery. Buy balance brought down, opening. To balance carried forward, closing. Depreciation is an expense. Credit the opening with the closing, right? 740 and 524. Then I did one depreciation over here, no, in the plant. If I have credited the plant, I will debit my depreciation account, depreciation on plant and machinery sold, lakh 96, 296 lakhs. So when I close my depreciation on plant, this will be my current year's depreciation on plant. I'll have to add this back to my net profit, right? This is going to be my depreciation for plant. Same thing for building. Building, opening 1900, closing at 2320. There is no sale purchase kind of any adjustment entry on this. So opening and closing, when I write, the balancing figure will be the purchase directly because there are no other adjustments. Okay. Is there anything? Yeah. Okay. Building, there is an adjustment. Okay. Cash and cash equivalent and mortgage loan I have bought for 420. There is 420 coming. Yes. It is coming as 420. Okay. So for that 420 though I paid some amount in cash. Okay. And I also have taken a mortgage loan. So there are two effects they are going to. For 20 lakhs my money is going to go out, and for 400 lakhs my money is going to come in. For building, this is investment account negative, it will go 420. But there will be another effect. No, for every journal entry there are two effects. Okay, so negative this will go. But in case of financial activity, I will get no positive 400 also. Right? Now accumulated depreciation on building, buy balance, opening, to balance, closing. So this will be the current year's depreciation on building 40. Will go add back to the net profit. Alright, now I have got this. I need to know my profit for the year. Now profit for the year, how will I come to know? How will I calculate net profit for the year? Okay. Before provision for tax and before dividend. Provision for tax, they have already given me the entire details on provision. Opening and closing they have given 20 and 20. So buy balance brought down 20, opening, balance carried forward 20. Okay. They have also told me that from the PNL provision was done of 278 lakhs. Right. So that will be by PNL provided 278 lakhs. So the balance will be what? Tax paid. Will go no in operating activities. At the end I will subtract this amount of tax, right? Then I have made a ledger of my retained earnings. They have given me retained earnings instead of PNL. They have given me retained earnings 616 and 476. So buy balance brought down, opening, closing. 476 is opening, closing is 616, right? I have paid dividend of 160. From where will I pay dividend? This retained earnings is like your PNL only. PNL appropriation. You will get retained earnings when you have some profit left and you are putting it in your retained earnings. You are transferring it. So dividend also you must have paid it from there only. So your balance will be what? Your net profit after tax, PNL. So you can do this net profit after tax 300, add back the provision for tax, which is how much? 290, 78. Okay, so you are going to get this amount of net profit for the year before dividend and before provision. It will be 578, 300 plus 278. 278 is your provision for tax. You can write it separately also. Net profit 300, add back provision, you can write it. This is your net profit. Correct? Now, anything which is related to depreciation, I add back. Calculated depreciation on plant and building, I will add it back. I will arrive at operating cash flow from operating activity before working capital changes. Now, what are the working capital changes in my sum? Creditors, outstanding salary. Creditors have decreased. Outstanding salaries also have been decreased. That means I have paid my creditors and outstanding salaries have been paid. So, if there is a decrease in the outstanding salaries, I will have to subtract. Decrease in the creditors also I will have to subtract. So, from 138 has become 120. 18 and 12. Okay. From 40 it has become 20. So I am good. This is done. Provision for tax is done. Now this I am doing working capital. So 18 and 12 I will have to subtract. In case of my asset side, working capital related 3 items are there: stock, debtors and prepaid expense. Stock has decreased, asset has decreased. That means I must have sold it, got some money. So decrease in the stock, I will add it back. There is a decrease in happened in the debtors, means debtors have paid me money, I will add it back. Prepaid expenses have increased. Means prepaid expenses, that means money has gone out. Okay. So therefore subtract -2. So from 698, I will add 30 and I will subtract 30. Again I came at 698. Provision for tax, we had made a ledger. From there we got the tax paid amount. See, why did we make this provision for tax account? In order to understand how much is the tax paid. Opening, closing we did. Journal entry, adjustment we did. So the balance will be tax paid 270. So minus 270, I am going to get cash flow from operations after tax. Okay, after tax. Actually. So I start with the net profit for the year before dividend, before tax, before provision, everything. Alright. I am going to get tax paid. Lastly, I will deduct. Now cash flow from the investment activities. We have made ledgers. I told you in investment activities, have purchased a plant that I am going to write for 400 lakhs. So purchase of plant and machinery negative 400. We have also purchased the building. We have made a ledger negative 420. Then anything else is there? We have a land also. Land from 200 has become 240. Land. So there is a purchase of land, does not depreciate. Therefore there is no depreciation. So again negative 40. And there was a sale of plant. Right? Sale of plant. Here. My ledger journal entries. There was a sale of plant, no, cash and cash equivalent to plant. Investment activity I will add. Remember this I had written. So that therefore I will add it back here in my investment activity. Add 24 to get 836 cash outflow from investment. Now cash flow from financing activities. In case of financing activities, I will see my share capital. From 1400 it has become 1600. So 200 is coming in of shares. There is a share premium also. From 180 it has become 220. So 40 again coming in, 40 lakhs. Then there is a mortgage loan here. There was no mortgage loan before, but now it is there for 400 lakhs. So it is going to come in here. It will be positive. It is coming in. Money is going to come in. And dividend paid will be money going out. Investment activity. We had passed the journal entry also for this. Dividend to cash and cash equivalent. From financial activity, I will subtract it. See, for dividend, I have already done, no, from retained earnings, I had added, no. Then only we got that net profit. So two effects are gone. One is negative, one is positive. So cash and cash equivalent. Cash flow from financial activities is positive 480. Then we have positive 428. 420 is 908 and minus 936 because it is an outflow. We are going to get net cash increase and decrease. Increase in the cash flow and cash equivalent is 72. Have they given me the opening? Yes, opening is given to me 124. Add the opening, I'll get the closing 196. They given me the closing? Yes. Verified? These sums are little, I know, a little bit tricky when it comes to how to find the net profit. Remember one thing, just pass the journal entries for this, any adjustments they have given, give them two effects. Definitely there has to be two effects. One of addition, one of subtraction. Make the respective ledger for the fixed assets only and provision for tax and PN. Once you have done that, you will automatically get it. Your net profit has to be profit before any kind of provision, before any kind of dividend paid, anything. Okay, so that profit when you will take it and then you will start making adjustments, you will arrive at operating profit. You have to make adjustments to those type of profit. Then the sum is very easy. Now they are asking me calculate return on equity and return on assets of Royd and Company. Okay, so fine. We will just write the formula. Calculation for return on equity and return on assets. What is the formula for return on assets? I have done return on assets. Net profit after tax upon average of total assets. We know net profit after tax 300. Remember I had shown you earlier. It is how much? It is 300, no profit. You add the provisions and then it becomes 578. I have given you all like this because if in case you all happen to go and see the model answers of the institute, then they have solved it this way. Then you should not come back to me thinking that ma'am you have not done it. Even if I have not done and if I am doing it also, this is the same thing. Profit, how did I get? I got it with the help of my retained earnings amount. Na? Opening, closing, dividends were paid. So my balance was my net profit after tax. Right? So 300 lakhs, this one, P&L appropriation or retained earnings account. From there I will get the net profit. So net profit after tax is 300. How much is my average of my total assets? It will be opening plus closing divided by 2. Total of assets is how much? 224 plus 312 total assets. So 254 plus 312 divided by 2, that will be 263. 300 divide that by 633 percentage 13 point. No, you're getting 11 divided by. Yes, it is 11.39. 11.39% return on total assets. Okay. Return on equity, net profit after tax upon average of total equity. Net profit after tax, I know it is 300. But of what is average of equity? Equity will be everything or belonging to the shareholders, no? Shareholder items, equity, share capital, securities, premium, retained earnings. All this belong to the shareholders only. So all my shareholder items are going to become a part of my equity. And I'll have to take an average of it. So I have taken average means opening of equity is 1400, 180 and retained earnings. 1400 plus 180 retained earnings plus 476. 056. In closing 1600 to 20 plus 616. 436. Add that and take an average. Divide that by 2. You will get average. So return on equity will be net profit after tax upon average equity. If they would have not given me everything about opening and closing, I would have just taken the equity share capital and the securities premium, etc. Everything belonging to the shareholders item. So 300, divide that by 2246%, 13.36% approximately return on. And now the last thing they are telling, calculate profit in the different scenarios. Very easy. First take the base case. First solve the base case on one side, and then we will do the best case and worst case. Base case, what they are saying, revenue is 800 lakhs, right? Rupees in lakhs. Okay, don't forget all this. Working variable cost, they are saying it is 60%. So 800 into 60% will be 480. So what will be my contribution? Minus it 20. Fixed cost, they have given it to me. Depreciation, they have given it to me. Okay, and they have also given me income tax, which is 40 lakhs. Tax will be how much? 40. So I'm going profit after tax 100. Now this profit rate, I can find, sorry, the tax rate I can find. If I'm paying tax of 40 lakhs on a profit of 140, I removed my fixed cost, I removed my depreciation, I arrived at profit before tax. From that tax amount they have given me, I can find the rate tax amount upon the profit before tax. 40 divided by 140. How much percentage of tax I paid? 28.57. It is important for me to know this percentage. Why? Because they have told me that even in the best case and worst case, everything this remains the same. Okay, so this I have done. Now, in case of the best case, they are saying sales will rise higher by 37.5%. So 800 plus 37.5%. Your sales will now become 1100. They have given me the percentage of variable cost. So on 1100, take 50%. 16. Easy. You will get a contribution of 484. Fixed cost given to me 60. Depreciation given to me again 60. Oh, sorry, 100. These two are given. Tax rate we calculated, no, 28.57. So now 324. Just take 28.57%. 93. Approximately 92 point something you will get. So 231 is my profit after tax. In the worst case, there will be the decline of sales by 25. So when decline, so 800, I'll always take the base, na? From 800, I am going to subtract 25%. Now I'll stand at 600 lakhs. 65% will be my, again, variable cost. So on 600, if I take 65, 390 will be my variable cost. My contribution will be 210. Fixed cost and depreciation again is given to me. So my profit is going to be only 10 lakhs. In 10 lakhs, if I put 28.5% as my tax, I'm going to get 3. So 7 will be my profit after tax. Rounded off to the nearest whole number. Okay, so we are done with preparing cash flow as indirect method, calculating return on equity and return on assets of Roydon, and calculating profit under different. So quite a big sum. It was for June 2 2025. Okay, and it gives a lot of weightage of all these chapters which are important. Cash flow statement. Try to solve it more. If you all have seen my other videos in which I have solved cash flow statement, many sums I have done on indirect. So when you will start doing those sums for practice, you will get a hang of it, how to find the profit before tax for calculating the operating activities cash flow. So with this I have completed your cash flow statement. Stick to what we have done. Theory is not that very important for cash flow. Just you need to understand how to find investment, financing and operating activities cash flow from the given information. Okay, they can ask you these small sums and make it a big question, or directly in indirect method. Okay, so see you all. Bye in my next class. Okay, so now let us solve another important question for cash flow statement. See, cash flow statement, I've been repeatedly telling you all, it is important. They do ask one sum for cash flow. If they're asking indirect method, it can be becoming the major part of your paper. And if they're asking you direct method, it will be for 5 to 7 marks. Okay, depending on what all they want you to find out. Now, on the basis, let us see this question, which is for December 2025. Okay, it is very easy, but there is some hidden item in this particular sum, because of which the students would feel that how to solve it. But trust me, once you understand the logic behind the question asked and read the question thoroughly twice, you will be able to find the answer in the question itself. Okay, so let us understand. They are saying, prepare on the following information provided by X, prepare cash flow. It is for 5 marks here. Okay, it is for 5 marks actually. Yeah. So one thing is understood, that this will not really be indirect method. Okay, let us understand the particulars given. X Limited sold all the goods for cash only and purchased goods only in credit from suppliers. Company has made a total purchase of 77 lakhs. Company paid 45 lakhs for wages, 9 lakhs for office expenses during the year. Balance of suppliers account on 31st of March 2024 was higher than the balance of 31st March 2025 by rupees 3 lakhs. Okay, for the suppliers. Tax paid is 8 lakhs while provision for tax was 7 lakhs. Company repaid a bank loan of 17,50,000 which included interest of 1,50,000. Dividend was paid during the year 5 lakhs. X Limited also sold the investments for an INR of 60 lakhs, profit at which was 4 lakhs. Furniture was purchased for 20 lakhs. Cash and cash equivalent on 31st March 2024 was 10 lakhs and 31st March 2025 was 49,50,000. So this is basically the opening cash and cash. This is the closing cash and cash. Okay, now let us see the sum. Basically, it is a direct method. So cash flow from operations, financials and investing activity. So cash flow from operating activities. Now, cash sales, we really don't know. Nothing has been given to us about cash sales. So how did ma'am get this amount? We will come to this amount later on. Okay, this amount we will come to it on that later on. We will first see whatever is given to us. We know the cash payments, right? We are knowing the cash payments. We know that we are making payments to suppliers, we are making payments for wages, and we are also making payment for other expenses. Now wages is directly given to us 45 lakhs here. Office expenses is also given to us 9 lakhs here, directly given. Okay, so cash payments we know. Cash paid to supplier, what are they saying? That total purchases of 7 lakhs in 2024 opening, okay, were higher than the balance on closing by INR of 3 lakhs. Okay, so opening plus purchases minus closing, that is what we do to get the amount. Okay, so opening were higher than the balance. So say this was X. Okay, this will become X plus 3 lakhs plus purchases minus X plus X is gone. 3 lakhs plus purchases is how much? 3 lakhs plus 77. I know this is not needed. Actually, it will be directly opening plus purchases, closing, because opening was higher by 3 lakhs rupees. Okay, then the closing. So it is going to be X plus 3 lakhs. If closing is X, X plus 3 lakhs will be my opening because opening is higher. Plus 77 lakhs plus X minus X will get cancelled. So I will get that amount paid to the suppliers. It will be how much? 80 lakhs. Okay, so here amount paid to the suppliers 80 lakhs. Wages 45 lakhs. Office expenses 9 lakhs. Total 134 lakhs. Agreed? At least this amount we know. Okay, now this also amount we don't know. So do not bother. However, I know how much is the income tax paid. They have told me we have paid a tax of rupees 8 lakhs. Provision for tax I am not interested. Right? How much is the tax paid? Cash outflow 8 lakh rupees. Okay, so even this amount I do not know. So whatever I know I am just writing that. Okay, I know tax paid amount and I know the payment to suppliers, wages and to the direct other office expenses. Okay, so all these amounts are known to me. I am writing it. Next is cash flow from investing activities. In case of investing activities, we know it is about sale of investments and also furniture purchase. So sale of investments positive. Okay, cash is going to come in 64 lakhs, 60 plus 4 lakhs of profit. Purchase of furniture is directly given 20 lakhs. So cash flow from investing activity is positive 44 lakhs. Cash flow from financing activity. Dividend is also paid. There is a repayment of loan along with interest. So bank loan repaid with interest. How much? Interest is 1,50,000 and repaid amount is 17,50,000, which is inclusive of that interest. So I will write amount as 17,50,000 only. I will not write 1,50,000 separately. It includes that 1,50,000. Read it properly. Okay. Dividend paid with dividend distribution tax included, which is 5 lakh rupees. So from cash flow from financing activity is negative 22,50,000. That is why I have written it in the bracket. Cash flow from all the activities A, B and C. I will not be able to know that A, B and C. Why? Because I don't know A, but I know B and C. Okay, so this amount we will not know. However, I know opening cash and cash equivalent. This is given. Closing is also given to me. So if closing is 49,50,000 and opening is 10 lakhs, which is given. So when I go reverse, cash flow from all the activities, which is A, B and C, to that we add opening and therefore only we get no closing. So I know closing, I know opening. I'll go reverse, I will subtract. Otherwise I would have added opening plus your cash inflow from all the activities. Okay, cash flow from all activities plus opening would give me closing. Correct? I don't know this, but I know this. Why? Opening is already given. Okay, 10 lakhs. Closing is also given. Therefore, X will be equal to 49,50,000 minus 10 lakhs. So it is going to be 39,50,000. So I came to know this amount 39,50,000 is the cash flow from all the activities. 39,50,000. So that means A plus B plus C is 39,50,000. I don't know A. Cash flow from operations we don't know. Why? Because we know few things. So we'll keep A as A only. B we calculated positive. C we calculated as negative. And total is 39,50,000. So now 44 lakhs positive and 22,50,000 negative. I will take 22,50,000. Okay, 44 lakhs minus 22,50,000 I have done. 44 lakhs minus 22,50,000 is 21,50,000. If it will go on the other side, it will become minus. So 18 lakhs will be cash from operations. So basically here cash flow from operating activity has to be 18 lakhs. Now if I am going to go reverse, I know 8 lakhs was paid for my income tax. If I go reverse, I will add back this amount 18 lakhs plus 8 lakhs. So I will get 26 lakhs. Always in reverse we will add. Otherwise from this amount I would have subtracted 8 lakhs, right, to get 18 lakhs. Now I have to go reverse. So when I'll go reverse, 18 lakhs plus 8 lakhs will be 26 lakhs. 26 lakhs plus 134 lakhs will give me 160 lakhs. Only then this amount will fit in, no? Whenever I go reverse, the sign changes, right? From 26, how did I get this 26 lakhs in first place? Cash from sales minus cash paid. So it is like basically from 160 minus 134, I will get this 26. But now I have 26, I have 134. So to go reverse, 26 plus 134 will give me 160. So this is cash sales, 160 lakhs. 134 lakhs we could easily calculate. 26 we got immediately once we got cash flow from operating activities. So this was the only hidden factor. We had to apply a little bit of logic and all that we know about cash flow in order to calculate this problem and solve this sum. So all the types in cash flow we have already covered now. Simply everything, direct, indirect, this type of missing factor, opening, closing, everything from cash flow is like completely revised. Okay, so go ahead and you all can solve these sums also and revise accordingly for your exams. So with this we complete the cash flow statement. Thank you everyone. Bye. So with this we have completed our entire corporate accounting marathon for the June 2026 attempt. Okay, so please go ahead, refer to all the notes. The notes are given as a link in the description. Download them, take a print, resolve those sums in your books. It will help you build confidence when you will write the paper for your attempt. Okay, so all the important topics along with the entire solution, explanation, concept, journal entries, everything has been solved keeping in mind the structure of the exams. Okay, so I wish you all the best. Read the question carefully, read it twice if nothing has been understood, apply all the concepts properly and then solve. Make proper journal entries, write the narration in small, everything has to be completed. For those who want to have a complete revision of all the other chapters also, you all can go ahead and subscribe for the dream batch and you will be able to access all my chapters for this given subject. So I wish you all very best, do well and stay cool and calm before your exams. Revise properly, sleep properly, eat well, and you will definitely pass with flying colors. My blessings with all of you all. Take care. Bye.